Good morning, everybody, and welcome. Welcome to day 2 of Emergence 2026. Obviously, for those that come yesterday, what an incredible range of companies sort of featured in the life science space. As I said yesterday, that was something that I've wanted to do for some time, and it was great to see the engagement and support for the entire life science ecosystem. So today, obviously we've got people joining us online, people in the room, people still coming in the room. Today, when I think about the Emergence journey, it started as a focus about how do we place a spotlight on the innovation ecosystem. And over the last 7 years, it's really grown to not just being about the innovation ecosystem, but also how do we place a full spotlight on what's happening in the private market space. And so over the next 2 days, our promise is very simple to you. We have done everything over the last 5 months to bring together the opportunity from the investor side to provide you with, number one, access to insights from the leading investment minds across private equity, private credit, venture capital, and also digital assets. And that's obviously a passion spot for mine. And the second part is to access to curated opportunities. As I mentioned yesterday, I've spoken to every single one of the companies featured, at the conference. And the key things that we've looked for, I'll mention sort of in my presentation. And the last part is the high value networking. The best part about events like this is the people that you meet. And last night, again, we experienced that at the dinner. And this year's theme, we've really focused around one key area, and that is convergence and abundance. The convergence of the technology platforms, the 5 technology platforms, and the abundance that's going to be created alongside of it. Now, for us, it's about really, bringing together all the different varied opportunities. And I'd say the key thing that underlines that is how can we provide you with access to high growth and high yield opportunities in one conference, one format where you can meet directly the people behind the event or people behind the companies that are building them. And the thing that I love about this space, everyone talks about how hard we work. The reality is, every single person here is working 24/7 to build their business, build their innovation, grow their ecosystem, build their fund, etc. Like the best thing about this space is it's an all-in kind of ecosystem where people put every part of their life into building what they're doing. Today, there's 2 different rooms. So this is obviously the presentation room, and then on the other side we have the exhibition room. So all the companies featuring today are different to the companies that were featured yesterday. So make sure you take the time to go around and chat to all the companies that have been featured. As I said, and again today, whilst yesterday was live, we actually have 12 incredible biotech and life science companies presenting today. One of them, to give you an idea, they've actually also been backed by VCs in the US as an example. We've got a space opportunity on Friday. We've got all sorts of opportunities that are featured. And I'll do my best to cover some of them at the end. And then the next part is that tomorrow also we'll have, the 2 panel sessions today is going to be focused around the venture capital investment trends. And then the second one will be focused around the private credit investment trends. So all the people involved will be able to go and have a chat with them later today or sort of in the networking zone inside CapitalHQ. All right. So now onto my keynote. I've been saying this for the last 2 years, that this is the best time to access high growth, high yield, and growth opportunities. And that's been accurate so far. And fundamentally, the foundations are still in place for that as an opportunity for investors. And I'll go through my thesis as to why for this. Today, as I said, I'll be focused on innovation. Tomorrow, my focus will move into what are the trends that have been observed across private credit and also family offices and also private equity as well. So to start with, and I know some of you may have seen this in my presentation, but I'll just start for those that haven't seen it. The 2025 summary, it's just incredible to think that the top 7, the Mag 7, created $4.2 trillion of wealth last year. That's an incredible amount of value creation in a short period of time. Obviously, digital assets have had a rough year and a rough start to the year, but the reality is the foundations are set in place for a whole bunch of money to come into that ecosystem, and I'll cover that in the presentation. The innovation, fundraising, and investment is absolutely bifurcated in that you've pretty much got AI and renewables on one side and everything else on the other side. But we're now starting to see some shifts in that. And the IPO market, which is something that we all want to be successful because of the realization of value aspect, is technically open with 67 listings last year. And then with that, $4.4 billion of money raised and then $72 billion of secondary raising. So there's an incredible amount of capital, going into companies that are listed on the ASX. And then geopolitics, obviously that's the part that we all have in our minds about what's sort of happening. And it's obviously a turbulent time right now, and it has been, for some time. And this one is really the standout, is the AI capital-related expenditure. 92% of overall GDP growth last year come from the AI capital expenditure. That is significant. So the theme around convergence and abundance is focused around this part. Firstly, the AI-driven growth. It really feels like AI has been the linchpin for what's happening across the five different convergence of various technologies. And what's interesting is to see that 70% of all seed and Series A funding went to AI-related companies. The next one is the exponential growth and convergence of the platform technologies. So the platform technologies covers, and this is done by a lot of the work around from ARK Invest, where each year they put out their big ideas report and they talk about the convergence of these technologies. So those technologies being AI, robotics, energy storage, blockchain, and multi-omics. And there's some interesting stats, and I'll cover this as to why it is so important that you're seeing these S-curve. If you think about technology gets adopted in S-curves, right? And you're seeing that convergence take place right now, and there's S-curve on top of S-curve on top of S-curve, in play. And so, as mentioned, AI has been the catalyst for all this transformation and basically lit a fire under the whole entire innovation ecosystem. And part of what I want to talk today is, what are the signals that investors should be looking for in this journey? This was an interesting one. When I was doing the research for this, as I said, technology gets adopted in S-curves. Everyone, whether it be from computers to the internet, to the mobile revolution, then to obviously cloud, now moving into AI and everything that associates that. These is where they all plot on the graph as far as where they're at from an S-curve adoption perspective. And what's really interesting is to see multi-omics on the life sciences side is at the earliest of stages, right? So he has the furthest to run. And then likewise, you're seeing with robotics, blockchain, digital assets, AI, etc. Now, AI, that adoption has scaled incredibly quickly over the last 3 years, right? Obviously, whether it be through OpenAI, whether it be through Anthropic, whether it be through Google with Gemini, Microsoft with Copilot, that adoption is accelerating at absolute record rates. And then energy storage. And that becomes very interesting when you think about what powers this generation of technology coming down the pipeline. This is the ultimate signal. It also scared the markets when it came out. But 2 weeks ago, all the big hyperscalers released how much their planned capital expenditure over the next 12 months is going to be. $600 billion is going to be invested into AI infrastructure from all the big hyperscalers over the next 12 months. That is an incredible amount of investment from those companies going in to build out this next platform technology. And what's interesting is that effectively they're expected to fund around about 50% in overall of what will be spent on data centers, or now what's called AI factories. But what's interesting about this is when they've done their analysis, people always have this concern, is this like the internet bubble? Are we experiencing 99 all over again? But the reality is, when you actually go and when you go and listen to the conversations, listen to the CEOs of these companies, they're absolutely doing their best to get as much online as possible. There is, in the terms of from the telco side, there is no dark fiber. What that means is that all the chips are being used, and as soon as they go online, they basically go into use straight away. So there is no shortage of demand right now. And every single day, like literally yesterday, there was two new models released, actually 3 new models released, right? And with that comes more expenditure of the tokens, more requirements and demand on this. And what's interesting is, I keep on hearing, and when I have casual conversations with people, they say, are we in the boom, or are we in the bubble? Are we in the bubble stage? And what people don't really realize is that there's been 4 significant bottlenecks actually for AI. Now, most people know about the energy aspect. That's one of them, but there's actually been 3 others. And all these different bottlenecks, and I won't go through all of them, but all these 4 different bottlenecks have all been aligned to actually hold back the potential for what could be released from all the big providers, right? And that becomes interesting when you think about your thesis. Because if this is actually bottlenecked, then what is the actual potential when it gets released? And the truth is, all these bottlenecks are actually starting to lift now because they become very obvious from the start. What's been interesting is what the LLM companies have done is they've actually gone and built software in that time with these bottlenecks. They've gone and added a software layer to all their various models, which is why we've got all the things like reasoning, deep research, and now obviously they're building in the agentic solutions, utilizing their software skills as actually part of that. So that becomes interesting for what we get as business owners and as consumers of this technology going forward. Now, the interesting thing when they did the research on this, the convergence, and I'll show you a graph in a second, what this looks like from a history standpoint, and then also what it's likely to unfold over the next few years, is that the convergence of these 3 technologies are likely to have a significant increase on GDP. And in fact, they already are, right? And the combination of the convergence of AI, robotics, blockchain, and energy storage are playing a significant role in that right now. And then the next layer, and something that I've been fascinated about, is obviously the release of AI agents, and then the focus around agent-to-agent payments. Because if you can imagine it, right now, there's no banking infrastructure that actually integrates with AI agents. And so if you think about it, because obviously, typically there's a human in the loop when it comes to it from a payment perspective. But now their protocols are being set from Google. They're being interrelated with the Ethereum Foundation and also with Coinbase, et cetera, where they're now actually starting to facilitate what those agent-to-agent payments look like, which creates a whole nother economy on top of itself and also probably changes the way in which online payments are done going forward. And so what this ultimately means is that from an ecosystem perspective, from an innovation perspective, from an investment perspective, from a business perspective, we all need to start thinking differently about what does the future of actual payments look like? What does our future product builds look like? When we're building websites, are we building them for humans, or are we also going to be building them for agents in the future? And that becomes an interesting thought process for how we think about building our companies going forward. And so the history always provides some really good lessons. And the great work, again, this is from the ARK Investor. It's like a 100-page report that they put out. But this one really caught my attention. And they talked about how, obviously the role that sort of agriculture played in sort of the GDP growth, previously. But what's really interesting is the second industrial revolution, which was at the same time 3 different technologies sort of converging with obviously electricity, automobiles, and the phone, basically helped break through on the GDP side to go from where it was at 0.6% growth to 3% growth, which has become the standard now, which everyone has been focused on. This next stage is the expectation that GDP growth will move towards 7% growth. And that's incredible when you think about the size of the economies now, the size of how big the global economy is, how much that changes for everyone involved in it, both from a business perspective, an investment perspective, a personal income perspective. And so it brings you to the question of how big will the biggest company be in 10 years? At the end of 2015, Apple was worth $586 billion. At the end of 2025, Nvidia was worth nearly $5 trillion, $4.8 trillion. That is incredible progress. And you can see most of those gains actually took place really in the last few years. So it really starts to make you think, if we're looking forward, if we're hosting an Emergence conference in 2035, And if I put up this slide, what is the value of the largest market cap company at that time? So from an investor, again, from all those different perspectives I highlighted, how much value will be created in this next stage going forward? So for me, the trends that I'm focused on personally that I find super interesting, and it came from a podcast. It was basically a podcast with one of the team members at XAI, and he casually mentioned in that, and it was for the first time it had actually been talked about, that what they're working on internally in XAI is human emulators. And what they've done is they've basically looked at the way in which humans use a computer and then figured out how to create a digital human emulator. So if you think about how everyone's trying to build a robot that matches how humans typically operate, this is what they're doing on the digital front, right? And they're copying the keyboards, the mouse strokes, the way they engage between different browsers, etc. And with that, they're also plotting them on the org chart. So one of the team members got called to a meeting, and it turned out that meeting was actually with the AI, right? So he turned up to the desk and then figured out there was no one at that desk, and that meeting, he said, was called by an AI. And then you got things like OpenClaw. I started doing meetups about 2-3 weeks ago talking about what was happening with AI, and literally that had just launched. In 3 weeks' time, that has gone absolutely ballistic, where people are setting up their computers and letting OpenClaw go and act like an agent all day long for them. There's examples online of people being called by their computer to give them updates on what's going to be happening during that day. And this has grown so fast that OpenAI acquired them last week. So this random guy on basically open source and using Claude models built this, then got threatened by Claude, right? Because he first called it Claudebot, and then next minute he's been acquired by OpenAI. And so again, that is how fast this is moving. And personally, I've never seen anything move this fast as what AI is. And then you got things like Claude Cowork, where for me, as a bit of an experiment, I set up a project for it to do something that would normally take me probably 2 to 3 weeks to do. And I went to the gym and come back, and literally an entire project was done and 45 pages were produced for the execution of that project with all the components outlined, detailed, content written, etc. And that is unbelievable. And it really does shape what the human potential of what we can do with technology going forward changes. As I mentioned, the agent-to-agent payment rails, that is something that's not being talked about too much in sort of financial media. This is something that all of us should be looking at, whether it be for your portfolio companies, whether it be for yourself personally, or if you're building businesses, how people are going to pay you in the future is definitely going to change. And then the other one, at the end of last year, again, this wasn't even talked about 12 months ago. All of a sudden, out of nowhere, you've got all the big hyperscalers all talking about how they can get data centers in space. Every single one of them is frustrated with how long it takes to get permits, how long it takes to build data centers, all the different challenges they have to face around water, around energy, around approvals, around all that sort of stuff has become frustrating for them. And so now they're looking about how do they build data centers in space. And again, what's interesting about this is obviously it's going to be solar powered, and in space they've got 24-hour access to sunlight, right? So 24 hours of energy, non-stop, basically being able to feed it. And of course they can direct the signal from those data centers to Earth instantly. So that becomes interesting as far as, well, you think about, well, how does that make out for markets like uranium, where people are thinking about the future solution for energy is uranium? Well, nothing beats the power of the sun. So that, for me, I don't have an answer on that, but I think it's an interesting question to ask as far as what happens in markets going forward. And then the last part to that is seeing all these companies throw money at this now, whether it be obviously Elon's got a bit of a head start with all the different integrations of his companies, but you can see Google quickly following, you can see Amazon quickly following. Obviously, he's also launching rockets as well. And then also, all of those combined. There was no other. Microsoft is the other one. All of them are now focused on this because who do they have to get approval for in space? right? And interesting enough, SpaceX has actually put in a request, an approval request to the FCC to be able to launch 1 million satellites into space as part of this data center build out. So again, this is going to move faster and faster than we can all imagine. And then you got the physical. I've talked about the digital part, and then you got the physical AI, the robots, and mobility. How does that all change? Every single time I ask this question, it's always interesting. So in this room, who absolutely loves driving in traffic? No hands. All the things, if you think about all the things at home that you don't currently enjoy, or all the things that are out and about, the travel and so forth, they're all grey areas that become problems for physical AI to solve. And interesting enough, literally yesterday, they rolled out the first cybercab with no steering wheel, right, and no front passenger seat, right? Waymo's been operating for a long time already. But the interesting thing when you think about how does that change from a cost perspective is that right now, they think the cyber taxi will be able to do point-to-point transport at 25 cents per mile, right? Compared to a ride-sharing platform, which would be around about sort of $2.80. And for us driving our own cars, 80 cents. And what's even more interesting is they're also thinking about how to create business models where people can actually generate revenue from owning their cars. Waymo is already started to outperform in markets like San Francisco. They've already started to outperform Lyft. So that transformation's already happening. They're already taking away market share from Uber. And you'll likely see the same with Tesla, with their robo-taxi as well, who now have got unsupervised taxis running in, I forgot the state. Anyway, they've got, now I've got to remember it. In Austin, that's where they've got it running. Right, so that's already happening. And people always think, and I haven't got the data because it was literally released this morning, people always think, that's going to be too hard to get regulatory approval. Well, what do Tesla, what do Waymo have that most car operators don't have? They have the data to prove that basically cars as robots are safer than human drivers by a long way. And that's the data that's most important to regulators. Next one is decentralized compute. One of the things they also leaked in this podcast was he talked about how XAI have got in their minds the model for how you could convert your Tesla basically into a compute machine. So when you're not driving it, it can basically become effectively its own mini data center processing compute whilst it's just sitting in your driveway and you get paid for it. So if you think about that, owning a car in the future, you could actually send out your car to work as a taxi during the day, and then at nighttime, it could be working as a processor on the compute side, working for you. Again, it changes the whole economics of how we understand business right now. And then the next one is obviously the generalized robots is the biggest thing everyone's trying to solve. There's various versions of robots, whether it be in industrial, commercial, and the part that they're trying to solve the most is how do you replicate the human hand? And that's been one of the hardest ones. Interesting enough, Tesla announced that they're actually going to shut down 2 of their car models and transform that factory into a manufacturing site for their robot. And I can tell you, all of them are focused on how do you build the machine that makes the machine. And again, that changes everything from an economics perspective because that output doesn't stop. That output doesn't need days off. That output doesn't have sick days. So again, we all start thinking about how does that change our investment portfolio? How does that change our thesis? How does that change how do we build our businesses? And then also, how does it change our lifestyle? What are going to be the benefits of that? If we've all got more time for different things, how does that change our entertainment use, family time? All those different aspects that we're working incredibly hard, all of a sudden, that gray area of time doing things that we don't want to do becomes either productive or connective capacity. So the impact in AI in 2026, So first one, AI agents is going to absolutely dominate the conversation in every way, shape and form. This is all you're going to hear about, the combination of AI agents and human emulators. And in fact, recently we did an AI summit at the end of last year. We're also going to be looking to host a variation of that this year as well. But this, for every single business, it must be the absolute priority on how you can utilize agents across your business, right? And then also there's going to be lots of personal solutions, because whatever gets created for the business side also creates the personal side. How does that change, how we go about our day to day? Right now, you're already seeing the entry-level roles for companies is becoming one of the hardest roles, right? As far as, people coming out of university are absolutely finding it the hardest to get a job right now. The whole HR process has been transformed in the last 2 to 3 years. And then lastly, there's been a historic decoupling of growth and employment in the markets. And what does that look like? And I talked about this at the meetups, but I didn't show the chart, but this is the chart I was referring to. How fascinating is it that the amount of total job openings, literally from the day ChatGPT was launched on December 2022, started to decouple from the actual growth of the S&P 500. That is the first time in history there has been a decoupling of that growth and the employment opportunities available, right? And that is likely to continue for some time. Now, I know what innovation has taught us, that in the long run, it ultimately will create more jobs. I think it also creates a lot more businesses at the same time. I mentioned this 3 years ago, that there'll be an absolute explosion of people setting up businesses. Again, people coming out of university will have to think about how they approach their careers very differently to what we all did. So the next stage of AI acceleration, this has me fascinated, and it's already starting to take place. I mentioned this briefly yesterday, but science, maths, and materials breakthroughs are absolutely going to be compounding over the next couple of years. Infrastructure and energy is going to be the focus and the solving of it. And actually, we've got a company presenting tomorrow, 2 companies presenting tomorrow that are actually focused on that as an area from a technology perspective. And then also, it's been briefly talked about, but the expectation of the NVIDIA Vera Rubin, the reason why that's so significant is that basically it can deliver 5 times the inference speed of what's available right now at 10 times lower the cost. So again, if that's going to be the scenario, if that's the foundations for what people are working with from the end of 2026 and 2027 onwards, what are we going to be able to use, in our day-to-day lives? So really, to me, 2026 is the true unlock, right? Basically, it's like 2023 was like the revealing of AI and its potential. 2026 is the true unlock for what it can really do. There's one part that I forgot to mention with this. This is just my personal fascination. I'm fascinated about how AI helps us understand history. We're all right now focused on the future. I'm fascinated by how it helps us understand history, because I think we'll be discovering things that people may not, what we've learned today about history, there may be changes coming forward. All right, so venture capital trends. I'll go through this quickly, given I've only got 1 minute to talk. So AI and deep tech dominance, that's going to be the focus. Obviously, clean tech, climate tech, still going to be, and the reason for this is still so much government money going to this area. And whenever there's government money going to a space, the innovation follows, additional capital follows. So there's still going to be a massive amount of growth in that area. Health tech and biotech, I showed you, it's at the earliest stage. That probably has, you're looking at the $1 trillion unlock, and I talked about this in my presentation yesterday. That is probably one of the biggest opportunities in the market right now that sort of isn't talked about as much as what it should be. Cybersecurity is also going to be a massive issue. The reason I haven't set up an OpenClaw yet is I'm not technical enough to know how to set it up and not have my data at risk, because it can have access to all your API keys, your credit card details and everything, right? So for me personally, I'm out for setting that up right now. Fintech and B2B. Again, these markets have gone ballistic over the last sort of 1 year. Still, massive opportunities. Every single business is thinking about, and likewise, all the various verticals of those businesses thinking about how they can actually massively increase their productivity over the next 3 to 5 years. Global investment trends, from chatbots to atoms, if you think about from 2008, right, with cloud coming out sort of 2006, 2008 was all, from that point on, it was all focused on software, or the good portion of money was focused on software. Now the capital is focused on deep science and the harder areas, deep tech, life science, medical devices, the high conviction areas. The sovereign safe harbor. There was an example of a presentation yesterday. There's one of the companies presenting tomorrow in the energy space in the energy area is focused on how do you produce local solar panels at a cheaper cost than what you could buy from China. That's interesting. Genuine IP modes. And then obviously the genuine IP modes now sits at the core of what all investors are looking for. And then the bifurcation of venture capital, AI is still going to dominate the majority of capital going into the markets. The digital asset super cycle, the tokenization of everything is already taking place. BlackRock literally sent it out in their chairman's letter saying that this is going to be the focus. This is how we provide access to the globe. To the democratization of private assets is absolutely going to be part of that. And, tokenization of everything is key. I mentioned about the AI part. I mentioned about the sovereign part. The last one, and interestingly enough, we've got 2 companies at the conference sort of in this area, but stable coins will become the new SWIFT. There is already more transactions on stable coins than what transactions take place on MasterCard and Visa, right? This is one of the biggest areas. And the truth is, this could potentially look like what the future of banking is, right? When you think about the potential for stable coins. And this is why the banks have fought so hard against it over the last couple of years. Macroeconomic factors, interest rates, obviously the US has a whole bunch of debt that they need to refinance. That's why they're working so hard to actually bring in a new Fed chairman and bring down their interest rates. But also, with the expectation of that, there's an expectation of increased money going into the system, right? Because they do have to refinance so much debt. And that ultimately goes and benefits all fixed assets. And then the last one is that there's still, in private markets alone, there is still $2 trillion of capital sitting on the sidelines. If you combine private markets, money markets, and then also the listed markets, there's over $10 trillion of dry powder sitting on the sidelines right now. Those 3 factors come into play over the next few years. I said we experience one of the super cycle bull runs, that we haven't probably seen in our lifetimes, right? Outside of the COVID stimulus of $9 trillion. So there's for me, and then the last one I'll just mention about the US. Now, obviously, I'm not here to talk socially about the US. That's a whole other conversation. On the business front, there's various reports about it. Trump says it's 17 trillion. He may add some GST to that amount. Analysts say it's about $7 trillion. Either way, the negotiation of the inbound investment into the US over the next few years is significant. Whether it's 7 trillion or 17 trillion, that's an incredible amount of money. And now what's interesting about that is in the previous administration, it was less than $1 trillion across 4 years. The economic growth. Earlier this year, the Atlanta Fed come out and highlighted that in Q4, they basically said the growth was at 5.4% annualized. That is astonishing for the US economy. To think that they're growing at that much. Trueflation is showing that their inflation is under 1%, right? Actually, I should mention that in the next. So at the dawn of the $1 trillion IPO, so this year we will see our first $1 trillion IPOs, whether it be SpaceX, whether it be OpenAI. You've also got Anthropic lining up for an IPO, and then also Databricks as well. That, between those 4 companies, is the potential for $2.5 trillion of listings. That amount of capital in the ecosystem, in the markets, and the realization of wealth, and then the reinvestment of that wealth, is what we want to be thinking about sort of playing out over the next sort of 5 years. I'll skip that. And then obviously the deregulation part, that's been a big focus. Obviously that's not in Australia, that's in the US. There's been a massive surge of M&A, and there's also a different model for M&A now, where they're not actually acquiring the full company. They're basically doing an acqui-hire plus a licensing deal. That was how Grok, G-R-O-Q, was acquired by Nvidia, right? So instead of taking 2 to 3 years to get all the approvals and go through all the regulatory process, they were out to do this M&A deal within a month. Again, how does that change the way investment bankers think about deals? How does that change the way people build their companies to be acquired? And then the last one, I just mentioned it before about trueflation. Because the registered inflation, the CPI that people come out, it's all outdated data, right? And it's all, when you understand how it's done, it's incredibly manual how they get that data. Trueflation, which basically is built off 15 million daily pricing points, has the US inflation at just under 1%. So if you've got an economy that's growing at 5.4% and trueflation showing at less than 1%, again, that gives you a signal from a market's perspective that you can have growth and have deflation at the same time, right? And that's exactly what's been taking place, because of technology. And technology has proven itself over and over to do that. All right, so just last one for me, the latest results from our survey. I will go into more detail. I'm doing another keynote this afternoon. High conviction sectors, it's a big focus for investors, whether it be deep tech, life sciences, it's basically become a priority. The sweet spot seems to be seed and Series A between sort of 38% and 45%. And the nicest one for me to see was pre-IPO interest at 39%. Right, which is a good signal. Again, going back, we all want to have an open IPO market. Number one frustration, I'll talk about later, and then obviously the focus on private credit, yield and growth is sitting at that basically anywhere between that sort of 8 to 18% mark as far as what people are after, but 43% of interest from investors in yield and growth. So the convergence opportunity is exponential platform convergence, the accelerated infrastructure build out, and then obviously the capital bifurcation and the inflection points all in those data curves. So that's my sort of keynote. Now, as we move into the first presentations for today, the first thing I do is I want to say a big thank you to all our sponsors for Emergence 2026. Between CapitalHQ India, we're going to be announcing shortly about our next events that we're going to be doing in India. There's also going to be one in Qatar. We're also going to be hosting Emergence in Dubai as well. MTP Connect, obviously the work they've done with us has been incredible. We're very proud to have Invest HK here. I said they've got some great focus around a lot of those deep tech areas. AUDD, Flanders Investment and Trade, just outside. Again, big focus in the sort of life science, deep tech, and technology related areas. Valoop Australia, our partners OKX. I've got a great love of Kate and the team and the work that Kate, Praz, and the team do at OKX. If you really think they're the third, depending on what day, they're the second or third largest crypto trading platform. But really, if you go and have a look at their products that they're building out, they are well in that, they're well in that line of building out what could be the future of sort of finance and markets going forward as that tokenization of everything becomes more real. Valoop Australia, focused on succession part. Big thank you to them. I'm obviously been supportive and involved with those guys. There's a 400,000 companies that need to go through succession over the next decade. They're focused on helping employees go through that they're helping employee ownership as part of that transition. Rockinghurst, Swinburne. By the way, Swinburne said really happy to work with Abs and the team. They've got 4 companies that are being featured today. It's so brilliant to see a university that's so focused not only on research, but also on the commercialization. And they've brought to us today 4 incredible opportunities that I know, looking at their profiles, I know from an investor's perspective, I know you don't normally get the opportunity to see these types of deals. FC Capital, and then, the stock network for the support on the media side, very much appreciated. It takes an army to make all this stuff real for everyone. If you haven't accessed the Capital, all the agenda, all the companies are sitting inside CapitalHQ. I strongly recommend that you access that. You can also network with each other, so you can find people with like-minded interests as yourself, chat to each other throughout the day. Again, the high-value networking part, we built this to make it easier for you to find the opportunities that you're interested in, but also to connect with other investors that are here today. And then the last part that I'll mention for my presentation is the power of one conversation. The power of one conversation can change everything. I see it at every single event that we do. I've experienced it myself personally. So the biggest thing I always say is that whilst you may be here today, you may find something that is transformative for either your business, your investment portfolio, or it could help one of your companies, or it could make the significant difference to the company that you meet today. There's another part to that, is that in your networks, there's anywhere between 5 to 15 people that could also be relevant to a company that you're speaking to, because you all have your own investor networks. So if you see a company that's relevant to someone that you know, please do that introduction and make that connection, because that is how we build ecosystems. And one conversation today could become a network for a lifetime, and layers of value created in that time. I will be doing a further presentation today at 4:30 about the future of private markets and how we see it. So I hope you all join me for that. Now today I'm going to hand back over to Jay to host today. We have an incredible lineup for you. As I said, there's 12 life science and medtech companies. We've got some of the top private credit operators, presenting today as well. This is an absolute stacked day. We've got the Venture and Capital Investment Trends panel and the Private Credit Investment Trends panel as well. I hope you enjoy what is technically day 2 of Emergence 2026. Have a good day.
Thank you so much, Steve, for that insightful keynote. Good morning, everyone, and welcome to day 2 of Emergence 2026. We now move into our first rapid-fire presentation block. We have 6 companies ready to showcase their innovation. Our first presenter represents Longview, an institutional shared equity fund. They offer investors a unique way to gain exposure to residential property growth while maintaining the traditional risks associated with direct ownership. Please join me in welcoming Evan Thornley, CEO and co-founder of Longview.
Thanks very much. Very nostalgic for me, that opening address. I put the first Australian tech unicorn on NASDAQ 27 years ago. We took it to 14 billion in market cap, which was proper money in those days. So all of those investments have massive returns, and all of them have massive risks. I guarantee there's not one person in this audience who will understand all the stuff that gets presented today, let alone the stuff that will arrive 3 months from now. So I want you to think about what's the best investment you've ever made. Not the best bet, the one that came home, forgetting the other 9 that didn't. What's the best investment, risk-adjusted, that you have ever made? And I'll make a bold assertion. For at least half the people in the room, the answer is fairly pedestrian. It was your family home. If you bought one of the roughly half the family homes in Sydney, Melbourne or Brisbane that doubled in value every 10 years, you put down a 20% deposit, you took 80% from the bank, so you're on 5x leverage on your equity. The thing doubles in 10 years, so that's 7% returns every year. With 5x leverage, that's a 35% return on equity, tax-free. So risk-adjusted, if that's not the best investment that many of you have made, you either bought the wrong home or something else went wrong. So the question is, how do you liberate the power of that risk-return profile in a more scalable and institutional form and take away the remaining risks? That's the problem we've been solving. Longview's an 11-year-old company. We've got 120 residential property professionals and data scientists. We've bought over 3,000 homes for clients. We manage over 4,000 rental properties. Our data science team's analysed every sale price of every individual home in the country for the last 50 years. This is what we do. There are more crypto funds in Australia than there are residential property funds. Why? It's the biggest asset class in the country by the length of the straight. We've been trying to answer that question for 11 years, and I think we've understood the answer and engineered around the problems. So let me quickly explain the investment thesis. It's not complicated. Australia is close to the best capital growth market in the world. The capital growth on Australia's existing homes this year and pretty much every other year, just the capital growth, not the underlying $12 trillion of value, just the capital growth, just this year, will be bigger than the federal government's budget. 5 times the size of all the earnings of every company on the ASX combined. So the biggest wealth generation in this country, this should not be a surprise to most of you, is in people's family homes by the length of the straight. And yet there is no way to participate in that except either buying your own home or being a landlord of a couple of things and hoping for the best. That makes no sense. So we've created a fund that allows you to tap into that wealth engine in a low-risk, diversified way. All boats do not rise at the same time. Everyone talks about the property market's doing this, the property market's doing that. If you can only get on the property ladder, everything will be great. It's just not true. There's a wide diversity of capital growth in Australia's homes. Roughly 1/6 of all the homes in Australia delivered more than half the capital growth over the last 40 years. Those are what we call the Rodwells of Sydney, Melbourne and Brisbane. The family homes that many of you either live in now or grew up in or both. Robust, older dwellings on well-located land. It's not complicated. Land appreciates, buildings depreciate, well-located land appreciates faster. It's a fairly simple formula. So how do you liberate the value from those homes? Well, here's your problem and your opportunity. Most of them are owner-occupied, so you can't buy them as a landlord. You wouldn't want to anyway. All that cost, tax, hassle, lack of diversification, negative cash flow. Trust me, I manage 4,000 rental properties. You don't want to do that. What you want to do is co-invest with the owners of those homes. And it turns out that a large number of those people, particularly in their 50s, pre-downsizers, are asset-rich and cash-poor. Their incomes are declining, their home values are skyrocketing. There is an obvious solution. Tap into their home equity to meet the other financial needs they have, whether that's investing in their business, being bank of mum and dad for their kids, renovating the home, all sorts of other things, getting through divorce or medical emergencies, etc. So if you give people access to equity in their home, they will give you a free ride on their capital growth. That's what HomeFlex does. So a typical deal is, say, on a $2 million family home, we offer our client 10% of the value of that home, a cheque for $200,000, no interest, no risk of ever being thrown out of your home, no monthly payments, no compounding, no nothing. Friendliest money they'll ever see. And they give us, in return, a 1/3 share of their future upside, just the capital growth. But assuming that home does well or better than the market average, then it doubles in value in 10 years, and the $200,000 investment we make is worth $867,000. That's HomeFlex. That's how we do it. We now have 158 homes across Sydney, Melbourne and Brisbane. These are some of them. They look like the family home you own or you grew up in. There's probably not a gag in our kitchen amongst them because we invest in appreciating assets, not depreciating assets. The critical factor is 81% of the value of those homes is the value of the land underneath the homes. And they're in spectacularly good locations. So that's how it works. We're diversified across price points and markets. I was here 12 months ago and a number of you kind people took a bet on what we were doing in its early stages and stuck with us. I'm happy to report that those who did got a 16% return on their money over that time period, slightly more than double the house price average in Australia, on remarkably low risk. We have no debt. So we've got leverage without debt. We get the uptick, a multiplier against the capital growth. If the house goes up 5%, our contract goes up 16.5%. We have leverage without debt. None of the cost and risk of debt, unlike if you tried to do it yourself. And we have land without land tax. There is no other way of investing in residential property in Australia without paying land tax, even in the Democratic People's Republic of Victoria, from whence I hail. So that's what we do. There's really only one problem with the Longview Home Equity Fund for those of you who would like to park a decent portion of your portfolio in something with this remarkably asymmetric risk-return profile. You can't get in. We just closed Fund 1, about $50 million in it. We're in now actually 170 properties. We'll have about 220 when we deploy the final parts of the capital. We won't be opening Fund 2 until the end of this quarter, early next quarter. So we are taking people on our waiting list. We've made a few changes in Fund 2 that weren't in Fund 1. You will have access to quarterly liquidity. It will be an open-ended fund. We'll have at least 2.5% liquidity available every quarter. So if you want to invest in the best risk-adjusted investment you can make in a diversified portfolio of family homes, my colleagues Matt Newham and Harry Herzog will be at the Longview stand all day today. We look forward to putting you on our waiting list. Thanks very much.
Thanks, Evan. We all know that choosing the right agent can be a minefield of biased reviews and pay-to-play rankings. Sell Now changes the game by using AI and real performance data to match you with a perfect property expert, whether you are buying, selling, or investing. To tell us more about their innovative platform, please welcome the founder of Sell Now, Daniel Hayward, and co-founder Andrew Grace.
Thank you everyone for being here today. I'm Dan Hayward, the co-founder of Sell Now, and joining today is Andrew Grace, my co-founder and chair. Sell Now is a sophisticated AI platform that is set to change the way property is done in Australia. In short, we've built today's... In short, we've built a Sell Now combination of PropTech, FinTech, SaaS, AI, all in one. For the past 30 years, the property industry has been dominated by the real estate giants that spend $2 billion a year playing for placement over actual real data. I'd firstly like to, property sellers and vendors incur an average loss in property of around $83,000. For the last 30 years, it's been biased, pay-to-play models. We're non-biased, non-pay-to-play. The buyers mislead vendors and can't find the best agents. Google reviews can be easily manipulated. We're a merit-based agent performance platform working with blockchain verified data and have 4 AI engines that work seamlessly together. Next one.
So let's talk about our team. We have, Dan and I, Dan's worked for a long time in lead generation, which is where this business originated, and I've come from a family office and worked in mainly governance and board positions and so forth, and invested in this business when Dan presented to me some time ago the opportunity with his lead generation expertise in the finance industry. So we learnt our trade there, and then we've seen the opportunity in the real estate industry. So we've been actively seeking the team, and we've had a very successful opportunity with Mark Hand, who was the not the CEO, but he was the 2IC at ANZ and the Group Executive of Australian Retail Banking. And he's currently now advising a number of boards, including Great Southern Bank, as the chair. And he's also sitting on the boards of a number of tech companies focused on property and real estate, particularly in the mortgage area, which is where he's got his expertise. So that's synergistic with our platform, and we think Mark will. Well, he's seasoned. He can deliver, and he's done this numerous times. So we're very excited to have him on board. Jeremy Cabral, who co-founded Finder, he built that and took it to 20 countries and has exited from the company and now is actively advising tech companies. He's assessed our opportunity here, and he's felt confident to come on board and guide us with our strategic tech strategy. Jeanette Kendall, a seasoned ASX director, non-executive director, and is FAI CD. the Australian Institute of Company Directors. She's very excited about the opportunities. And again, when we've chosen these people, or we've had the opportunity to present to these people, they've taken the time to do their due diligence and really read through the corporate information statement that we put together, the long-form corporate information statement, and really understand why we're feeling that we can disrupt the market, and we have a platform that will be fast expanding, as Dan explains, the technology that we've implemented behind it. Cam Senig's at BDO, he's a partner there. He's dealing with our accounting and our corporate structure. Mike Jeffrey at Sierra Law, and we don't have him on here, but George Hoa at Intention Experts, who is also using a lot of data to drive marketing and sales. So we'll just pass that on. Back to Dan.
So our 4 AI engines, Isabella, Betty, Hannah, and Liz, match vendors with the right agent based on over 50 data points. Betty acts as a compliance engine that as you've probably all seen lately, Current Affair and all these other locations, the industry's being roofinized right now. It's being smashed by agents doing the wrong thing or being cowboys in the industry. Our system gets rid of that. Betty sits in the background watching, making sure all the promises are met, etc. Hannah works as an omni-channel marketing and lead generation engine for the platform as well as for the agents, so they can use tools, etc., to access more leads and vendors looking to sell, buy, or invest. Liz is a customer service bot working 24/7. You can go onto the platform, ask questions, or get any answer as a vendor, a buyer, or an investor. It's all backed by blockchain. So with reviews, ratings, the sell now score, it's one of the big things. Think of like an Uber rating. It's kind of very similar for the real estate industry. So based on promises they make, or things that they do, everything's ledgered. So if they say that they can get 95 or say 1.95 million for your property and they only achieve $1 million, it's all ledgered. The algorithm only matches the agents that continue to do the right thing by the vendors, buyers, or investors. It doesn't also just work with the agents. We also have a Sell Now Finance brand, insurance, and conveyancing. So we offer all these products and solutions to the homeowners, vendors, or investors to be able to give them better solutions at a market cheap rate. Here we go.
Okay. The market opportunity. The real estate services annual real estate services is running at about $31 billion, and of that, $12.65 billion is commissions from sales of properties. And on our projections, if we are able to achieve them, then we're looking at a 2% market share that will deliver over the 3-year period, and that will deliver us a $250 million projected year 3 revenue. Now, I'll break that down. We haven't based it on on just taking a guess at 2% of the market. We've done it on the basis of the cost per lead of just social media market advertising. So we've been doing that in the finance industry, and we've now addressed it in the real estate market. And we can assess that the cost per lead is between $10 and $65, and at $30 cost per lead, which then becomes, it takes about an 8% lead to turn into a listing. We're looking at that ratio, which is between the market of about 6% up to, at the best, 15 to 20% conversion rate. So we've taken an 8%, and if we do that, and we're able to achieve 100 listings per day, that gives us a projected revenue of $250 million per year. The revenue is based on a commission share with the agent. It's 25% of the agent's commission share, so we're not taking anything up front. And just want to go back to generating, the essence of the business is capturing from the lead, the vendor wanting to sell their property. As so many vendors have experienced, that they're not having their expectations met, and so they're disgruntled. So what we're doing is giving them the opportunity to use data-driven decision making to help them choose the best agent. So the AI will process the agent, the best, most suitable agent for their particular property, giving them almost a niche agent for what they have to sell. Now, if you're selling your most valuable asset, as we just heard from the previous presenter, you certainly want to be able to do as much due diligence as you would for your investments or otherwise. However, we're time poor and we can't access that data necessarily. It's quite expensive and it's just a lot to go through to look at the performance of an agent or all the agents in your market area that can actually do that for you. So we're doing that for the vendor, we're capturing that customer, giving it to them at no cost, and we're leading them on the journey through the property process, through that. So the platform as an ecosystem will then allow that customer to look at the opportunity to then, after they've sold their property, perhaps use the conveyancing offers that we've got on the platform, or the after the recommendation of the agent, the conveyancing. Oh, sorry, the time's up. I've got to run off onto the actual model. We can then assess the other opportunities with the multiple revenue streams down that line of the property journey. So that allows us to then take commissions from the seller now becoming a buyer after they've sold their property, potentially finance and insurance, and another of the other services that are involved. Sorry. We've got the first mover opportunity here. We've got blockchain-backed trust, so it's very difficult to fake. The AI engines obviously scale without human intervention. We've got a lifetime ecosystem lock-in with this platform and multiple touch community across the property journey. I'm just reading off it because our time's up. So the investment, it's a 10 million raise, 40 million pre-money with 20% equity, 100K for minimum for the first 5 investors and 250 after. We're closing at 10 million or 40 investors, whichever comes first. That's it. We've got a quick video and we're done. Thank you.
Every year, the Australian property market moves $500 billion through what is essentially a black box. It's an industry built on information asymmetry, where vendors pay for hope instead of results. This pay-to-play model is ripe for disruption because it's designed to protect the mediocre agent at the expense of the homeowner. Sell Now isn't another listing portal. It is the first AI-driven accountability layer for real estate. We've deployed 4 autonomous AI engines that don't just show data, they audit performance by anchoring every transaction to a blockchain. We've created an immutable record of truth, making it impossible for bad actors to fake a track record ever again. The Sell Now platform and business model is designed to provide agility in the marketplace and thereby exploit our first mover advantage over established players. The Sell Now ecosystem triggers a flight to quality across a multifaceted platform. Our AI technology filters the noise to attract high performers, while our blockchain secures the only verified history of agent performance in the country. The market response has been immediate. With $2.2 billion in listings and over 700 industry professionals onboarded in just 30 days, we are already capturing the data that will define the next decade of Australian property. But this isn't just about a single sale. By capturing the vendor at the point of highest intent, we own the entry point for every subsequent life event, from finance to future trades. We aren't just changing the transaction, we are building an entire ecosystem that inherently promotes repetitive transactions. Talk to us today.
Thanks a lot. Thank you.
Thanks, Daniel and Andrew, and that's Sell Now. Next, we have Sharp Bridge Funds Management, a global equities fund dedicated to driving sustainable outperformance through rigorous research and strategic diversification. To tell us more, please welcome their portfolio manager, Jared Stewart.
Good morning. My name's Jared Stewart from Sharpbridge Funds Management. Today, I will introduce you to the Sharpbridge Global Equities Fund. Please read our disclaimer on screen. About us, we founded Sharpbridge Funds Management to deliver first-class investment performance in global equities. Our group has a mortgage broking and financial planning business to deliver us a platform for growth. We launched our Sharpbridge Global Equities Fund on the 1st of April 2025. Since inception, the fund has returned 77.68% net of fees with no down months. The fund is a long-only, 90 to 100% long global stocks and holds up to 10% cash at any time. We have done this with no leverage, no hedging, no derivatives, and no shorting. Our custodian is Sandhurst Trustees and fund administrator is William Buck. Turning to our investment team, I'm the founder and co-portfolio manager of the business. I hold a Bachelor of Commerce and Economics from UQ, as well as a Masters of Applied Finance. Previously, I worked as a senior manager at Colonial First State, CBA, Suncorp, and EY. My business partner, co-founder, and co-portfolio manager is Nick Chant. He has extensive experience in Treasury FX markets at BOQ. Nick holds a Bachelor of Commerce and an RG 146 and is an AFMA member. To the fund now, it's a high conviction portfolio of global stocks. We hold around 20 companies at any time. We're a bottom-up fundamental research manager and we buy businesses that have sound balance sheets, that have a strong growth prospects and are undervalued by the market. We believe the strategy will outperform the MSCI Global World Index across a full market cycle. Talking to our investment process, we start with 10,000 plus listed companies and we filter those down using our 7-factor framework. The factors we use are valuation, director ownership, business quality, balance sheet strength, corporate governance, analyst coverage, and market catalysts. This whittles us down to a short list of 50 stocks where we manually review this list weekly and focus on earnings results upcoming, insider activity, corporate actions, and market catalysts. Finally, we select a 20 to 30 stock portfolio based on our conviction of a stock to deliver, considering both upside and downside risks. The majority of the companies we look for are in the $1 to $30 billion range, US. They're big enough to be real, but small enough to be inefficiently priced. What do we buy? We hold positions 2 to 3%, which is a typical low position and an opportunistic trade for us, 5% medium conviction, and 7 to 10% high conviction, where a strong catalyst is playing out. We cap our exposures at 10% to minimise risk and limit exposure. In terms of selling a stock, we sell when it hits our valuation target, when a catalyst is no longer present, or the ranking from the 7 factors we discussed earlier deteriorates significantly. I'll add here, we also hold for around 2 to 3 years any one position. So we actually run it as a black box and don't discuss the individual company names to protect the fund's IP and our client returns. However, I'll go through some examples. First stock is a European-listed car supply manufacturer. They have long-term relationships with major car manufacturers, $20 billion of recurring stable revenue. Margin expansion plays is a key theme here, with EBIT margins likely to double to triple over the medium term as a cost-out play. The cost-out story, with 10% of the workforce being rationalised by the end of this year, with a very strong balance sheet of $1.5 billion net cash and an undrawn debt facility of $2.5 billion, total market capitalisation around $4 billion. Management and key personnel alignment is key, with a stock incentive program to encourage their execution, and the valuation for this $4 billion business is 10 times. So we like it. Stock example number 2 is an American data center developer. This is a picks and shovels play in this hot sector. It has a strong and growing order book of work. Key upside here, where further infrastructure requirements are playing out to develop AI sector. There's strong growth market here with the US data and power center power needs expanding, as Steve mentioned earlier this morning, and also has an incentivised and aligned management team. The near-term catalyst is consistent delivering on their earnings. Throughout 2025, they underguided conservatively, and we expect the upcoming catalyst where they report for the full year, they'll outperform again. The valuation of this is a PE of 10 times. And thirdly, we've got a leading European defence contractor. When Trump was elected, he announced to the world that Europe would need to defend themselves more so. And this company, more than half of their revenue comes from European defence contracts. They have a strong and growing order book with a robust balance sheet and are positioned for growth. Catalysts are continuing to receive new contract wins from increased government defence expenditure, and the valuation here is 22 times. Turning to the future market outlook and our performance, we see 3 key themes that are likely to impact markets in 2026. 1, AI and technology stocks are expensive, and we expect further volatility, although there are some opportunities in this sector. Secondly, European defence stocks are benefiting from a Trump play. And thirdly, US equities are likely to underperform European equities, contrary to last year. Our global equities fund has returned more than 77% from stock picking, net of fees, with no down months to date. And we look forward to seeing you afterwards. Thank you.
Thank you, Jared. Our next presentation is from One Key Resources, a leading provider of managed workforces and labor hire solutions. They support the mining, energy and resources, and civil infrastructure sectors on a national scale. Please welcome its Managing Director, Ben Lewis.
Thank you. Thanks to everyone for coming. So a little bit of a step change here away from AI, tech and finance, and a little bit more on the operational side of things on how some of these things are going to get built. So Australia has a widely recognised workforce problem, and it's a structural problem, not a cyclical one. Capital alone won't solve it, only labour availability will. One Key is already has a proven delivery engine in place, and what we're doing is scaling that missing labour supply for the infrastructure and the industry that is going to rely on over the next decade. This raise is about completing that transition, not starting from scratch. Typical disclosure slide. As I said, Australia is facing deep workforce shortages across trades, operators, essential operational roles, particularly in regional markets. This isn't a short-term cycle, it's at least a decade-long constraint. It's now become the limiting factor across energy infrastructure, resources and industrial development. Domestic labour supply alone can't solve the problem, which is why workforce solutions in this space need to evolve. Sorry, that didn't work. So why One Key? So One Key's got over 15 years of operational history as a trusted workforce partner to Tier 1 industries across Australia. We've got a database in excess of 350,000 candidates built over 15 years, not a bought database. We operate a national platform with deep regional capability, regularly mobilising large workforces in those labour-constrained environments. This isn't a concept business, it's a proven platform with the ability to scale. Some of our clients that we work with currently are obviously delivering national critical projects. Our role is often embedded within their operations where the failure of their labour workforce isn't an option. This slide demonstrates the client trust, repeatability and long-term client relationships that we hold with Tier 1 clients across Australia. So this is the inflection point for our business. We were built as a workforce partner to mining and resources and delivered labour hire and managed workforce solutions across regional Australia. Today though, workforce shortages extend well beyond mining, with infrastructure, energy, industrial and regional developments all constrained by labour, not capital. Following a successful restructure in 24, we're deliberately transforming into a total workforce solutions platform, with skilled migration as a core lever in that supply chain. We're not raising to grow, we're raising to complete a transition that's already underway, with skilled worker inflows for regional, project critical roles as the core focus. This section covers the structure and the funding at a high level. I'll keep it brief, focusing on intent today rather than the specific details, but happy to discuss that with anyone afterwards. As I said, staying high level here, the strategic use of the capital matters more than the mechanics in this slide. But we're seeking up to a 40% equity position with a minimum of 15% at closing. The stage structure is intentional and aligns capital development with the execution milestones. The primary use of capital is to establish and scale the skilled migration capability, which we see as the core labour supply for infrastructure and underpinning the future business. There's also optional flexibility with the right investor to deploy additional capital towards a complementary RTO acquisition, a registered training organisation. That's not a second strategy, it's an accelerator that vertically integrates our training and migration outcomes and pulls forward the value creation rather than a change in direction. Our focus remains singular here, and that is building scalable skilled worker inflows for regional and project critical roles. Everything else supports that objective. The group structure is intentionally simple. It's deliberate to separate risk management and operational clarity and enables the platform to scale. The resources business, including the talent business, sits at the core operations at this stage, but the industrial and international businesses are standalone JVs which have been structured to enable strategic partners to be actively involved, yet they operate independently while sharing a single governance and compliance framework and a back-of-house engine. I won't go into detail here. This is available on our portal, but the key point here is that this executive team is execution focused. Okay, we've got experience in scaling workforce businesses in complex and highly regulated environments, and the operational delivery, commercial discipline and embedded legal and migration capabilities are all internal strengths. The team is built to execute, not theorise. This slide obviously shows the gross profit expansion over the forecast period, and the growth is driven by diversification of services, improved margin mix and increased contribution from skilled migration. The key takeaway here is the operating leverage, not the individual year-by-year numbers. This illustrates expected earnings as a trajectory as the platform matures, and as skilled migration and other services scale, the EBITDA conversion becomes more efficient, diversified and resilient. The focus here is the shape of the curve rather than the absolute forecasts, but obviously demonstrates the economies of scale as we grow. This is a graphic here, shows how the contribution to EBITDA will grow and the earnings broaden over time. You can see no single vertical dominates in the latter years, which reduces the cyclicality and the client concentration risk. Diversification is deliberate and reflective of the market needs and central to the investment thesis. As the platform scales, there are a number of multiple exit pathways for investors. These include strategic acquisition, private equity recapitalisation or structured liquidity events. And exit timing is driven by value creation and platform maturity, not fixed timelines. This raise offers investors the opportunity to participate at a clear inflection point of the business. And what matters here is that we're building something strategic that buyers already struggle to replicate. Conscious of time, why the demand for our services is expanding is that skilled shortages are persistent and structural across all industries. Compliance and governance expectations are only increasing, and clients are considering suppliers and favouring fewer, broader workforce partners. Regional delivery is increasingly policy-driven, and all of these forces point towards integrated workforce solutions at scale for a regional market. The future state, the skilled migration is the anchor and the core of the platform. Everything else supports that supply, governance and efficiency, and it is a system, not a collection of unrelated different initiatives. The capital deployment priorities, the majority of new capital is directed towards scaling that skilled migration vertical and the key worker inflow. Managed services and technology enable the efficiency and the governance across the platform. And as I mentioned before, any M&A activity that comes in the future is selective and only pursued where it accelerates the core strategy. So in closing, one key, as I said, is building the workforce infrastructure in Australia that the energy infrastructure and regional areas are going to rely on. This capital raise offers investors the opportunity to participate at the inflection point of a proven platform's next phase of growth. Thank you very much. Happy to take any questions next door.
Thanks, Ben. Moving forward, we have Palace Capital, a leading partner to sophisticated investors. They specialize in delivering secured real estate debt opportunities designed to provide superior returns. Please join me in welcoming Paul Van Soylen, partner in distribution at Palace Capital.
Thanks, everyone. Over the course of this presentation, I'd like to give you an overview of the Palace Group, our journey over the past 10 years to where we are today, where we sit in this ever-growing private credit asset class, as well as a summary of our various opportunities for investors. So the Palace Group was established in 2016, so we've been around 10 years now. We have two distinct parts to the business. There's Palace Capital, which is the non-bank lending and investment arm of the business, and then we have Fortis. So Fortis are a respected property development manager, and they have a strong focus on luxury residential apartments and boutique commercial office buildings in the city fringes around Melbourne, Sydney and Brisbane. Now, this strategic relationship between Palace Capital and Fortis provides huge strategic advantages for the Palace Group, namely when we're looking to write loans in those areas, getting insights from a respected property development manager like Fortis is just invaluable. So this slide outlines Palace's key competitive advantages. It represents our DNA and why we have an advantage over other non-bank lenders in the commercial real estate debt space. Firstly, we're a specialist manager, so we specialise in commercial real estate debt. So we're not lending against other asset classes, it's purely commercial office buildings, residential apartments and the like.
We also enjoy institutional support. So the likes of Goldman Sachs, Westpac New Zealand and Ares, they provide funding to Palace as well. So that has the advantage of providing lower cost of capital for us, but it also provides our high net worth investors comfort that those large institutions have done their due diligence on Palace and are comfortable with our processes and our compliance and the types of loans that we're writing. Additionally, we have a leading investment team. So Palace Group has over 200 staff, 30 plus of those are in credit alone. So the credit team are responsible for the upfront due diligence on every loan that we write, but also the ongoing due diligence on each loan too, to ensure that borrowers are paying on time, the construction is tracking as it should be. So that's a very important piece and a large engine room behind Palace. And then, as I touched on before, having that unique developers lens with the Fortis relationship is really important to us as well. So this slide tells a great story of Palace's growth over the past 10 years. As you see from the number in the middle, we recently surpassed $9 billion of lending and investments for our investors to take up. In that time, we've repaid $5.5 billion back to investors, and we currently have $3.7 billion of open and performing loans. In that time, we've paid out $620 million of interest to our investor base. But most importantly, we have that number in the top right-hand corner, which is the zero loss of capital or impairments on any interest payments. So when you consider that we've written 1,200 plus loans and $9 billion of lending over 10 years, that's quite a feat and something we're very proud of and intend to continue into the future. And it speaks largely to that strong engine room of the credit team. So where does Palace sit in the ever-growing private lending or private credit asset class? We're in that mid-market space. So that gold bar in the middle there, the typical loan size that we write is anywhere from $5 to $50 million, with an average loan size of around $9 million. We're very comfortable in that mid-market space. There's a good secondary market there, so if there is a loan that is distressed for whatever reason, there's a strong secondary market there that'll refinance those loans out. We're happy to leave those larger 50 million plus loans to the likes of Goldman Sachs. It's not the space that we're looking to play in. And similarly in the small loan space, the sub $3 million, it's a very competitive area and also less experienced borrowers or sponsors. Why do investors look to private credit? I guess the number one reason is the lack of volatility in play there. So when you look at the gold bar in the middle there, that's a typical first mortgage paying returns of around 10% per annum. As you can see, it's very flat. You're insulated from those highs and lows that other asset classes represent. So when it comes to investing with Palace Capital, investors have the opportunity to either invest in diversified funds or into specific single loan investment opportunities. We offer investment opportunities across the entire capital stack, so from conservative first mortgage opportunities through to mezzanine debt and right through to preference equity deals through our relationship with Fortis. Just looking at these diversified funds, we have four funds there. The first two are first mortgage funds. So all the loans within those funds are only leveraged up to a loan to value ratio of 65%. The difference between the short-term fund and the warehouse fund is just the redemption notice period. One is 3 months and the other is 12 months. And then those that are looking for higher yields, we have the high yield fund number 2 and high yield number 3. High yield number 2 holds a mix of first and second mortgages, whereas the high yield fund 3 holds preference equity opportunities through the Fortis relationship. As I touched on, for those that wanting to invest in a specific loan in a specific suburb within Australia, we can offer those opportunities as well. And right as that present slide shows, anywhere from first mortgages through to mezzanine and then through to preference equity as well. Finally, I'll just leave you with an example of a typical first mortgage that you could expect to see with Palace Capital. In this example, it's a Manly-based first mortgage loan. Got the typical LVR there of 65%. Almost all of our investments have a fixed component with a floating bank bill swap rate on top of that. So in this case, 6.5% fixed plus the bank bill swap rate, which is 3.7. So you're getting over 10.2% in that type of first mortgage loan. So thanks very much for your time. If you'd like to discuss any of what I've discussed today, please come and see me over at my booth. Thank you.
Thanks, Paul. Joining us next is Deltine Capital. They manage a high-yield motel portfolio that targets over 20% annual returns by focusing on diversification, stability, and full transparency. Please welcome their CEO, David Toomey.
Welcome everybody, and thanks very much for coming. It's great to be back. It's excellent for us to come back and keep our investors up to date with our progress. Speak to you again. Thanks very much for your time. Deltine Motel Fund, it does what it says on the box. We're a commercial property fund that is consolidating the motel market in Australia. The target fund size is a 500 million, and we're on track to get that. We've started last year. We've got 4 assets in the portfolio, another 4 in the pipeline, and our target is to buy 10 assets a year for the next 5 years to consolidate this market. The motel sector is highly fragmented. Unlike pubs and storage and childcare, which have all been consolidated, and many of those industries have holders and owners that have between 7 and 10, 15% of the market, whereas in the motel market, no one owns more than 1% of the market. Extremely fragmented, so a lot of independent operators without the skills, the resources and the capability to really drive operational improvement and scale. So we target 20% per annum total returns. So yes, I know that's a big number, so let's unpack that a little bit because we have got assets in the portfolio and we are on track. So half of that return is income yield, so we pay over 10% per annum in income yield from the earnings of these motels. We target 4-star profitable motels, established motels that are generating a lot of cash, and as you can see from our track record, we've been paying monthly a distribution equivalent to 10.5% per annum. So that's half of the 20%. So let's have a look at the other half of the 20% is of course capital growth that you get at the end of the 5-year term when we exit the entire portfolio. So the balance of the 20%, the first being the income portion, the balance comes from the operational upside that we get, which obviously transfers into the increase in value of the property. Inflation over the 5 years gives capital uplift, and then at the end when we've built an institutional grade portfolio of 50 assets where we've got diversity, we've got size and scale, we can then sell that lower grade portfolio at, the lower risk portfolio at a higher price. So you can see the assets we have in the portfolio here, they're all on track in terms of the acquisition yields are 11%, so I tick in that box. The forecast yields, so as the prices rise and the income rises and we get the operational improvement, we get more income. So the average is between 12 and 13% per annum for the 5-year period, which brings the forecast return with the capital growth into the mid-20s for each asset. So a couple of the assets we've got in the portfolio, this is an example of a really nice service apartments we have in Tamworth. Purchased that for 11% acquisition yield. It's forecast total return of 23.5%. The other one is, other example is the one we're closing in the next six weeks. 44 room, $20 million property in Ipswich. That growth corridor where this is located. The population growth of that area is 6 times the national average. So Southeast Queensland, a really strong, growing, bustling corridor with power stations nearby, the Amberley Air Force Base, etc. So let's take a step back for a minute. Why motels? Well, I think you've started to get a bit of a feel for it. We're looking for quality 4-star buildings. So what do you see when you go into a regional town, and on the main strip in the centre of town is a motel. So great buildings at great location. We're looking at buildings and we're looking at motels with a track record of profitable operations. we can get these assets for over a 10% yield. There's upside available, and of course we can get the diversity through the regions, through the locations, and through the local economies. So there's a lot to like about this sector. So just quickly again to reiterate, the investment strategy is to acquire 10 a year for 5 years. We get the operational improvements through the revenue management and cost management that we can get by having a centralised team instead of being an independent operator. And then once we put an institutional grade portfolio together, we can get that yield compression at the end and therefore the uplift. Now that's all nice, but what about downside protection? Well, that's our number one priority, and we've structured the fund specifically to have capital preservation. So of course it's a property-backed fund. A lot of the value of these properties is the land and the buildings which we're buying. The LVR we're setting is low. We're conscious that these are targeted, this fund is targeted towards semi-retirement, retirement, super fund style investors that require capital preservation. So we've kept those debt levels low. As I said, we can get that diversification. We're looking at resilient operations with a track record of repeat customers. We have really good governance, and we also excluding high-risk properties like turnarounds and developments and pubs and clubs, things like that. The governance layer is very important to us. So as we've got a national accounting firm, Bentley's, it's a second-tier accounting firm that is our independent trustee. So it controls the holding trust level, it controls the bank accounts, it does all the fund administration, the fund accounting, so it only releases the investor capital to us at the asset level when we've proven that we're sticking to the mandate and sticking to the target returns. So they're also a voice of our investors as well. So if you have any concerns, you can always talk to them. So it's a very important layer for us. They provide us with the AFSL, compliance training, etc. So it's a strong layer to protect the investors. So myth busting in this sector, motels, I mean, I know what you're thinking. I've spoken to a lot of investors over the last couple of years. A lot of people say, well, they're too small. How can you corporatise a mum and dad business? Or the tourism spend it fluctuates, or the operations are very complex. So let's look at those things one by one. Well, did you know there's more room nights sold in the regions than there are in the cities in Australia? So all of those motels in the regions actually is a larger industry than the big hotels in the city. And this is what I call the smoke screen. So there's over 3,500 motels in Australia, but the small ones, which is the perception everyone has, sort of the 5 to 20 room motels, everyone sort of perceives the industry based on those, but we're targeting ones that are 25 rooms and higher, average value between 5 and 25 million. Now they're the ones that can afford to have a professional on-site management team. And after that professional on-site management team, we have enough left over for the investors. So it's not, we don't have to replace the passion of the mum and dad. They're the ones that we're buying. The mum and dad left years ago because they're making 800 grand a year. They're on a beach somewhere and they've put professional managers in. So they're the ones we're targeting. We're targeting the larger ones that have been shielded by this smaller perception in the market. The second myth is tourism spend. Well, we're not going after Cairns and the Gold Coast and Jindabyne. We're going after Seymour and Orange and Dubbo, where there's diverse economy, there's a lot of business travellers, 4-star properties. So we're going after a lot of the guest profile of our existing properties is in the visiting friends and relatives and the business travellers. Yes, we do have some tourism, but it's not overly exposed to that segment. And our average guest profile is all the service providers that are the lifeblood of these towns. Service providers that are coming in and need to be accommodated, and therefore we're providing an essential service to those. The myth number 3 is the complexity of operations. Well, don't overcomplicate the operations. You know, we have on-site managers that manage a team of 2 cleaners. They turn the rooms over in the morning, they clean the rooms, and they get ready for the guests in the afternoon. And a lot of the tasks that they used to have, like bookkeeping and revenue management, pricing and marketing, is all centralised to our team. So we're making their job more simple, and they can focus on the hospitality and providing a good service to the guests. So a warm welcome and a friendly goodbye and looking after the guests. So I think results speak for ourselves. The Seymour property that we acquired in Seymour is, the blue line is last financial year, the red line is the budget, and the gold line is what we've been able to achieve. So that's a bit of an example of what we can do with our proprietary operational system that we put in place and centralise those important tasks. So I think that's everything. So if you're looking for venture-style returns with property backing, we'll be here for 2 days. Please come and see myself and the team. Thank you very much.
Thanks, David. And that concludes our first block. We will now take a 25-minute morning break. Use this time to connect with the founders you've just heard from. And before you head out, I highly recommend you to subscribe to our Capital HQ YouTube channel. You can scan the QR code on screen. It's an incredible resource for gaining deeper insights into capital raising strategies, the impact of AI, and the latest market trends. We'll see you back here at 11:05 sharp for our first panel session. Thank you. All right, welcome back everyone. I hope you all had a wonderful networking earlier. So we're now starting our first panel session for today. Our next session dives deep into the heart of the current investment landscape. This panel is designed to give you an inside look at how some of the most active funds are navigating today's market. Please join me in welcoming our moderator and panelists to the stage. I'll start with our moderator, Carly Martin, CEO of Venture Bench and Venture GC, Lawrence Schwartz, General Partner at OIF Ventures, Rajiv Gupta, Partner at Allium Capital Management, Ulrich Ferner, General Partner at Blue Team Ventures, and Karen Chan, Portfolio Manager at Perennial Private Investments. Let's all welcome them on stage.
Thanks everybody and welcome to the Venture Capital panel session. Big thanks to our esteemed panelists today for making the time. You're in for a treat everyone, so please take a seat and get comfy. So quick intro, I'm Carly Martin. I run Venture Bench and Elanara Capital. I support high growth businesses both from a legal and go-to-market expansion perspective, and also run a capital raising firm. Joining me today, we have the fabulous Karen. Karen trained as a lawyer, another awesome lawyer, and technology investment banker before spending years at Investec as head of emerging companies, running all of Investec Australia's VC and private growth investments. Today, she manages perennial private investments, specialising in the moment most investors find either too risky or too late, the last private round before a company goes public. And then we are also joined by Ulrich. Ulrich Ferner is one of our most technical VCs. Unlike most, he's backed by a PhD in computer science and a master's in aerospace engineering, both from MIT, plus a patents background in distributed systems, and he holds, which he is also a former researcher. Before moving into investments, he operated startups in Boston, consulted at BCG, and held principal roles at Right Click Capital and King River Capital, leading their deep tech practices. Then he founded Bluestream Ventures to focus exclusively on deep tech. So I'm sure we have plenty of deep tech interest in the room. He's the one to watch. And he has a portfolio spanning frontier AI, quantum biotech, and semiconductors. So as you can see, we've got a pretty cool panel here, so bear with me. And then we have Lawrence. So Lawrence his focus is really around selecting Australian companies that get built in the hard years. And so he is from OIF Ventures, which has made its name. Sorry about that. He came up as an M&A lawyer at King & Wood Mallesons, built a venture-backed tech company, and has since deployed 3 funds at OIF, the latest being a $140 million raise that closed oversubscribed. His years in New York building relationships with top-tier US venture firms have become one of the things that founders seek OIF out for. Last, we have Rav. Rav began at Goldman Sachs investing in listed and unlisted tech across Asia and ran a global tech fund at Tribeca and Merck's Capital before leaving the investor seat and building his own startup, Gecko Life. That move defines how Allium works, the $350 million crossover fund he co-founded from early stage through to an ASX listing. Okay, all right, so we're just going to jump into the questions now. And we're going to start with Lawrence, and then I'm going to move on to Raj. So Australia raised $5.1 billion in 2025, up 24% in venture capital, but 58% of that went to the top 20 deals. Lawrence, from OIF's early stage position, is that concentration a sign of a healthy market finding its winners, or is the ecosystem actually narrowing?
And thanks, Steve, and the Wholesale team for hosting. It's great to be here. So that was Australia's third largest year on record, and representative of offshore markets in venture, where there is a concentration to the winners. Those companies are able to absorb more capital, attract more capital. In the Aussie ecosystem, what that number doesn't capture is a lot of the dry powder available. Offshore funds, the Excels and Andreessen Horowitz, the Sequoias from the US coming in and looking at Australian companies. Also local investors like ourselves who have dry powder and are very actively looking at opportunities. The angel side and government-linked entities like the National Reconstruction Fund and others. So on the kind of supply side of capital, very strong. On the demand side, we see 20 to 30 opportunities a week at OIF. We make a much more concentrated number of investments, about 10 a year, but we see incredibly healthy deal flow. And so I think, the ecosystem is strong and healthy on both the demand and supply sides. There are pockets, obviously Series A, and we can kind of get into the nuance, but at a high level, it's healthy.
Thank you. And Raj, different lens here. Is the recovery you're seeing in listed small cap tech real across the board, or is that really an AI story masking everything that's still flat?
I think it has to do with the fact that in the US there's been significant concentration in the top, people say 7, but it's probably like 15 technology companies that dominate returns and value. How that's translated into Australia is that you also saw over the last 3 years large cap technology do extremely well, and that's where people were concentrating as retail investors, superannuation funds, institutional investors. We also saw a lot of managers in Australia shut their small cap or mid cap funds, which meant that there wasn't a lot of space for small and medium listed technology companies to garner interest. That did wane. What we have detected in the last 9 to 12 months, I'd say since July of last year, people are now starting to rotate again into some of those smaller companies, whether they're AI enabled or not. I think there has been this shift from people not necessarily wanting to hold large cap technology, and you've seen that contraction in the US over the last 6 to 8 weeks. Same things happened in Australia, and there is a rotation that's occurring in front of us today.
So, not to go deep into AI, but if AI is absorbing capital, what else is being significantly underfunded that shouldn't be? And I'm particularly interested in your perspective on this, Ulrich. If deep tech can't get private capital at later stages in Australia when the science is proven, what's the answer? So what is it that you think the true underfunding gap is, and where are there really big opportunities?
Yeah, look, great question. In terms of deep tech, I won't maybe get into definitions today, but it's essentially, you can almost define it as what it is not. And a lot of deep tech investors will say it's essentially not SaaS. And more investors, I think, are having this realization that AI is either slowly or quickly killing SaaS, and you can debate that. And certainly at the early stage, we're a big believer in this, this mantra that SaaS is dead. And when you think through what has a moat, what is hard to build, that is hard for AI platforms to disrupt, people typically tend to look at deep tech, whether that's sort of frontier AI or like robotics, semiconductors, quantum, those kinds of areas. In terms of the stage of the market, so the American deep tech market is more mature than Australia. It's about half of the US market. In Australia, it's sort of 20 to 35%, but it's growing very quickly. The last 5 years of deep tech investing in venture in Australia, the number has gone up over 10 times, and it's catching, and we have a view that it'll probably stabilize at around where the US is. And when you look at the history of the US, it was first the very early stage investors that part of the market matured, then it was late stage equity, and then it was debt. And that's what seems to be happening in Australia. The early stage market has matured a lot. It's not yet baked, but it's getting there, and late stage comes next, and maybe debt comes after that.
Thank you very much. I'm conscious we've contracted this into a shorter time period, so I'm going to jump quickly over to Raj and then over to Karen. So Raj, you've been a founder accepting term sheets, and now you're an investor setting them. Want to look more to the founder lens and give some of our founders in the room some advice. So if structured deals and liquidation preferences are coming back and founders are accepting terms they don't understand in order to close, what would be your one piece of deal structuring advice or really practical founder advice in order to avoid some mistakes and hopefully get founders the capital they need on the right terms?
I don't think there's one thing, there's probably a few things, and Karen can add to this. So I think number one is make sure you've got an investor that is early in the investing cycle. So you don't want to be taking money from a fund that's late in that fund's stage because you're not sure whether you can get follow-on capital if you need it. So to go early is important, and you want to be transparent with that investor to say, if I do need money again, I hope you have that capacity. To the point that Lauren said, dry powder is really important. That's number one. Number two, I don't think it is wise to have too many investors. I think it's good to have someone that's strategic if you can get it, and to get one financial investor, but to get 3 or 4 different financial investors can sometimes be a bit complex. It can sound wonderfully romantic when you get them and you have a press release that says, I got this fund, this fund, this fund, this fund. But often, but not always, later on it can cause some complexity because different investors need different exits, and that can cause some problems for the investor. So that's the second thing I'd say. And then on terms themselves, when we started our business 10 years ago, term sheets were relatively simple. They've become much more complex. A lot of it is about downside protection, which didn't exist as strongly 10 years ago as it has in the last 2 to 3 years. So just be conscious of liquidation preference, whether it's 1 times, and we've seen some deals that have been 5 times, which I'm not sure any founder or any management or board should take. So those are the 3 things I would say.
And just to add to that, I think the terms, if they're too complicated, it is, or very negative, like the 5 times liquidation preferences, it does send a signal to the next investor coming in. 2 other things I would add to what Raj has already said would be the relationships, really important. So if you're like flying high, really hot company, your new investor coming in may actually want to prevent other existing investors to invest, so that's a great problem to have. But then when the going gets tough, you should really keep a great relationship with your investors, because you might be going through a tough patch, and that's actually where you're more likely to get that capital, as opposed to trying to win over new investors who may not understand the story or see a non sort of up and to the right type of financial profile, because there are other opportunities out there which may look more attractive. And then lastly, I would think a lot about your capital structure. Ulrich also mentioned it. Know who the investors are out there, what they can offer. Do you need equity, you need debt, or are there other forms of financing which make sense?
Yeah, I'll just build on that. I think that's a really good point, is preparation. So the venture deals that I see that go best are those where the founders have invested in some company due diligence on themselves, their own relationships with each other, their capital structure, any key risks. Look at it from an investor's perspective before you start having those conversations. And then they've got a really strong investor narrative. What is it that makes them special? What's unique about them that's going to make them really capable of executing, taking that great idea and actually making it real, and then turning that into a strong operational plan so that they can answer any of those questions when they're having the investor conversations. So looking at it in terms of phases, the prep phase, so you know exactly what you're asking for and why it fits you as a business, and then going into those investor discussions prepared with a data room, with ideal thoughts on term sheet, why you're asking for things, and how it fits into the broader trajectory post-funding. Okay, so we're going to move on now to what used to be really important as the only way to get out, IPOs. And so I'm going to touch on Karen's expertise here and ask for some thoughts. So, there's been a lot of commentary about, whether Canva's going to list, what that's going to look like. Is it going to be in the US, on the NASDAQ? Is it going to be here? What does that look like? Given you sit in that pre-IPO space, can you give us a little bit of feedback on whether a listing on the ASX or any other exchange is a genuinely viable exit, particularly for tech companies, but anyone in the room that's considering a listing, and what are your kind of must-haves?
Yeah, I think it's absolutely a viable viable exit or liquidity pathway. Traditionally in the US, top-tier VC-backed companies are looking at IPOs as the gold star. That's where they want to get to. The bar to get listed in the US is actually very high. I think you would need to be at least, this is the very bottom end, US $5 billion market cap to get a look in, whereas in Australia we actually have a very strong market on the Australian Stock Exchange. Contrary to what you might be reading in the press, it really is a cyclical situation versus a structural situation. And I think it's really important to Carly's point, being prepared and having optionality because the market can turn, the IPO windows can close, and sentiment is also really important. So you want to be prepared to go when the timing is right. And also assess, is being an IPO or a listed company the right option for you? So I think the market is there. I think in terms of the ASX, the listings were up 40% year on year. And then the dollar value quoted was also up 200% at almost 40 billion. So it is a deep capital market. We've got a very strong pension pool, lots of institutional investors, local and global. So definitely one to think about. But in reality, most companies are actually exiting via the takeover pathway. So that's actually something to think about. And maybe others here can also talk about other liquidity options that they're seeing, like secondaries. Anyone here have experience on that?
So we started the firm in 2016, so we've been operating for 10 years. We've had 5 exits. The returns are market leading. We've returned 4x to investors. None of those exits have come from IPOs. I think we're blessed in Australia to have the ASX as a really credible option. Companies don't need to get to that US $5 billion market cap. But I think companies really need to think hard about why they'd look to go public, as opposed to just going public for that purpose. You can raise capital after on the ASX quite easily. There's a lot of capital available there. But if liquidity is the only thing you're looking for, there are many other options. Financial sponsors offshore, financial sponsors onshore, strategic trade sales, secondary funds that are popping up. So that's the kind of lens and data I'd bring to that conversation.
That's a really good point. I might just add something there from an early stage founder perspective. Knowing what your potential exit parameters are when you're actually planning your business right at the beginning. So, I have founders now that are planning, I'm building this because I want to sell it to this kind of company or this kind of investor. And they will build the economics of every business model to match that so that they're actually tracking their performance against likely exit parameters. There is a way to plan and build, not obviously just having one view, but it's one of those vectors that actually gets built into the strategy and operations of the business, which I think is quite helpful. It then goes to planning so that when an opportunity comes up for a trade sale or someone, it's an optimistic type, someone comes at you and you're not really thinking about it, at least you've got your governance, you've got the story, you've got something ready to go so that you can actually capitalise on that unexpected opportunity. I think that's something just to keep in mind. So we're going to open this up to the broader panel now and welcome anyone to jump in. I'm just going to give a stat and then let's respond to it. So between 2021 and 2025, S&P 500 returned 12.3%. The average 2021 vintage VC fund is currently sitting at a negative IRR. No deflection, no early in the life cycle. What's the honest answer you'd give an LP today who asks whether committing to you, or committing to a venture fund in 2021 was the right decision?
I'm happy to jump in.
Yeah, you jump.
Venture's not for everyone, and I think people need to understand the asset allocation in their portfolios. The data's there. 2021 was at top of the market, and venture funds of that vintage will not perform, as good as other vintages. So it'll be on a relative basis, but I think there's an asset allocation question, and then also, similar to the time in the market versus timing the market, it is prudent to have exposure across multiple cycles and vintages, as opposed to just looking at one vintage. And the final point is about understanding venture. It is inherent. This is early stage, investing, higher risk, the opportunity for higher reward. There is something called a J curve, so you can't ignore the context of that. Venture does suffer losses earlier in its life cycle, as the companies that are not performing do not survive. But then the ones that are compounding and performing really start to accelerate, and that's borne out over many decades. So I think it's just that understanding the nature of the asset class, and in our portfolio, our funds of that vintage, would be, I wouldn't expect that they would perform as well as a vintage where the entry prices were lower, obviously. But on a relative basis, and for our investors in those vintages, they are performing very strongly, thankfully not in negative IRR. But it is an education piece in just understanding the dynamics of the asset class.
I'd also say it's relationship as well. Just as company founders have a relationship with their investors, we also have relationships with our LPs or investors. And I think what LPs should be looking for is how we would be working with our portfolio through the good and the bad, because it is a longer horizon, and you might be in a temporary dip. And we've actually also seen companies like successfully pivot, some venture companies, backed companies that were backed during 2021, where they've actually pivoted to an AI story and been very successful. We've seen some of these companies raise a lot of capital. So as long as you're alive, I think being default alive is, I think, the most important thing.
Business is hard in a good cycle and a bad cycle. Raising money is wonderful when the money's available. In 2021, it was readily available because that period between 2016 and 2020, companies that raised money and funds that raised money did very well. So in 2021, if you raised money, it was easy to raise money as a fund as well as a company. But the habits that it built in 2021 and 22 were horrible, because it was very much a grow at any cost. We had companies that were coming in to raise $3 or $5 million, and a week later they'll say, oh, we're closing, we've in fact got demand for 15, so we're going to increase it to 15. They only needed 3 to 5, but they raised a lot more, and it built some really bad habits. In the last 12 months, we've seen many companies reduce their global ambitions when they're somewhat early. You just have to validate very quickly, and you've got to show that revenue conversion to some type of profitability metric isn't something that you dream about, but that you can show that it can happen within a period that everyone's comfortable with. So that 2021 period, we will look back on in 10, 15 years. It was a blip. It's normal. It's natural. If you were part of it and you won, well done. But if you're stuck in some stuff, that's investing.
So maybe add one other comment, which is, I think as an investor in a fund, you are a business partner with that manager, and the good managers will spend serious time with you working through the highs and the lows of any venture portfolio. It is a patient game. It has long time horizons. The rewards can be extraordinary, but it is also a game where there shouldn't be surprises from venture managers in terms of the highs and lows. The best managers are fairly transparent about it.
It's a really good point. Thank you so much, everyone. This was fantastic, both getting to know you, but also to hear your perspectives. We're out of time, but if anyone has any other questions or wants to come say hi later, we're around for the day. So thank you so much, and enjoy the rest of the conference.
Thank you so much to our panelists for their expert insights. We have a packed session leading into lunch with 7 more presentations. Starting our mid-morning block, we have Taurus Empire presenting their lifestyle waterfront development project. To share more about this landmark development, let's welcome its property developer, Johnny Vines.
Thanks, Jade, for the introduction, and also a big thanks to Steve for putting on the event and bringing this kind of community together again. We spoke about it last year, and the project wasn't ready, so Steve, I promised you I would bring it back, and here we are again, so it's great to be back in the room. So I'm Johnny Vines, Director and Developer at Taurus Empire. We're in the business of making, building, designing landmark waterfront projects, particularly in the high net worth retiree market of Sydney and Canberra. We do this by selecting dynamic sites, government incentivised, recognised with high growth returns, improved community infrastructure, and enhanced lifestyle amenity. Over the last 2 decades, we've helped hundreds of families to fulfil their life's greatest dream of a family home. So the current project offers a range of bespoke living profiles within a waterfront precinct, anchored around a 90-berth marina. So let's dive into it. With the team, a little bit about myself and the background of my dad was a commercial builder, so kind of grew up in diapers on a building site, and I took a little bit of a different path into landscape architecture, and then evolved from my own projects with developers, project managing, and then onto my own development sites. So this is the team with me as well. I've got David Dean, he's the commercial finance kind of rep in my corner. He was a bit over a decade with NAB commercial banking and done significant rural, residential and commercial development funding. Scott Milliken there in the middle and Peter Rasa, they're the principals at PRD Architects. Done a lot of high-rise design and similar with their builders as well. They've been quite a few decades in that architecture space. Mark Grayson with Knight Frank Town Planning, he was the guys who put it together with our proposal. And Aaron Sansoni is my mentor, coach for AFR Young Rich Lister. So that's kind of the team to make it happen, but the big problem with this project is really it's kind of a patience play. It was a long-term game for me. It's probably about 12 years in the making so far. And the real problem was just underutilised land. A little bit of a confession for me, I was only after one site in this whole precinct area to start with, and then as the opportunity and the DD went into it, the opportunity grew into something a lot bigger than just the one site that I originally wanted. So as we go through it, there's underutilised zoning. It was an old part of town that needs to be redeveloped. The new hospital facility is literally 500 metres up the road to the left of that left image. So they've just redeveloped that at a 7-storey building now. Outdated planning controls, lack of cohesive development. So I'll show you in a couple of slides where others have tried to do this single site development and failed, never went ahead. But really it's the lifestyle amenity that we're after, that waterfront, marina, esplanade, the kind of luxury kind of stuff that people want to retire into. So as a company, like I mentioned, a few projects we've done in around housing, villas. It's all been targeted at retirement population, so they've obviously got money. They've got, the lifestyle downsizing, they want the quality of a retired lifestyle. And that's kind of where we've featured a lot of the projects that we've built over the years. And with this one, probably the main attribute is the 90-berth marina, so having that waterfront esplanade, really focusing on the residential, cafe, retails, and the kind of walkable space when you retire. You got the hospital up the road, community, cafes, town centres, 5-minute walk, train station's not far away either. So with the market, it's a pretty interesting pool for us. So over the last few years, we've had local agent Rain and Horn. They've run an EOI on the project and some of the concepts we've released publicly. And each time the EOI gets presented, there's over 500 which they've capped it at. Registered interest party come back, and that's mainly their local database that's come back interested. But really there's three main pools. So if you're familiar, it's the first set of traffic lights south of Sydney as you drive down the Princess Highway. So all the government infrastructure and the bypasses around towns, Albion Park, Gerringong, Kiama, all those bypasses now lead you to the narrow waterfront, and the first set of traffic lights is at this development. So we've got our Sydney market that kind of come down every weekend, and we've also got Canberra on the other side of us as well. So it's a very kind of strategic play for us. It's quite competitive with the Sydney market and Canberra on the other side of us, but obviously the demand is still there locally as well. We'll jump into a video. So this is a bit of a fly-through of the project, a couple of stages, the two waterfront stages at present. This is stage one, which I'll kind of identify a little bit later on. You'll see the three bridges there. Mainly that bridge on the left is the newer one that's been 4 years kind of in construction with Fulton Hogan. That was a $440 million federally funded project with a new bridge upgrade. So that's a stage one, 90 apartments, the commercial podium on the bottom layer and double basement underneath. So that's looking south as you head in towards Nowra from Sydney. Marina there just at the bottom, and this is on this side, commercial hotel and about 150 apartments on this side. And if you know Nowra, you'll know that this is a very different appearance. As we go through, a couple on the bottom side, you'll see obviously waterfront, but there is a levee bank on here where we're behind the levee bank, but we've got a double basement car park there, engineered with a tanking, so it can be built within the flood zone. We'll come around into like an esplanade. We've got a few different ideas with the museum there, some community infrastructure to give back, and also just create that kind of ambience and amphitheatre for people to enjoy. As we go on, so our competition, like I mentioned, there's a few guys that developers come through over the years, obviously seen the strategy that I did myself in the single site, never went ahead, expression of interest went to market, and never really happened. But the big thing that happened last year, so we've had a lot of government funding now come through. PM announced $5 million last year. He was in town, delivered to council. Some pretty key funding for economic study and flood study as well. So that all that modelling's been finished now. And obviously I mentioned the Nowra Bridge project. So that was 4 years. It kind of stalled this project a little bit. They used one of our sites there, demolished it off, used it as a site office. So that kind of stalled the whole thing. All that's finished now, and we're at that kind of cusping point where we're ready to, really get some momentum behind this thing and get into the construction. So the business model, there's 4 stages to our project overall, and basically, stage 1 right through to 4, and we're looking for kind of an investor who understands the development model and what works around a cash flow, roll through from stage 1 to stage 4 ideally, and then really leveraging in that investment value. So the money model, starting with stage 1, and it's basically what I've targeted here on the numbers is around the 90 residential apartments, and we'd probably look to hold the commercial aspect of it underneath. And then we'd probably replicate that for the 4 kind of stages of the project, selling off the residential and then holding the commercial aspect to it. We've also got the marina sales just on the end there, and typically the Shell Harbour Marina, this is completed in the last year or so, and they're looking to basically sell the marina space and then lease it off. Next 12 months, we've got the amalgamation, the approvals, and the construction for stage 1. And then our marketing to roll out as well for the project. So our 5-year goals, we're going to basically strategically get these approvals finished off, and then we'll get into the marina construction stage 1, and then stage 2, 3 and 4 will kind of roll on, probably about 12 to 18 months in between each construction phase. The numbers, we're looking at about a $30 million raise, 25% of the company, and that's kind of structured around those apartments again. So it's not over the overall, it's that number's on the apartment total. And then we're looking for a 3-year minimum. Like I say, if we can, we're looking for the investor to kind of roll onto each stage of the project. Next steps, I'll be next door. We've got the stall, first one in on the left there. And happy to take any questions and run you through the project a bit more.
Thank you, Johnny. Our next presentation features Patrys Limited, a clinical stage biotech company making significant strides in the healthcare sector. They are currently developing the first injectable therapy for delirium using their proprietary deoxymab platform. Please join me in welcoming their CEO, Samantha South.
Good morning. I'm Dr. Samantha South, the newly appointed CEO of Patrys. I'm here to share why this opportunity compelled me to join and why we believe now is an exceptional entry point for investors. Patrys has spent the last several years advancing its deoxymab platform in cancer and immune-mediated inflammatory conditions. Despite confidence in the platform's long-term value, manufacturing scale-up complexities have extended development timelines, which prompted a parallel strategy to accelerate revenue alongside this flagship program. In late 2025, Patrys identified a complementary opportunity in ELLIS, a clinical stage asset with faster market programs addressing real unmet needs. This acquisition bridges the timeline gap, de-risks our runway, and generates nearer-term value. I'm very excited to be able to introduce you to the first product that Patrys will advance to the clinic and why we expect rapid success. Of course, the usual disclaimer about forward-looking statements. So our lead product addresses delirium. It is a common, serious, reversible, acute brain dysfunction characterized by confusion and agitation. It happens in intensive care, aged care, and palliative care settings. It distresses patients, families, and carers, and drives significant healthcare costs through increased falls, longer hospital stays, cognitive decline, and dementia onset. Delirium is basically a chemical storm in the brain, where the normal balance between the calming and the activating brain signals get scrambled, leading to struggles in information processing properly. There are three types, with patients sometimes fluctuating between the aggressive and the withdrawal subtype. While the aggressive form is more easily noticed and more easily medicated, the withdrawal subtype often leads worse outcomes, particularly related to dementia onset. It's not just seen in elderly patients either. Although anyone over 60 is certainly more likely to experience delirium, young people also experience delirium, in particular those undergoing long heart surgeries. Delirium affects a significant proportion of critically ill, elderly, and palliative care patients. Globally, over 500 million people are diagnosed annually, a number that will rise with aging population and better diagnosis of delirium. Delirium rates vary by healthcare setting, and conservative calculations estimate a serviceable, addressable market of $2 billion annually across the three care settings. Hospitals do care about this problem. Every day of delirium increases ICU costs by approximately 40%, with complications and rehabilitation and things like that adding further expense. The annual costs almost reach $9 billion in Australia and $100 billion in the United States. A solution that could reduce this burden will create better patient outcomes and lower hospital costs, which we think makes adoption straightforward for the hospital systems. There are currently no approved treatments for delirium. Existing therapies that are used off-label, which means without approval, have safety concerns, slow onset, or inconsistent efficacy, which leaves a gap for a fast-acting injectable option. Many clinicians actually consider that oral quetiapine is the safest, most effective delirium treatment. Approved by AstraZeneca for schizophrenia and bipolar disorder, it's been used safely for decades. Clinical trials show that oral quetiapine at doses used much lower than those for bipolar disease does resolve post-surgical delirium faster. However, its use in delirium is limited by only being available orally. As you might imagine, trying to convince an acutely confused patient to take a pill from a stranger in a hospital isn't always that straightforward. Some clinicians even try to crush the quetiapine for nasogastric tube administration, but this is difficult, limited to patients who already have the tubes in place, and doesn't solve the broader access issue. The majority of delirium patients simply go untreated or receive suboptimal alternatives. Additionally, oral quetiapine undergoes extensive metabolism, and it's highly variable between people, so what might work for me may not work for you. So our solution is, in fact, a solution, a proprietary injectable formulation called AQS of quetiapine, optimized for use in the acute care setting to provide patients a more rapid, predictable, and effective resolution of delirium with fewer side effects. We filed a patent application that we believe, due to quetiapine solubility complexities, provides extremely limited opportunity for workaround, and will offer protection if approved until 2042. AQS offers several advantages over oral quetiapine, and we are confident that clinicians will adopt AQS as oral quetiapine is already being used post-surgically, and importantly will be replacing the current unapproved drugs with the first approved drug for delirium, requiring no workflow changes and not having to change the clinician's activities now. Because there is so much safety data that already exists on oral quetiapine, Patrys can benefit from a truncated hybrid regulatory pathway, taking only approximately 12 to 18 months to move through to the pivotal registration clinical trial, the phase 3. However, we still need to bridge the data that exists on oral quetiapine with our IV formulation, which can be achieved with very small subject numbers because we already know the dose and we already know the safety. We're currently completing the required drug product regulatory and clinical trial initiation activities, and in these small early clinical trials, we'll provide the data to design the pivotal registrational trial very quickly. As part of the acquisition, the Patrys board has been refreshed, including members with deep expertise in biotechnology, clinical development, governance, and capital markets. We think now is the perfect time to invest because we have several near-term value inflection points. We'll be working closely with the Independent Ethics Review Board and regulatory authorities to target completion of drug product manufacturing and regulatory and phase 0 clinical trials this year. In summary, we're advancing our first product, an injectable antipsychotic targeting 500 million individuals suffering delirium each year. We have an IP position that provides limited workaround and a large growing market. By leveraging established oral quetiapine data, population computer modelling, and hybrid regulatory pathways, Patrys benefits from a shorter, more predictable, lower risk development timeline and clear regulatory precedent and strong clinical demand supporting faster market entry and adoption. The company believes this dual platform strategy positions Patrys to deliver sustained development momentum with a clearly defined near-term clinical and regulatory valuation uplift from the catalyst from AQS, complemented by the longer-term value creation from the original deoxymab platform. Thank you for your attention. I'm at booth 14 and I look forward to discussing the specifics of this opportunity and answer any questions.
Thanks, Samantha. Next up, we have Invion Limited, a company at the forefront of cancer treatment innovation. Backed by the Cho Group, Invion is leading the development of the groundbreaking PhotoSoft cancer therapy through a strategic alliance with the Hudson Institute and ongoing clinical trials. Please join me in welcoming its Executive Chairman and CEO, Professor Thian Chu.
Hi everybody, great to be here. And I don't really need to share with you why we need to find treatments for cancers. The question that we're trying to answer is how can you combine a drug with light to treat multiple cancers and ultimately make it affordable to a lot more people in the world. Our technology is a next generation photodynamic therapy, and we are already in clinical trials right now. And we've already completed a phase 2 investigator-led trial in prostate cancer. We're currently ongoing with a non-melanoma skin cancer trial out in Queensland that I'll share some results with a little bit later. And we're actually getting ready to start an anogenital cancer trial, and we're working with the Peter MacCallum Cancer Centre on that. The differentiating factor here is all 3 cancers are using the same underlying drug to treat. And in addition to getting to clinical trial stage, we've started to get more attention from industry, who are helping to fund our programs, which means non-dilutive funding for investors. One of them is a Korean pharmaceutical company called Hanlim Pharma, and they recently got a grant from the Korean Drug Development Fund of up to $2 million to fund an esophageal cancer program using an IV formulation for us. Another industry partner we have is a pet pharmaceutical company called Protect Animal Health. Pets also suffer from cancers, and we're looking to use our technology to actually treat pet cancers, and it's something that our partner Protect are actually funding as well. So how does our technology work? Well, there's something called the Warburg effect. Cancers like sugars. So what we did was we coated our core molecule with glucose conjugates. Therefore, many types of cancers will rapidly uptake our compound. And by itself, nothing happens. But when you shine a frequency of light, it generates an oxidation process which kills just the cancer cells because it hasn't localized in the healthy cells. That's the first mechanism of action, is to kill the cancer cells. The second mechanism of action is to actually activate the immune system so it starts recognizing and fighting those cancers. Before we got to clinic, we actually tested on over 6 different types of cancers in animal models, and we found consistently that it regressed these cancers. At the same time, we tested safety and toxicity. In fact, we injected at 100 times the therapeutic dose and didn't really find any toxicity issues. However, curing cancer in mice is nice, but not really useful for us. So we completed a phase 2 investigator-led trial in prostate cancer, and what we found was it was really safe. In fact, we only had mild side effects. The most common was fatigue, and if you compare that to other standard of care, that's a really big thing. The other question then is, did we get any efficacy signals? And we got a roughly 40 to 44% response rate. We actually tested 2 endpoints. One was, did the tumor get smaller? And the other was a biomarker called PSMA PET. And combined, we got roughly 40 to 44%. Small study, promising results, so we're really excited about that. But what we wanted to do was to pivot and show that the same drug can work in more than one cancer. What better cancer in Australia to do than skin cancer? So I think 2/3 of every Australian will get skin cancer by the age of 70. And so we're doing a trial in Queensland, and we found in the interim results we announced that there was very good safety data. There was actually no pain, no adverse events linked to our treatment. At the same time, we found that there was a statistically significant reduction in the tumor size. And so that's our second cancer. Now, the curious thing about our compound is there's 2 activation wavelengths. So one is in the red light spectrum, and that's the one that kills the cancers. The second wavelength actually fluoresces them. It actually glows the cancers. And you can actually see that on the left-hand side in some of our animal models. So on the top left, you can see a mouse that's been implanted with a tumor in the back, and that's what glows pink. And when we look more closely in one of the organs, you can actually even see the pink goes to the metastatic spots, which shows that it's actually localizing quite specifically to the cancers. Literally, we use an iPhone with orange goggles, and that's what you see. Now, if you switch the wavelength to red light, that's going to kill those cancers. And in our human trials in skin cancer, you can see it translates quite well. You can see the compound glowing on the skin as well. Now, the third clinical trial we're doing with Peter Mac is actually a little bit different, because we're combining our therapy with immunotherapies, specifically immune checkpoint inhibitors. They're the #1 best-selling cancer drug in the world for the last decade. And when they work, they're fantastic, but they normally don't work. So about 12% of the time they work. With the work we did at the Hudson Institute and Peter Mac, we increased that to 80% in animal models. So what we want to do now with the anogenital cancer trial we're preparing for is to actually treat humans using a combined therapy. And we also got orphan drug designation with the FDA as a rare cancer. So that means we actually have a portfolio of cancers that we're treating in humans, of which other folks are funding a whole bunch of them. And prostate, non-melanoma skin cancer, anogenital cancers, and we're leading up to esophageal cancer, which industry is paying for. We also are looking at animal cancers, and I might quickly touch upon our collaboration with Protect. They're a pet pharmaceutical company that has both an R&D group as well as a distribution channel to pharmacies as well as vet clinics. And they're funding in vitro, in vivo, and ultimately companion animal trials, which is the equivalent, in pet equivalent, of human clinical trials. And there's such a big need. Some people spend more on their pets than their kids. So this, we think, is a very interesting unmet need. The other element is affordability. The average drug in the US costs $300,000 US. Most people in the world can't afford that because they're very good science, good technology, very tailored to individuals, but not scalable. Ours is a small chemical that's scalable, and on top of that, it works on multiple cancers. So we believe instead of targeting the top 1% of the world, we can potentially target the top 10, 20, 30% of the world. So in short, we have a great team and working with partners, both industry and research, and we're very excited about where things can take us. Love to chat more when in our booth, so feel free to stop by after this. Thank you very much.
Thanks, Professor Chu. Our next presenter is VenstraMedical, a company backed by Highcroft Capital and boasting over 120 years of collective medtech expertise. With validation from the world-renowned Mayo Clinic, they are pioneering the next generation of cardiac care with their patented PVAD technology. Please join me in welcoming their CEO, Dr. Martin Cook.
Imagine this, the market for an existing type of medical device that's currently at just under $3 billion of annual revenues, growing at over 18%. That market is completely dominated by only one company with this type of medical device, and that company was acquired recently for $17 billion US. Their device is based on 30-year-old technology. Now, who here can see that that's a market ripe for disruption? Now, let me tell you about my company, VenstraMedical. At Venstra, we're developing a technology to treat critically ill cardiac patients, most notably patients who have suffered a massive heart attack and have gone into a condition called cardiogenic shock. This is an emergency condition. There's not enough cardiac output, and they need circulatory support, and they need it promptly, and they need a high level of circulatory support. Now, a type of device called a PVAD is becoming the standard of care for these patients. It's a tiny blood pump on the tip of a catheter, implanted by a cardiologist, not a surgeon, in a cath lab, no surgery, for temporary cardiac support. And the system typically consists of an implantable catheter pump, as well as an external console, as you can see there. Now, as I mentioned, there's one company and only one company in the world with approved such devices. It's a company called Abiomed, and they basically have two versions. The one on the left that you see there is relatively thin, which is great. It can be put in on an emergent basis through the femoral artery by a cardiologist, but because it's small, because it's thin, it can't provide the level of support that patients need. All cardiologists know this, which is why they have the much bigger device, which can provide more support, what patients really need, but because it's thicker, it requires surgery, needs an OR to be prepped, typically takes about 3 hours. So there's a conundrum for the doctors trying to treat these patients. At VenstraMedical, we're developing a disruptive next-generation technology, which is a best of both worlds approach. It's collapsible and expandable, so it's both small and full cardiac support. So imagine you've got a patient, they've had a massive heart attack, they're rushed to a cath lab, cardiologist implants our device, our pump is folded and collapsed inside that tiny blue catheter. It's about 3 millimeters in diameter. They advance it across the aortic valve into the left ventricle, and here's the new bit. We retract that catheter and the pump naturally expands, including the all-important spinning little rotor. And just like the existing technology, it draws blood from the damaged heart, pumps it into the aorta, takes over the sick and injured heart. After a few hours to a few days, we retract the device, we recollapse it into that tiny sheath and out of the very small incision in the patient's groin. Now, not only do we have a very small catheter, the level of support that we can provide is second to none. By support, I mean the flow and the pressure, which all sort of blood pumps need to produce. So, which is why you're seeing a pressure flow graph here. The big blue circle is what patients typically need. The red line is what the existing technology can do. You can see it's far from ideal, and our technology can provide full support for almost all patients. It is an absolute game changer. When we speak to cardiologists, they call it the holy grail, and it's really important. Studies show that if you can provide full support to patients who have had a heart attack, you keep the infarct size much smaller. The infarct size is the dead tissue in the heart caused by the heart attack, with subsequent positive effects for the patients, keeping that size down. And we do it all in what's called a 9 French or 3 millimeter diameter catheter. That keeps complications to an absolute minimum, bleeding and limb ischemia. And it's of particular importance to women. It's a well-known fact that women don't get PVAD therapy as often as men because their vascular system often can't handle the size of existing devices. But as we get that size down, it opens up the already massive market for these devices. Here's some videos to sort of show you how our device works. On the left, it's actually being collapsed using a collapse tool underwater. It gets the air out of it before you implant it. In the middle is the device once it's expanded, pumping away in the heart, and on the right is the retrieval and recollapse the device to take it out of the tiny incision in the patient's groin. We work with the Mayo Clinic in Minnesota. They give these animals a heart attack and produce cardiogenic shock, and you can see here in the blue bar chart the cardiac output of these animals falls to almost nothing. They're on death's door. We put in our device and bring that cardiac output back up and basically save the animal's life. We've published in journals co-authored with the Mayo Clinic. We've also done multi-day animals. Some patients need these devices for up to a couple of days. And one of the things we track is the blood damage. All blood pumps produce some sort of damage to the blood. Ours is the lowest of any of the sort of comparable devices. We've also done bench testing for up to 20 days, although we'd be looking for a 4-day approval from the Food and Drug Administration. So from a technical perspective, we've really done a lot of de-risking. We've got an absolutely unique device. It's the most powerful and the lowest profile PVAD, which is incredible. And we've done it all because we've got a fantastic team. I think it's over 120 years of cumulative medical device development. My co-founder, Dr. Thumbar, who's here sitting in the front row, and we sold our last company to Edwards Life Sciences back in 2017. We've put together a fantastic team, this time including Professor Chris Haywood from St. Vincent's up the road and Dr. Chet Rehal from the Mayo Clinic in Minnesota. IP is important, and from an IP perspective, we're actually very mature. We have 8 granted patents in our portfolio now. some very early priority dates, which is important, and of course we do very large freedom to operate searches, but our IP is covered. I alluded to the market when I started talking. It really is known as the most exciting market in medtech. The gross margins for these devices are over 80%. So the disposable catheter pumps typically sell for north of $25,000 each. Reimbursements in place all around the world, particularly in the US, where hospitals get $72,000 reimbursement for the procedure to implant these devices. And the addressable markets, 100,000 cardiogenic shock patients every year, as well as other type of patients who use these devices. It really is an incredible market. So we're looking to raise $8.5 million, and that will get us through our what we call first-in-human study, our first clinical trial. And that, as you can imagine, is really a massive value inflection point for the company. Beyond that, we're looking for an exit in under 3 years. If we do go all the way to FDA before we're acquired, most people would consider an exit around the $2 to $3 billion range in this market. There's no better endorsement than having doctors come on board, particularly when they're investors. And I'm happy to say that late last year we got a US VC that is led by a group of 5 cardiologists to invest in our technology because they were, frankly, so impressed with it. And Forbes Australia did an article about VenstraMedical as well. So we really have a unique technology. If you're interested in joining the journey and taking us through to a big exit, we'd love to hear from you. Or if you're just curious and would like to learn a bit more, I've got a table next door as well. Come and speak to me. Thank you very much.
Thanks, Dr. Cook. Next, let us welcome Navi Medical Technologies. They are transforming the standard of care in vascular access through innovative ECG-guided placement and continuous surveillance. To share more about their mission and technology, please welcome their CFO, Brad Bergman.
Good afternoon, everyone. My name is Brad Bergman. I'm the CFO and co-founder of Navi Medical Technologies, and I'm really thrilled today to be able to share with you what we're doing to help children everywhere live brighter, healthier futures. So globally, there are millions of critically ill newborn children and pediatric patients that require a central venous access device, or CVAD. And that's essentially a long, thin plastic tube that's inserted into a blood vessel, usually a vein in the arm or the leg, and it's introduced through that vessel to terminate close to the heart. And they do this so they can deliver high concentration doses of drugs, medication and fluids to these critical ill patients. The problem with this procedure is that it's currently performed blind. So doctors don't really know where the catheter is during the insertion procedure, and they have to estimate the length by measuring the external features of the patient. They insert the catheter to that predetermined length, stop the procedure, and then have to call in an X-ray to confirm if that catheter is in the safe position. And that can take upwards of 60 minutes. And the problem here is that up to 50% of the time, the catheter is actually in an incorrect or unsafe location. So either inserted too deep into the heart or too short into the surrounding tissue. And that often means that doctors have to either adjust the catheter or repeat the procedure all over again. And that causes a lot of delay in infusion to these critically ill patients. These catheters also stay in the patient for weeks at a time and have a tendency to move or migrate. And if these catheters move or migrate to unsafe locations while there's an infusion happening, they can cause significant complications, damage to the heart and the surrounding tissue, and sometimes even death. So that's why we've developed the NeoNav. It's an ECG tip location system, and it's compatible with any standard catheter, and it turns a dumb catheter into a smart catheter. It uses the heart's electrical signals to give doctors real-time information of where the catheter tip is during the insertion procedure, and also gives them the ability to do a non-invasive surveillance of the catheter throughout its use. Using the NeoNav, its procedures can be performed faster to deliver life-saving infusion therapies by inserting the catheter first time right and over 90% of the time, as well as saving time not waiting for an X-ray to confirm its location. It's safer by reducing the risks of service complications, primarily in undetected migrations and the complications that arise with that. And if it's safer and faster, there's a good argument that it's cost effective as well. So the NeoNav is currently for sale in the US. We got our FDA 510K clearance last year, and we're really proud that we've got the broadest indication for use of any tip location system on the market. So our device can be used preterm babies through to children and adult, any size catheter. Uniquely, it can be used to position catheter in multiple positions in the heart, so above and below the heart. As mentioned before, it can undergo surveillance of the catheters, as well as be an alternative to X-ray. The global addressable market for the NeoNav is large and growing. Currently, there's over 830,000 of these procedures that are performed in the US alone, and over 2 million globally. And it's a total addressable market of about $1 billion that's growing at about 9%. I wanted to take a moment to talk about the clinical data that we've collected over the years. We've worked really closely with the Royal Women's Hospital in Melbourne, and we've recruited over 200 patients across multiple studies. Our most recent study was that of a comparison with ultrasound, which is considered a gold standard in imaging. And we're pleased to report that we've got a 94% accuracy, which when you're talking to the FDA or hospitals, anything over 80% is considered clinically significant. So we're really proud of that result. We've also spoken a lot with health economic experts and hospitals in the US to better understand what the cost of these complications are and what the cost saving of using our device can be to them. Conservatively, just on neonates alone, you're looking at a saving of over $520 per procedure. We've got early traction in the US market. We currently have 2 clinical evaluations underway, one of which is a paid evaluation, and we've got several discussions happening with kind of large children's hospitals there, and hopefully we'll commence clinical evaluations in the coming months. The business model that we're operating is a capital and consumable model. We're a little bit flexible here. Hospitals can either purchase the capital unit on its own and the consumables as needed, or they can enter into a subscription agreement where there's no charge in the capital and there's a slight upcharge in the consumables that's contracted out of a certain period. And one thing that's worth noting with our device is because we can do the placement and the surveillance, it gives us the opportunity to sell multiple consumables per patient, which is quite unique for this type of technology. We've put together a great team. We've been working together for over 8 years, and we've got a very broad range of experience. My co-founder, Christiane Theda, she has got over 30 years experience working as a senior neonatologist in Germany, the US, and Australia. And we've got experts in commercialization and vascular access specialists as well. So to summarize, we've got a great unmet need. Over 170,000 adverse events can be prevented using our technology. We can address a market that's over $1 billion with a US FDA cleared device. We've got a really strong IP portfolio. We've got 3 patents across multiple regions, and we're engaging our first customers as we speak. We're not currently actively raising now, but we're looking to build relationships when we open up our next round, which will be towards the end of this year. Thank you for your time.
Thanks, Brad. Next, we are joined by Wavewise Analytics, a company redefining the standard of care in brain health. The world's first non-invasive technology empowers clinicians with continuous real-time monitoring to detect early neurological deterioration. Please join me in welcoming their CEO, Dr. Mary Beth Brinson.
A 34-year-old man collapsed on the way to work. He was rushed by ambulance to hospital at Stanford University in California, where he was diagnosed as having a ruptured aorta. Surgery went really well. He left the theater and was admitted to the cardiac ICU, where he remained deeply sedated and anesthetized for several hours as per standard practice. Upon arousing him and bringing him back up, it was unfortunately discovered that sometime either during the surgery or in the ICU, he had had a massive blood clot that had traveled to his brain. His right side of his brain was completely without oxygen for many, many hours, and at that point there was nothing they could do for him. He was declared brain dead and then passed away. This story was told to me by one of our advisory board members who was the cardiac anesthesiologist for that surgery. And in a regularly scheduled meeting, she was describing to me and validating the need. She was also mired deep in going back and looking at every output of every piece of equipment that had been used during the surgery and the ICU, looking for any indication that this large tragic event had happened, and was adamant that there was not a single blip during the surgery or in the ICU that would indicate a problem like this. This story, very sad story, confirms our founder's belief, Dr. Barry Dixon, a career neurointensivist out of Melbourne, that for certain patients having surgeries, if you think big cardiac surgeries, for instance, or in the ICU and that are deeply anesthetized, that effectively medics are flying blind in evaluating how much blood their brain is getting and is it sufficient for what they need. So the neuromonitoring standard of care leaves patients and clinicians quite vulnerable, and it leaves hospitals and payers and health systems on the hook for greatly increased cost. So for instance, in the United States alone, there are over 4.5 admissions annually to hospital for cardiovascular-related issues. Of those, over 1 million patients will go on to have procedure that places them at a really high risk for poor outcome. So these are not your simple heart surgeries. I'm talking big heart surgeries like aortic repairs, carotid endarterectomies, things like that. So the current standard of care monitoring fails to provide early warning signals so that something could be changed in the care of that patient. And as it stands today, there's no objective way to alert clinicians to early changes where preventative care could be provided to prevent brain injury or disabling injury. So this leads to about $8 billion of additional cost in the healthcare system in the United States. Brain injury is detected too late. The deterioration can be detected, but often only at really terminal stages in these sedated and anesthetized patients. So in the ICU and in perioperative care, neurological decline is subtle and it's hard to see. Typically, it's detected by asking patients how they are, how they're feeling, to do something, to look at reflexes. But when you're under anesthesia or sedated, deeply sedated, that's not possible. So typically, they're evaluated by subjective monitoring. Somebody monitors them on a schedule, looking at all the outputs and any reflexes that are available. But again, anesthesia really dulls those reflexes. And early changes are missed. It leads to, in the case I described, death, but irreversible injury. But even if it's not a fatal injury, it leads to increased hospital stays, length in the ICU, and increased disability. So despite that there are several and varied types of monitoring tools available, there's not a non-invasive, continuous, reliable indicator of neurological deterioration. Sorry for the jump scare, apologies on the screen, but I just want to mention two really common ones. I was talking to somebody about one today who said he would be here. But first is the non-invasive method. You've seen it on TV. Your ICU clinician sitting at the head of your bed or by your feet will make regular checks on the outputs of machines where you are being monitored and look at things like your pupil dilation and check your reflexes. Again, it's subjective, it's time intensive, it requires skill, and it can vary from person to person. And they do change shifts in the ICU. On the complete opposite end, there is an objective way to look at the brain, but it requires placement of a probe by a neurosurgeon, which is this is not available to most people because of the risk of infection and damage. So for the vast majority, over 85%, something like this would never even be considered. If you'd had heart surgery, they wouldn't consider putting an ICP probe in you. So at Wavewise, we're determined to develop a non-invasive, continuous brain blood flow monitor that can provide early indications of patient complications. Our technology uses well-established ultrasound Doppler technology, but we're applying novel thought to that. We are using multi-channel Doppler, and we have developed a proprietary way of looking at multi-sites around the head and neck and drive algorithms that can indicate early changes in patients. The places that we've chosen to monitor are excellent for monitoring because they're easily accessible by the bedside, and taken together in an algorithm can provide early indications of change for the patients. So it will provide faster treatment and lead to cost effectiveness by reducing stays in the hospital and reducing poor outcomes. We have IP, and it's developing. The IP is developing around the hardware, the software, and trade secrets around the algorithms and how we actually weight the different inputs from the sensors on the ultrasound. The addressable market is really large and growing, unfortunately, for cardiovascular disease. In the US, a global TAM of over $8 billion US dollars, and growing every year by almost 8%. Payment pathway initially will be via DRG code and will be limited to the most high-risk patients initially. The regulatory pathway is a 510K. Our pre-sub goes in tomorrow. We will confirm the predicate and we will confirm the clinical pathway, the clinical data pathway that we've chosen. We have a small but mighty team backed by an able and experienced board. We are in a raise for $900,000. We have closed $794,000 of that, which means that I only need 4 of you to come up with a little over $25,000 so that we can close this raise. It presents a really good opportunity to get in early with a company with a relatively small investment. With these funds, we're developing the prototype, which is well progressed. We are developing the data architecture as well as a computational model, which I'd love to talk to you about, and setting ourselves up for a human study that will begin in a few months. Thank you. I'm at table 17, and I'd love to talk to you. Please come by.
Thank you, Dr. Brinson. Continuing our healthcare innovation block, please welcome ELLIS Medical Solutions. They are an award-winning team transforming intensive care by introducing continuous autonomous monitoring designed to detect respiratory complications in real time. Please welcome their CEO, Liz Davis.
Hello. ELLIS Medical Solutions has a vision to revolutionize airway management by simplifying the tools, methods, and resources used to access and monitor patient airways. Success will lead to better patient outcomes, lower costs for hospitals, and create significant revenue for our shareholders. As a clinician, ensuring that a patient has the oxygen they need to survive is a critical first step in clinical care. 60% of surgical patients and 40% of intensive care unit patients will require invasive airway management. There's 4 steps to invasive airway management. First, a clinician will make sure their patient is ready. They'll sedate them, oxygenate them, paralyze them, and make sure that they're ready for an endotracheal tube to be put into their throat. They'll then force that endotracheal tube past the vocal cords of the patient. If they can't access it, they might use a video laryngoscope to help them see the vocal cords, and then they'll put the tube past them. Unfortunately, once they pass the vocal cords, they have no visual confirmation of where that tube is going. So they'll place it in an approximate position in the throat and then confirm that it's in the right spot via a direct measure like an X-ray, or an indirect measure like attaching it to a ventilator and checking the inhalation rates of the patient by observing their chest movements. Once they've placed the tube, they'll move to monitoring. So they'll monitor to make sure the tube has stayed in the right spot, and they'll also monitor to make sure if there's any airway complications that are forming. It's the standard of care that we're talking about right now. It's resulting in poor patient outcomes, unnecessary mortalities, increased costs for healthcare systems, and increasing stress on clinicians. It's clear that the tools and methods that they're using right now are too complex, they're taking up too much time, they cost too much money, and it's highly risky for patients and frankly inadequate. Over 30% of intubations will require more than one attempt, and up to 25% of the tubes that are inserted into people will be put into the wrong position, and putting that tube in the wrong position can lead to catastrophic outcomes. On top of that, current monitoring isn't real-time or continuous, and it's leading to delays in the detection of complications. 32% of intubation cases will result in a major complication, something like choking or a lack of oxygen that can lead to brain death or cardiac arrest. Detecting these complications early is especially important for vulnerable patients because they have higher rates of complications and a higher mortality rate risk. This is resulting in unnecessary healthcare costs, it's consuming significant resources and time, and it's exposing care providers to liability and litigation. And that's why we at ELLIS developed the RespiraProbe. The RespiraProbe integrates the latest sensor technology and smart analytics into an endotracheal tube that can provide real-time continuous monitoring for the tube placement, movement of the tube, and other airway complications. It provides first-time right intubation and faster detection of treatable complications that will result in better outcomes for patients and lower costs for hospitals. How it works, the RespiraProbe is inserted into the throat alongside the endotracheal tube, and sensors at the tip of that probe capture data on the progress of that tube into the throat. There's a signal that confirms to clinician that the tube has been put in the right position, and then it provides ongoing data to confirm to clinicians in real time that the tube hasn't moved. Mechatronics then allow the probe to extend into the lower airway beyond the throat to capture real-time data and detect the formation of complications early so that it can support clinicians in their decision-making for how to intervene to manage the airway. RespiraProbe enables safer access for airways and faster detection of life-threatening complications, which will result in better patient outcomes, reduce clinical time and stress, and reduce the direct and indirect costs of care for hospital administrators. This value proposition is protected by patents covering our core hardware and methodologies, as well as trade secrets that are safeguarding our user interface and software algorithms. This is a very large and growing market. The airway management market is over $60 billion and it's growing at over 6% CAGR. This growth is underpinned by aging populations, increased comorbidities, and an increased number of patients that are presenting with chronic illness like obesity that is increasing the need for intubations procedures to occur. We've already engaged with key opinion leaders, customers, and strategic partners, which has provided us really strong early validation and proof of demand, and these partners are very excited to work with us to bring the RespiraProbe to market. Our team combines clinical expertise, engineering and technical capability, as well as regulatory and commercial experience. Lee and I, as founders, are focused on guiding that commercialization activity at ELLIS and putting in place the right capabilities and culture for success. We're pursuing a 510K regulatory pathway in the United States. The funding round that we have open right now will support our initial Q-sub with the FDA and confirm our regulatory pathway, which includes preclinical evidence generation with an animal study and human trials, with a regulatory approval date for 2031. We've identified coding, coverage, and payments in key major markets, and this funding round will also enable us to put together a health economic outcome model, which will demonstrate the value that RespiraProbe will bring to care providers. RespiraProbe is made up of a bedside monitor and probe consumables. We're expecting to achieve industry standard gross margins, and even at a relatively modest penetration rate, we can see a pathway to over $100 million in revenue. We're raising $750,000 in this current round so we can conduct product development, generate evidence, and build out our team. Our milestones include a working beta prototype, the regulatory pathway confirmation with the FDA and for CE marking, as well as completion of our health economic outcomes model and our preclinical evidence generation collection. We're building the new standard of care in airway management. It provides first-time right intubation and faster detection of treatable complications that will result in better patient outcomes, lower costs for hospital, and generate significant returns for our shareholders. I invite you to join us. Thank you.
Thanks, Liz. Closing our mid-morning session, we have Encapsolutions, a company transforming the transdermal delivery market. They have developed a patented skin sync nanofiber platform, which uses innovative electrospinning technology to create dissolvable patches that are significantly more efficient than traditional options. Please welcome its founder and CEO, Chris Barbet.
Right, how are you guys doing? Last stop before lunch. So thank you for sticking around. I'm going to talk about the next generation of transdermal delivery for pain relief. So pain is the most prevalent health condition in the world. Everybody has experienced pain at some stage, and chronic pain really affects a lot of people worldwide. In Australia, about 20% of the population above 55 suffer from chronic pain. In the US, it's 20% of the adult population. It costs a lot of money to society, and the total cost globally is about $1 trillion. Compounding that issue is the opioid crisis. So the opioid crisis, everybody has heard about fentanyl, is affecting prescription of opiates, so doctors don't want to prescribe opiates anymore, and people are left with no treatment. Our goal is to design a safe, convenient, patient-centric solution to chronic pain. So there's a number of delivery for pain, but they all fall short. So you've got orals, you've got injectables, you've got vapes, and you got patches. Patches are good because they are a sustained release device, so they deliver a constant amount of therapeutics over time. But they're very inefficient. If you buy the lidocaine patch at the chemist, you're chucking out 95% of the lidocaine when you dispose of the patch. So we've come up with a patented technology which is based on encapsulation of the therapeutics, so the active ingredient inside biodegradable nanofibers. And the fiber dissolve in contact with moist skin and liberate the bioactive payload over a certain period of time. Having this very open structure means we use the full payload, and that makes our patches much more efficient than existing patches. In terms of products, we've got more effective delivery. We've got non-invasive and convenient solution. It provides 3 days of relief. It's safe and environmental friendly. And those products are made with high quality design, organic products, hypoallergenic patches, and manufactured in pharma-like clean room environment. We've got 2 patent family protecting this technology, and of course formulation and manufacturing that we control because we manufacture ourselves is also an integral part of IP. We've got 2 registered trademarks to protect the commercial activity, and that also gives us the opportunity to do private label manufacturing, or what's called white label manufacturing also, and also licensing opportunities. The team, as you know, the team is always the key to everything. Okay, so as me, I'm been commercializing deep tech technology for 25 years or more. My colleague, Dr. Caffrey, has extensive experience in control drug delivery and dermal systems. And Nigel Pollard, who's also here in the assistance, brings the commercial, OTC and pharma experience and natural health experience. Dr. Phil Kearney, who spent 15 years at Merck, brings the pharma licensing experience, and Dr. Scanlon brings the cannabis and phytopharma experience. So a rounded team with a lot of experience. I haven't added the years because I don't want to insult everybody, but probably above 100 years. The key is always execution and traction and momentum. It took us 3 years from concept, the company was created in 2022, to market entry in the US, which is quite an achievement, and I'm very proud of that. We have built up a manufacturing, so the nanofibrous layer, the critical layer, is made here in Australia. The patch is assembled in the US, gives us logistical and tariffs advantage. And it's an industrial process. We produce 1 patch per second. We've got a product portfolio in the US of 3 natural hemp patches, and we are developing new products for other conditions such as anxiety, sleep, and inflammation. So in terms of traction, commercial tractions, we started having some stocks in the US in September last year. Then we put some product in October on the shelf of 20 stores in the East Coast and Midwest. In November, we created a subsidiary in the US to be able to accelerate growth for e-commerce. In January, we set up a Shopify store and arranged me account. In February, we registered as an Amazon seller, and we're exhibiting at the biggest wellness trade show on the earth in Anaheim in 1 week's time. So from a funding perspective, I've been paying the bills for the last 3 years, and this means that, I have to do some downsizing and things like this. But it also tells you how much I believe in this technology. We're looking for $3 million to finance our expansion of our products in the US natural health market. Some of those $3 million will be to improve our production equipment, to continuous production. We currently make 20 meters batches of patch layer if you want, and we want continuous. That will cut our COGS production cost by half. The key amount of the money is going to go into marketing and channel diversification to boost our e-commerce and to target other segments. We're currently focusing on natural health stores, but we want to go into pharmacies. We want to have, in the US, chiropractors can sell stuff, and spas, etc. And our goal is to reach profitability in 18 months. But the important thing is that we're not just building a product or even a set of products. We've got a platform technology, and we're building a delivery platform across multiple high-value verticals. And you can look at all those apples here. Okay, these are very, very big numbers. And ripe for the taking if you want. The market for transdermal product is exploding. The total market is about $7 billion at the moment, but it's really high growth. Why? Because it's convenient, it's safe, it's non-invasive, okay, and it's compliant with an aging population. So people don't forget their pills, they've got a patch on, people have difficulty swallowing or whatever, it's all right, it goes through another route. And at the moment, we're focusing on B2C, but we're also in discussion with companies about licensing and even acquisition from patch manufacturers. So I will stop now. My time is up. Perfect. Lunchtime.
Okay, thanks, Chris. It's now time for a networking lunch. While you enjoy the catering, please take a quick second to pull out your phones and subscribe to the CapitalHQ YouTube channel. It offers exclusive deep dives into capital raising, the latest in AI, and emerging market trends that will keep you ahead of the curve long after the event ends. Enjoy the lunch, and we will reconvene back here at 1:35 p.m. Thank you. Welcome back, everyone. I hope you all had a productive lunch. We are starting our afternoon session by diving into one of the most dynamic sectors in finance, which is private credit. Please join me in welcoming our distinguished panelists, starting with our moderator, Carly Martin, CEO of VenstraMedical and Venture GC, Dean Weinbrand, Executive Director at Pengana Capital Group, David Toomey, CEO of Deltine High Yield Motel Fund, and Evan Thornley, CEO and co-founder of Longview. Please welcome them all on stage.
Thank you. And just a note, we actually have a bit of a different panel than what we're expecting. We've got David, he's my stayer, and we've got Evan Thornley from Longview, so please give him a big warm welcome. Okay, so jumping right in, just to set the scene. Private markets have never attracted more capital, more attention, or more scrutiny than right now. In Australia alone, private credit has grown to approximately a $225 billion market. Globally, this asset class has quadrupled in a decade. And yet most investors, even sophisticated ones, would struggle to explain exactly what they own, how it's valued, and what happens when things go wrong. Globally, the signals are worth naming. We've got shadow default rates when payment-in-kind loans are included and running at around 6%, again at a reported rate of around 2%. Covenant protections are eroding, and spread compression from something like 50 to 75 basis points over the last 18 months means investors are accepting less return for equivalent risk. Today I have two guests who sit at uniquely interesting points in that system, not in private credit, but in what comes next. We've got an operator who generates returns through acquiring and running real assets, and a builder who's creating an asset class that barely existed in Australia. I want to start by letting each of them introduce themselves and explaining their angle. Let's start with David.
Thank you very much, Carly. Thanks very much. My name's David Toomey. I'm the CEO of Deltine Capital. We run a motel fund. So we've found a niche in Australia. Motels are the only commercial property that I've found that are still yielding over 10%. But it's a really attractive niche for us because it sort of flies under the radar of the institutional investors. So it's two transaction sizes of between 5 and 20 million, too small for institutions, too big for private investors. And the motel market is really fragmented, so nobody owns more than 1% of all the motels in Australia, which is very unlike pubs and childcare and storage. So it's something we're going after with really attractive yields, really established buildings, really quality assets. And it's a vanilla buy and hold property fund, so nothing fancy. So keep it simple. Thank you.
And Evan?
Thanks, Carly. Yeah, look, what we do that will be familiar to private credit investors, and we certainly have a lot of private credit investors who also invest with us. Private credit has debt-like security and debt-like returns. We have debt-like security but focus on equity-like returns, but let me say where the debt-like security is. So we invest solely in existing family homes. So a little $12 trillion asset class you may be familiar with. We invest solely in existing family homes. We don't do anything in construction or development or any of that stuff, just existing family homes. And we typically have protection for our investment with occasionally a first mortgage, usually a second mortgage, but given that most of our clients are in their 50s, their average LVR on their prime mortgage is 33%. So we sit above that in the capital stack, but miles below where even a prime residential mortgage lender would sit. So that's our debt-like security that would be the first thing that would concern any private credit investor. But this is a very, very stable asset class. The maximum peak to trough movement in house prices since before anyone here was born is 12%. And that took 2 years and was recovered in the third year. So we're in a very non-volatile asset class, and we have very strong protection low in the capital stack. That would be familiar to you as private credit investors, but pretty much everything else is different. So we invest to get a share of capital growth. If you try and get capital growth in one house, that is speculation. If you harvest capital growth across hundreds of homes, that's a strategy. So that's what we do. We co-invest with homeowners. We give them access to an amount of capital that is freeing up their equity, they give us a disproportionate share of their future capital growth. So
Thank you,
our
Evan.
position is debt-like security. Our growth is a 3x multiple on the underlying growth of the home.
Thank you so much. So I'm going to jump into a bit of a state of the union in private markets in 2026. So David, as our operator in the room, you find assets, acquire them, run them, and generate returns. Global private markets boom has poured an enormous amount of capital into this asset class. What does the capital environment look like from where you sit, and is all that money making your job easier or harder?
Well, it's making it easier, of course, and it's black and white compared to this time last year. If you recall where the world was this time last year, there was 2 wars going on. Trump was throwing his toys out of the cot with tariffs. We had cyclones hitting Brisbane. We had state elections and federal elections, and we were calling investors asking them if they'd like to invest in our fund, and they were all just sitting on their hands. And that was just for the first 3 months of last year. And then the federal election came and went, and people just started making decisions again. It's always baffled me why the federal election is such a big deal in people's minds, and I know there are changes in the economy because of it. But we've got a long-term buy and hold fund, so it doesn't change that much based on the government of the day. So we're seeing this year, even after Christmas, a stark contrast, and really the capital is flowing. We've raised record amounts of capital in the first couple of months of this year, or the first 6 or 8 weeks of this year. And we want that to continue because it makes our job easier, of course, in deploying that capital. So the investors are responding to a couple of things with us: the track record that we've achieved, the distributions that we're paying, and also I think, like you say, the macro sentiment is in our favour as well now, as it wasn't this time last year.
I'm going to pass to you, Evan, on a slight additional question there, because what we were talking about before the session was around liquidity and contract lengths. I wanted you maybe just to describe for us, like, what investors typically have impressions about your long contract terms, and how do you achieve liquidity in your product structure through what you do?
Yeah, so look, I guess for want of a better word, traditional private credit environment, whether that's construction credit, for example, with new developments, or sort of short duration corporate credit, the typical duration is probably 18 months to 3 years. When we co-invest with a homeowner for the individual homeowner, the typical duration is more like 7. Mm-hmm. But what you then do is just have a rolling portfolio where 10 to 15% of the portfolio realises every year. So we're invested in about 170 homes now across Sydney, Melbourne and Brisbane. We're doing about 5 or 6 a week. So while the average duration is longer, the liquidity profile that comes out of the churn, either from people selling their homes or people buying out our contracts, means that you've actually got a surprisingly high cash flow coming out. I think that's counterintuitive for people by just sequencing across that rolling churn. Yeah.
Okay, so I'm going to move to another piece now. Evan, you're not trying to generate yield from a tenant, and you're not lending money to a borrower. You're co-investing, as you say, alongside the homeowner who retains control of that property. That's a fundamentally different model to what most in the audience will have seen. So how does that model perform in the current environment, and what's the investor actually getting that they can't get from a traditional or a conventional property fund?
Yeah, look, I guess the examples you gave, commercial properties, all yields and whales, mm-hmm. and private credit obviously is really about a spread to BBSW that you think, the risk return profile of that spread makes sense to the investor. We've sort of been through the golden age of private credit in this country over the last few years, though I think anyone who reads the Fin Review knows that some of those wheels are falling off. And partly, I think, because, and I know David's sort of in a particular very powerful niche, but a lot more money is chasing the same opportunities, I think, in, for example, construction credit, and the risk is that you get an asymmetry in the risk return there if you're not careful. that's just really not the risk exposure that we're focused on. Our risk exposure is not to the credit quality of a counterparty. Our risk exposure is upside exposure to the capital growth in a home. And given how low our clients' mortgages are, I mean, there's the de minimis risk that they'd ever be sold out of their home. It's a question of how do we get balanced exposure. Again, if you're hoping for one property, maybe it's the right one, maybe it's the wrong one, maybe it's in the wrong city, maybe it's at the wrong time. But if you're exposed across, multiple price points, multiple cities, multiple housing types, we're really invested in suburban land, and suburban land goes up in value because we keep putting more people in the same cities. That's the basic thesis.
Thank you. So if you're an investor in this room and you're kind of spoilt for choice over the last couple of days and wondering where to put your money, what's one thing you notice through the conversations you have with investors that they don't understand and you wish they did?
Yeah, I think it's pertinent that they understand in the underlying business model of the fund. So this is partially a private credit discussion, but also private assets. We are, the investors in our fund are in the equity, so we're not a credit fund, we're an equity fund. We get our debt from St George Bank at an LVR, average LVR of about 45%, so we set the LVR low, so it's just a pure senior debt play. And then the investors in our fund own the equity and the equity upside. And so investors in our fund get 10% over 10% annual income paid monthly, and there's a 10% equity upside. So the people that invest in our fund get that upside when you compare to private credit. But what I wish they would understand, I think, is what some investors say to us, well, I can get 10% in private credit. And I said, well, that's right, but you're taking on development risk. Did you understand that? Because that was the example that they were using. Or you don't get upside. Yes, the 10% income is equivalent, but we've got a capital growth upside on top of that. So when you're looking at the different funds, there's different aspects of those funds you really need to consider. You need to understand if there is development risk or turnaround risk. You really need to understand where that investment sits in the capital stack, whether it's first mortgage, second mortgage, preference equity or equity. You need to understand the governance structure, whether there is a governance structure or whether the fund manager is the trustee and there isn't a true distinction there. You need to understand whether they're funding their income out of the money they raise from you or whether they're funding their income out of operations. So these are fundamental things, and I wish investors to really understand those components, because when you start adding those things up and comparing funds across the board, it really starts to show where you should be putting your money and what the true risk profile of some of these investments.
I think that's a really good segue into my next question, which I think builds on this. So, honest risk, okay? Private markets have operated in a pretty benign environment for a long time now. Low defaults, rising asset classes, strong demand for yield. But globally, those signals are shifting. So, I want to look at the idea that if shadow default rates are rising, covenant protections are eroding, and some liquidity structures are being tested in unique ways that haven't been tested before, what keeps you up at night? And looking from your unique lens, I might start with Evan. What keeps you up at night in that environment, and what are you actively doing to hopefully mitigate some of those that ambiguity and uncertainty coming down the pike?
Yeah, look, I guess the reason we've chosen the strategy we have is that we have great respect for those risks. And I have even greater respect for the good private credit operators who manage those risks, because they are significant and multifaceted. We're not that smart and we're not that brave. So we've tried to position ourselves in a strategy that I don't have any counterparty risk of whether they'll default on me because they don't owe me any money till they sell the home. I don't have any construction risk because I invest in robust older dwellings on well-located land. Most of them are more than 40 years old. I have 40 or 50 years price history on them. So I joke with my global equities counterparts, I know you've got someone who gets up at 3 a.m. to check what Trump said, check what's happening in the Ukraine, check what's happening with the Aussie dollar, decide whether you're in or out of the Magnificent Seven. Don't get me wrong, I've got someone who gets up at 3 o'clock in the morning too.
We've got algorithms for that now.
Yeah, we do. But that person checks that the grass is still growing, the owners are still asleep, and then they go back to bed. So I'm being slightly facetious, but the point of our strategy is not to expose ourselves to all of those other types of risk. Be in a very stable asset class, be in a very secure place in the capital stack. And then I think most people think capital growth is this sort of mysterious speculative thing, and at the individual property level and for the individual person that's true, but as a systemic operator it's just not. I mean, it's, you know, we've analysed every sale price of every property in Australia for 50 years. We know what drives capital growth and what doesn't. We know that the single most important driver is what proportion of the value of the home is the value of the land underneath it. If that's above 80%, you're making a flying start. If you then adjust for key locations, you can backtest this for 50 years. We know what drives capital growth. So at a systemic level, you know what the answer is, and otherwise we try and stay out of any other sort of risk except predicting capital growth.
Thank you. David, did you want to comment on that one?
Yeah, I think what keeps me awake at night, well, I think, again, a bit like Evan, you know, there's not a lot that can go wrong. You know, there's a big wave coming, an onslaught of technology change with AI, and a lot of businesses and a lot of startups will feel that, you know, really wonder how it's going to impact their business, and a lot of us don't really know. And however, in our business, it's the accommodation business, and doesn't matter what happens in the AI world, people will still need to sleep and they'll still like to travel. So it won't be disrupted except for our operations, which will get more efficient through booking systems and through customer service. I guess the elephant in the room is people try and catch me out with the big one, which is COVID. What happens if COVID comes back? Because that was hard for the hospitality industry, and we're in accommodation and we don't do food and beverage, so it's quite simple. And so when I was researching this fund, I really dug into those 2 years, which had lower occupancy. But what I found was, and I asked the bank manager, I asked several banks, how they acted in that period, and they said they put repayments on hold for 18 months and then added to the term. So the motel operators and owners didn't need to, you know, continue their debt repayments. And a lot of the expenses in a motel you can stop. They're all variable expenses. The other aspect to it as well about having a diverse portfolio, diversification fixes most things, as Evan alluded to. Yes, there might have been a lockdown in Victoria, but it was only in the city and not in the regions, or it might be in Queensland this month and Victoria the next month. So if you have a diverse portfolio, there'll be always a percentage of those assets that are operating and propping up the rest. And yes, you might take a lower return for a while, but it's not devastating to the asset value. In fact, it was the best thing to happen to the motel industry. If you have a look at the average room rates in the motel industry, it was going up at a marginal level for a decade. But as soon as COVID ended, the whole population went travelling into regional Australia, discovered how beautiful it was, and are continuing to travel in regional Australia. And the demand and the lack of supply through high construction costs have just kept those rates higher. So actually, the other side of COVID, the value of these motels increased, and it was actually a good thing in the long run. So that's a bit of a perspective about you know, the worst that could happen, I guess, in the market, and how it is a robust asset class for those big shocks.
Thank you, David. And I think just to comment on this piece around technology, I see this more from an operator side of things, where technology's always been an opportunity, but now the rate of opportunity is just so much higher. So I think this is definitely the age of the expert, and you've got really great skills and experience, and you know how to prompt. You can build systems that operate in a way that you're really only limited by your imagination. So thinking about the unique opportunity of the rate of technological change, what are the skills within your team that you're really looking for in terms of preparing for this huge rate of change?
Yeah, I think it's a good question, and I think you're right. You know, somebody who knows how to change with the technology, but also sees the possibilities. Obviously there's possibilities in our market where it can help with administration, booking, bookkeeping, but you go to the next level and there's AI bots, and I've tested these AI bots who can very capably have a conversation with someone and take a room booking, ask about room type, ask about dates, have a good conversation, and it's all from an AI bot. And then being proactive in terms of customer service, as soon as somebody checks out, we can have the AI bot call them and ask about their experience, and was there anything that we could do better? What improvements do they suggest? How was their stay? And if there was someone leaving who was annoyed because the TV was flickering or something like that, then we sort of diffuse that situation before they get too upset, and we fix it. And those calls can be automatic, and they can be conversational and unobtrusive, and for people who have something on their mind that want to share, they can share that. So that's the next step as well, and it's not too far away. It exists now. It's just a matter of integrating that stuff. But I guess beyond that, it's also the investor piece, an analysis of the risk and the opportunities, and comparing that to other opportunities in the same market and other assets in the market as well. So on the investor analysis side as well. So there's a lot of
the
good
data
things coming.
analytics capability, given the rate of technology change, is just incredible. So you're really only limited by what kind of data you're looking for, how clean is the data, and then how do you analyse in a way that really lifts the lid on possibility. Evan, do you have any thoughts on that?
Yeah, and again, for those who heard me this morning, I put the first Australian tech unicorn on NASDAQ 27 years ago, so I'm not a technophobe. But again, we try and limit the moving parts in this business. We're in family homes. So what matters to us is really just asset selection. If we pick the right homes, our contract mechanism is so powerful, we deliver high teens returns on the risk profile of a residential mortgage. So it's all about asset selection. So that is about art and science. It's firstly, obviously, about data analytics. So I want people that will be governed by the data, not by the mythology. But secondly, it's actually about field experience. It is a completely heterogeneous asset class. Every home is different to every other home. Any real estate agent who's been in the industry for decades will tell you that, and it really matters. You cannot do this from a beanbag in Surrey Hills or Cremorne, right? The data science is really important, but field expertise is really important. And look, you all know that AI is an incredible productivity tool for people who have decades of experience, and a hallucinogenic drug for people who don't and think that it's going to give them the answer. So if you ask AI engines about capital growth in residential property, they'll principally repeat back to you what they've read in newspapers and what all the other nonsense that's written about this question is out in the marketplace. And most of it's wrong. So if you know nothing about it, you'll take that hallucinogenic drug because it sounds like it knows what it's talking about, and you'll be completely dead wrong. So, like for example, almost a large proportion of people in this room that I talk to in the investment community live within 15 kilometres of the CBD of the city they live in, and they will faithfully assure you that all of the best capital growth is for those lovely people who live in the leafy greens within 15 kilometres of the CBD of their city. This is such an unchallenged assumption that you can read it everywhere, and you can find any AI bot in the world that will tell you that. Unfortunately, it's simply not true. Just completely not true. It varies, by the way. In Melbourne, for example, the rail corridors have outperformed the leafy greens consistently for 25 years. Sydney's very patchy. Brisbane actually is, on average, more inner than outer. But it's just facts, guys. So AI is incredibly powerful. It makes our buyers advisors who've bought 2,000 homes each in their local patch and know every home, every street, every agent, it makes them more productive and more consistent and higher quality. It makes our data science team much more productive. We can analyse new factors all the time much more quickly. But it's only useful when you've got people who actually know what they're doing, and it makes them do it better and quicker, not people who don't know what they're doing.
I think just one thought to close is, I look at this from the perspective of what are those missing pieces, the secret sauce you can really kind of add to a business to accelerate growth. The two things for me are, if you can't afford the right staff, hire those staff members fractionally. take a slither of someone excellent than, you know, a whole team of people who are not, and then power them with great tech, because I think that really does give you so much output, and it's definitely the age of the expert, unfortunately, not the junior, so we've got to find ways to bring the next generation through, but that really is a huge opportunity, particularly when businesses are going through periods of significant change or encompassing things that just they haven't, you know, encountered before. So thanks so much for giving us a unique lens on our topic and being very flexible with me today. Really appreciate it. And thanks so much for your time, Evan and David.
Thanks so much, Carly. Thank you. Thank you, everybody.
Once again, thank you to our panelists, Carly, David, and Evan. Next, we have a special featured presentation from Flanders Investment and Trade. For those who may not be familiar, Flanders Investment and Trade is the government agency responsible for promoting sustainable international business in Flanders, the northern region of Belgium. Our next speaker here is going to share how they are positioning the region as a premier global gateway for innovation. Please welcome Bart Boschmans, Foreign Direct Investment Manager from the Brussels HQ of Flanders Investment and Trade.
Well, thank you very much for the introduction. My name is Bart Boschmans, and the pronunciation was actually quite good. Probably I'm the speaker that comes from the most remote location to this conference, all the way from Brussels, together with my colleagues here, who I will introduce a little bit later. So I'm not presenting a product or a solution like most speakers, so you will not see any forward-looking statements. I'm actually here to present to you the region of Flanders, and actually more specific as a potential investment location for Australian companies. Now, maybe a little bit more information on, I don't know how the pointer works. All right, easy. So I've been speaking to a number of people yesterday and today, and Belgium, let alone Flanders, is not very known here, so just some basic facts from my side for you. So Belgium is in the heart of Europe, a federal state, just like Australia. We have 3 regions. In the north we have Flanders, mostly Dutch-speaking region, with about 60% of the population. There's in the middle, and also it's both the Brussels region as the capital of Flanders and Belgium, to make it a bit more complicated. And in the south, there's the region of Wallonia, mostly French-speaking. So population is around 12 million, and most of those, or almost 70%, live in Flanders. Now, some key facts about Flanders at a glance. As a location towards companies, we can really give you a great access to the European market. We're in the middle between France, Netherlands, Germany, and the UK. And if you see that shaded area, we also sometimes refer to it as the blue banana. It's actually the economic and industrial heartland of Europe, ranging from North England to north of Italy, with Benelux in there, Paris area, Rhine-Ruhr in Germany. And it's about 100 of the 450 million European Union inhabitants, with almost 60% of the EU's wealth. So a tremendous concentration of purchasing power there. Now, one of the taglines we use is come for the market and stay for the knowledge. It's true we do not have the natural resources, so these are our natural resources, the brains, our knowledge. And we take pride as a region that we spend 3.5%, and the government's intention is to even increase that, 3.5% of GDP today to R&D. That is second highest in Europe. We also refer to ourselves as being sort of the control tower of Europe, as we house the seat, the headquarters of the European Union and NATO. So it has the second largest center in the world for diplomats. Almost 4,000 diplomats work in Brussels. And of course that means that you would be very close to the legislative and decision-making bodies. Easy access to Europe's main cities. I suppose some of you have been to Brussels or the area. So we have very easy train connections to some of the major surrounding cities. It's between 1.5 hours and 2 hours to London, Amsterdam, Paris, and then flight time to the bit more remote cities, Berlin, Rome, and so on, is mostly 1 hour to 2 hours. So very easy access. You can do easily a meeting in London, leaving in Brussels, and be back in the evening. The location means that we are very well positioned in terms of logistics, well connected to Europe and the world. So we actually host around almost 700 European distribution centers where companies store their goods and distribute them from there all over Europe and the world. To name a few, Nike, DHL, Toyota. There's 4 international airports, with Brussels, of course, being the main one. I would also like to mention, referring to yesterday's topic of life science, that Brussels Airport is a major hub for cold chain pharma logistics. And we have also 3 international ports. Biggest one of them is Port of Antwerp-Bruges, which is the second biggest port in Europe, and is a real hub for chemical and cargo and roll-on, roll-off traffic. It's also the second biggest petrochemical cluster in the world after Houston, so a huge concentration of companies there. Now, when I told my boss I would like to go to Australia for this conference, she said, well, why you want to go? Because everybody's always a bit jealous if you go to Australia. And said, well, look at the themes of Emergence. They fully, or they align for a great deal with the themes that are presented here today, tomorrow, and yesterday. Take yesterday, topics like biotech, medtech, life science in general is really where we are strong at as a region. It's really a thriving system of young scale-ups, established local companies and multinationals that cross the whole value chain from research, development to commercialization. And some of the main advantages we offer in that area are a speedy procedure for clinical trials, a nice set of R&D incentives for companies that are active in that sector. And actually, Flanders has the highest biotech market capitalization in Europe, which would surprise you maybe for a relatively small region. There's Flanders Make, which is the research center for advanced manufacturing, Vito for new energy, and I would particularly also want to highlight IMEC, which is the world-renowned independent hub for nanoelectronics and digital technology. It is a spin-off created already in the 1980s from the University of Leuven, which is one of the oldest universities in the world. And it hosts, it's actually wrong what's here, should be a 5,500 international researchers researching and developing the future technologies in terms of microchips. And they already had also 130 spin-offs, and they support scale-ups, startups via the IMEC Startup Accelerator. Beyond chips, they also invest strongly in smart health, sustainable energy, and intelligent mobility. I said it before, talent is for us a crucial element in keeping up. It's crucial for our welfare and as a development motor for our economy. And consistently, our workforce ranks high worldwide in themes like mathematics, science literacy, and reading skills. I would also like to highlight that just by our location, people are, or a lot of people are multilingual because we're somehow on this crossroads of the Germanic, the Roman, and the Anglo-Saxon culture and business culture. So we have a multilingual workforce, which of course is very attractive for foreign companies. So our proposition to Australian companies is strategic access to the EU market, a market of almost 500 million customers, consumers, world-leading research institutions, a highly skilled multilingual workforce, and in these turbulent times, not unusual or not unimportant, a stable regulation with investor-friendly tax incentives, combined with strong ecosystem in biotech, AI, digital tech, and sustainable manufacturing. Now, what are the investment opportunities for companies, investors from Australia? First of all, strategic industrial or manufacturing projects. There are already a number of Australian companies active in Flanders. For example, Cochlear as their technology center in the region of Flanders, their European technology center. The Sonic healthcare company, huge Australian healthcare company, has a second biggest pathology and blood sample lab in Flanders. So we can offer companies also R&D partnerships with these research institutions, and they can often benefit from grants and subsidies from our government. There's investment possibilities in high growth scale-ups, corporate venture co-investment opportunities, and there's private equity VC funds where that also looking for additional investors and collaboration with foreign partners. Yes, I will wrap up. These are a number of incentives that we are able to give. Of course, we'll not go into detail. We have actually a booth outside. You see it's in the bright yellow, so if you're interested and you want more information, I will be there together with my colleague from our Melbourne office, Luca and Dolores. Thank you very much, and looking forward to meet you later at our booth.
Thanks, Bart. And that is Flanders Investment and Trade. Now we turn our attention to the cutting edge of digital finance. As the global economy moves towards instantaneous 24/7 transactions, the need for a trusted, stable, and regulated bridge between traditional and digital currency has never been more vital. AUDD is Australia's regulated Australian digital dollar stablecoin. This is a fully reserved 1:1 AUD-backed stablecoin issued under an Australian financial services license. To discuss how this innovation is shaping the future of the Australian financial landscape, please join me in welcoming the Executive Director of AUDD, Peter Cook.
Good afternoon, and thank you for attending and listening as we talk about stablecoins and the future of digital finance. Australia's digital dollar is here, not as a concept, not as a white paper, but a live, regulated and scaling part of the future financial ecosystem and infrastructure of Australia. We are very focused and are actually implementing, building the financial infrastructure that's needed for the future of programmable money, which is going to be a major driver of efficiency and services going forward. Today I want to show you why this matters, not just for crypto, but for the future of finance. Let's zoom out for a second. Stablecoins have quietly become one of the most important shifts in global finance. Major payments networks are integrating them. Banks are integrating them. Settlement is occurring in a programmable fashion 24/7. Trillions of dollars are moving every year via stablecoins, completely changing how financial infrastructure works. It's core financial infrastructure, quickly rebuilding payments networks, banking services networks, financial transaction types, systems, settlement. And just as an aside, stablecoins are not crypto. Coming back to Australia, the Australian dollar is one of the most traded currencies in the world, 6th or 7th or 8th, depending on who you ask. Over $1 trillion moves in and out of Australia every year. Trade finance, remittances, bill payments, capital transactions. We can now, with stable coins and re-engineered infrastructure, speed up, improve the transparency, the efficiency and productivity of such payments. Digital asset adoption is growing rapidly, both globally and in Australia, and stablecoins are a driving element to enable that. But despite all of that, there was no scaled, licensed Australian digital dollar operating inside the regulatory perimeter until now. AUDD is the Australian digital dollar, fully backed 1-for-1 by Australian dollars in segregated client accounts in Australian banks. We're regulated, operating across multiple blockchains, Stellar, Ripple, Ethereum, XDC, Hedera, to name a few. An Australian one, Red Belly, recently integrated. And we've built our Australian digital dollar for institutions and developers. Institutions so that they can improve how they deliver services at scale. Developers so that they can bring through new services, new concepts, new productivity for our nation. We are driving millions of dollars of transactions every day. And so I put to you that we are delivering institutional grade digital money today. For us, a defining moment. We've been granted our Australian Financial Services Licence by ASIC. ASIC has now started to focus on regulating digital companies, and we are one of the first companies to get an AFSL for stablecoin services. It matters that we're licensed. I was in Hong Kong last week. Virtually every conversation I had at a digital asset conference is about, okay, you're licensed, we can work with you. They understand that it means that our client funds are protected, we're operating under standard AML, KYC type procedures, that we are a serious player that's invested in regulation. But even more important, they recognise that we've been operating for over 3 years. We've processed more than $1.5 billion in payments. We're doing a couple of $100 million of transactions or payments every month. So we're not new. We have proven, trusted technology and services. So our infrastructure is proven, we're fully licensed. And so we say that the first scaled, regulated stablecoin in Australia begins now. And we're not working in isolation. We are deeply integrated into both traditional finance and digital finance ecosystems. We're live across multiple exchanges, Coinbase in particular, SwiftX in Australia and others. Custodians working with us, liquidity providers, embedded into decentralised finance pools. We are tightly integrated into the digital asset ecosystem and also traditional finance ecosystems, enabling liquidity, distribution and opportunity for new services. We are embedded in the infrastructure layer. We see stablecoins as an infrastructure component for the future of financial services and payments and banking. With this regulatory clarity, programmable money becomes something people can think about. Essentially, not just a dollar, but a dollar that can be programmed via smart contracts, software, platforms to deliver new services, faster services, more transparent services. We can move money cross borders instantly. For remittances that used to maybe take 2 days, 3 days, 7 days, that can be brought to a 24/7 zero time. Imagine a stockbroker settling a T+0 transaction in the US, no longer needing to have funds in advance ready to do that settlement, but can be settled now 24/7. Streaming international payrolls in real time. Imagine a workforce spread across multiple countries, the gig economy, and essentially launching one payroll service to deliver payment from your centralised treasury globally. So stablecoins enable the reduction of friction in financial systems, speed, efficiency and transparency. We'd say we're not a trend. Stablecoins are actually the major component driving future infrastructure of financial rails. So, heading to scale. We built the foundation, we've been operating for 3+ years, we're licensed. Scaling enables us to drive deep institutional liquidity, more strategic global partnerships. We have many today, but we can scale that and become the significant driving force for restructuring and improving financial rails. We'll expand across financial borders, APAC in particular. And as we enter the next phase, we're preparing for Series A, and conversations are already underway. Oh shit, I've just killed that somehow. In closing, stablecoins are the infrastructure layer of modern money, and AUDD is how Australia is participating. Thank you.
Thanks, Peter, and that's AUDD. Moving into our next presentation, we have Cromwell Property Group. They are showcasing a prime Brisbane CBD office fund that offers investors a compelling combination of stable income and value-driven growth. Please welcome their CIO, Rob Percy.
Hi, everyone. Mine is a significantly more lower tech thing than everyone else you probably is speaking to today. So I'm Rob Percy. I'm the Chief Investment Officer and Head of Funds Management at Cromwell Property Group. I think everyone's seen this before, so we can probably move on. Yeah, so Cromwell is a listed real estate group with quite a long history. We've been in business a long time, creating essentially wealth management products through trusts and syndicates for our investors. The business is fully integrated, so we do all of our own PM and FM all the way through to investment management, and we're currently managing around $5 billion worth of assets across Australia and New Zealand. The business serves principally retail, wholesale and strategic institutional investors focused on traditional Australian real estate sectors of industrial, office and retail. Like I said, while property may be viewed as less exciting than some of the other industries at today's conference, the sector is the building block to the Australian economy, and the property sector offers investors strong cash flows that are supported by industries across the economy, and therefore by definition less risky than other types of single investments. The product that we want to talk about today is one of our latest products. It's a prime example of how property investment can offer superior returns with lower risk. The Cromwell Creek Street Investment Trust is a vehicle primarily for wholesale investors. It intends to acquire an asset in Brisbane CBD at 100 Creek Street, and this will provide exposure to the Brisbane real estate sector, which is currently Australia's standout office market. The investment represents a quality asset at cyclically attractive pricing and in a market showing compelling fundamentals. The investment targets a distribution of 8% paid monthly and a target equity IRR post-fees pre-tax of 15% over a 5-year period. Distributions from this investment are fully tax deferred for a minimum of 2 years. The Brisbane CBD real estate market has been expected to continue its growth strongly all the way through to the Olympic Games in 2032. Brisbane has shown the best relative vacancy to its 15-year history for all Australian CBDs. And a key contributor to this outcome has been Brisbane leading all Australian major cities on office job growth, driven in part by the significant infrastructure spend by the Queensland Government. This is translated into Brisbane CBD effective rent growth growing by 35% over 5 years, which is significantly better than all other CBDs combined. A key driver of Brisbane's growth is the lack of supply over coming years, which is forecast to be about 1/3 of the 20-year average. This reflects the fact that it's too expensive to stack up new office developments currently. Most of the government infrastructure investment is cited as pushing up demand for construction resources and forcing up construction prices. And rents and pricing on real estate is just not high enough on existing products to compensate developers. Strong macro tailwinds in the form of infrastructure investment and the 2032 Olympics are expected to boost economic growth for Brisbane. We also expect that the Olympic spotlight on Brisbane will be positive for the exit of this investment in around 5 years' time. So we think that Brisbane offers a compelling cyclical opportunity and is the right market for real estate investment at the moment. If I focus on the property itself, 100 Creek Street has many features of an attractive property investment. Firstly, the location is prime with exceptional amenity available for occupants. The price is substantially below replacement cost, reflecting great value. The asset is a good leasing performer and occupancy is outperforming the prime grade market in Brisbane. The expiry profile of the asset is well positioned to capture Brisbane's higher market rent growth, resulting from the next 5 years' worth of growth. The design of the property appeals to small and medium-sized tenants under 1,000 square metre tenancies. This segment has reported the strongest growth in space demand over the last 5 years. The property has 45 quality tenants, which provides a diversified income profile, minimises individual tenant risk. So we believe that 100 Creek Street is the right property to capture the strong Brisbane market opportunity we're currently seeing in Australia. And in summary, the investment case for this opportunity is to acquire a quality asset at cyclically attractive pricing and in a market showing compelling fundamentals. Just as a reminder, distributions are forecast at 8% paid monthly over the 5 years, tax deferred for a minimum of 2 years, and a 15% equity IRR over a 5-year period. We are currently capital raising for this product at the moment, well progressed, and looking to close in early May 2022. So my colleague and I have a little booth out the side. If you are interested in any further information, please feel free to come and have a chat.
Thanks, Rob. Next, we have Be Rewarded Group, a company redefining how businesses engage with their customers through purpose-driven technology. They specialize in delivering scalable loyalty solutions and global social impact rewards. To share their vision for the future of customer engagement, please welcome their Managing Director, Ivan Schwartz.
Good afternoon, everyone. Thank you all for being here. and to giving us this opportunity. A special thanks to Steve, to Jackie and the team at Wholesale Investor. It's been a real buzz working with you guys. So welcome to Be Rewarded Group, a unique opportunity to achieve an above average return and to do some good in the world. Firstly, a little bit about us. We are what our accountant calls a consolidated entity. And that, for those who understand consolidated entity, provides some very effective tax advantages. It has also enabled us to work with Austrade and the R&D program, which has been very beneficial in getting us to this point. Our legacy is through Be Rewarded Pty Limited, which has been around for about 20 years, where we've earned our stripes. More recently through Points for Purpose in Australia, Pty Limited, and then our most recent development, which we're particularly excited about and why we are here today, is to actually take Points for Purpose Inc. to market in the USA. So what drives us? And I'd like to, if you will allow me, I'd like to just read this statement. Our goal is to make a measurable difference in the world by providing our seamless and scalable global digital marketplace that enables people to save, businesses to grow, and communities to thrive. And this slide talks about how our platform works. And just to take you quickly through this, businesses join by registering their EFTPOS terminals and subscribing to our marketing services model. Shoppers join by linking their payment cards in-store, online, or via their mobile phones. This, ladies and gentlemen, is the future of loyalty. Members earn cashback wherever they transact with participating businesses via card linking and online cookies. So this is both bricks and mortar as well as the world of online. They spend, they earn cashback, they save, and or they donate their cashback or a percentage thereof to their favorite cause. We call this micro-philanthropy. Businesses are supported to grow by increasing the customer lifetime value of their customers, the lifetime value of their customers, and by attracting new customers. We have 2,500 charities on our platform in Australia, reaching about 3 million people. In the US, we have every single charity on the IRS database, 1.8 million charities. And last but not least, worthy causes are able to expand their offering, making the world a better place. A few quick statements within the time that we have on the global marketplace. And I've just picked off 3 quick statements here just to give you an idea of the size of the loyalty market. And then we'll go into why now. It is estimated that 48 trillion reward points worth $360 billion lie dormant on the balance sheets of our major financial institutions, retailers, and airlines. I'm sure you all have lots of Qantas frequent flyer points going nowhere. Then we move to the marketplace. 71%, according to Deloitte, of Generation Z and millennials are willing to pay up to 10% more for products and services that support a social purpose or cause that aligns with their interests. Quick example, my eldest daughter just moved her super fund. I asked her why. She said, "Dad, I did this because the firm that I've gone with compares with the best that I was at, but they invest in what I believe in." And there are a hell of a lot of people that fit that category. And of course, charities, with times being tough, are facing precarious times. And we have a micro-philanthropy option, as I said before, that enables that to happen seamlessly without consumers having to put their hands in their pockets. So why now? We have a number of banking people amongst us, but certainly if you read the Fin Review, you will understand that interchange revenue is under the spotlight. That interchange revenue or merchant service fees have been the fuel for a lot of loyalty and rewards programs out there. They will either disappear or be removed significantly in the period ahead. Number two, there are typically low engagement levels in current rewards programs. I don't even use the word loyalty program anymore because loyalty has been a very overused and abused term, certainly in this country. We have enough case studies that proves that when it's done well, it can be measured to the dollar in terms of its impact on bottom line. And then last but not least, this mismatch that I was talking about with my daughter. Personalization at scale is the future of loyalty, and certainly that is where the marketplace is going. Some early wins, and I'm just watching the clock. I feel a little bit like I'm at the Winter Olympics. But, you know, we have agreements with all the major card providers. We have a white label platform that is now card-linked approved both here and in the US. We have over 5,000 online merchants with over 1 million not-for-profits, as I mentioned, in the US. We have US consultants appointed in our two primary markets, being credit unions and grocery retail. And we have just got our first gym junkie in the US who is very excitedly going after the gym market in America. And then last but not least, we have launched our first pilot program in Miami and Florida, and our goal is to cookie cut that across the US. What is our growth strategy? Really, just to expand some of the footprints that we have in place already. I'm not going to read that all out, but certainly you'll see that we are well on our way. Here's a quick snapshot of our projections. At a 3 times multiple for a business like ours, which is very conservative, we're looking at a $22 million valuation within the next 3 years. And then at 6 times, which gets closer to where it is, those are the kind of numbers that you are looking at. Our ask to you today is through a safe note. We had originally looked to raise 2.5. We've already raised a little over 10% of that. We are willing to cap our valuation by financial year 2029 at 15 mil and offer a 25% discount to those that come into our safe note right now. Our 3 key takeaways as I wrap up: a significant market out there, a highly scalable platform, and the opportunity to make a difference. Thank you very much. We invite you to participate in our offer, to invest in a powerful fintech, and to make a difference in the world. Thank you.
Ivan. Our next presentation is from Rhodes Asset Management, a specialist fund manager focused on delivering consistent monthly income. Their strategy centers on a diversified portfolio of short-term mortgage-backed property loans, providing investors with a secured and predictable yield in a fluctuating market. Please welcome their investor relations manager, Stephen Kroll.
Have you ever wondered why Australian banks make billions of dollars of profit every year and they never make a loss? We all know banks make their profits from the difference between what they charge their borrowers and what they pay their savers and investors. Wouldn't it be great if we could be the bank? Let's just hold that thought. Good afternoon, everyone. My name is Stephen Kroll. I'm the Investor Relations Manager for Rhodes Asset Management. We're non-bank lenders as well as fund managers. So all the money that gets invested with us, we then on-lend that money, and every loan that we do is secured by a registered mortgage over the borrower's property. So we don't do any unsecured loans, we don't do any car loans or personal loans, we don't do any unsecured business loans, we leave all those loans to the banks and other providers. Everything we do is secured by a registered mortgage over the borrower's property. So it's considered to be a very low risk investment and the returns are quite good as well. So we pay our investors from 7.85% and up to 9% per annum. So we do cater for retail investors as well as wholesale investors. For the retail investors, minimum investment amount is $20,000, minimum term is 12 months, and it is a variable rate, 7.85 for 20,000 up to 100,000, and for 100,000 and above, it's 8.35% per annum. And for the wholesale investors, we're offering a variable rate at 8.85%, and we've just announced from today, fixed for 12 months at 9% per annum. So for the next 12 months, you can get 9% for a relatively low risk investment. And we do pay the interest monthly, and that gets paid at the end of each month into your nominated bank account. So if you're looking for something that gives you a regular monthly income and is a relatively low risk investment, because I mean at the end of the day we make our money the same way as what the banks do. So if that's for you, we'd love to have a chat with you. We've got a booth in the room next door, so love to talk to you. So we've got a perfect track record. We've never had any losses. We've never lost any money for our investors, and our monthly distributions have been paid on time every single month. And at the end of the term, if any of our investors want their capital redeemed, that's always been paid back within 30 days. So just to give you a bit of a snapshot of the loan portfolio, at the moment there's 30 loans in the fund. 90% of the loans are first mortgages and 10% second mortgages. We do charge our borrowers on a first mortgage between 10% up to 14%, depending on the LVR and the location. And for second mortgages, we charge them from 16% up to 24%. So we do make a good profit for ourselves, and this is why we've never had any issues paying the investors on time. We do collect the interest from our borrowers up front, and every loan that we do is a short-term loan. That's our niche in the marketplace. We've got a network of around about 1,000 mortgage brokers from all around Australia who give us business, and we're probably getting around about 10 to 15 inquiries a week. Out of that, we might only approve 1 or 2 loans. So we can afford to be very, very fussy with the loans that we take on, and obviously we always pick the ones with the lowest LVRs, best locations, best presented properties, and people who've got the best exit strategies. So we only lend to businesses, we don't lend to individuals, we don't do any long-term loans, 25, 30-year loans. They're all short-term loans from 3 months up to 12 months. The average term of our loan is 9 months. So we do turn them over pretty quickly. Every month we've got between 1 and 3 loans getting paid out and 1 to 3 new loans coming on the books. Geographically, 50% of the loans are in Queensland, 22% in New South Wales, 13% in Victoria, and 15% in South Australia. So our book is quite diversified. 65% of the loans are secured by residential property. Usually it's the directors of the companies that we're lending to put their own homes up as security for the loan. So there's a good incentive for them to pay us back on time, because if they don't, we do have the right to legally take possession of their house, sell it up, get the money back and give the borrower whatever's left over. So we've never had to do that so far because we do have a very stringent approval process, and we're very careful lenders. 15% of the loan book would be secured by commercial property, and about 20% is vacant land, which is also residential property as well. So the main risks obviously are defaults. We've probably only ever had about 3 loans that gone into default. One went into default for about 5 months, and the exit strategy was to sell the property. It was a vacant land in Wollongabba in Brisbane. The owners got a DA to build a 12-storey apartment on it, and the market was rising, so they were just hanging on to it for as long as they could to get a good price. And that property ended up selling for $1 million more than what we valued it 15 months earlier. We've had a couple that do go 1 or 2 months over, but they always work with us. They're very sensible people. Usually they're in their 40s and 50s. They own a business. They've got solid assets. They own property. We've got a mortgage over their property. So they're really not going anywhere. So the risk is well mitigated. The other main risk is government regulation and compliance. We do have a in-house compliance manager, a guy by the name of Ian Chestermaster. He's a former financial planner. He also lectured at university in compliance and financial planning. So he looks after our compliance, and he does it very, very well. So there's no monthly fees, no exit fees. All the fees are taken out beforehand. So the rates that I've quoted you are all net of fees. We also have a distribution reinvestment plan if you want to take advantage of the compounding interest effect. That's available as well. You can opt into that at any time and also opt out of that at any time. So the fund is available for individuals, self-managed super funds, trust companies, family offices, etc. This is our management team, very experienced team. One of the things you really need to look at when deciding to invest in a fund is look at the management team. So thank you very much. I'm more than happy to have a chat if anyone is interested. Come and see me anytime. Thank you.
Thanks, Stephen. Our next presenter is an asset-backed private debt fund dedicated to delivering consistent, reliable returns for their investors. By focusing on secured, low-risk lending strategies, they provide a stable alternative in the private credit space. To explain their approach in more detail, please welcome Fund Manager and Director of OTG Capital, Ray Trevisan.
I like to run, that's all. That one there? Yeah. Hi and welcome. How's that? Goodo. Normal disclaimer, we're licensed to provide GA only, so again, just the normal disclaimer that we don't give product advice, personal advice. You've heard probably many pitches from private credit, which is kind of interesting. We've been going for almost 8 years now, and when I first launched the fund, nobody knew what private credit was, and so I spent most of my time explaining to people that we're not a mortgage fund, that we actually lend money, make sure it comes back, and we use mortgages as security. So we've come a long way, and it's nice to see now that there is a lot of variation out there and a lot of opportunities to invest in this asset class. I've been involved in private credit now since 2001, so that makes it 25, almost 26 years. I'm ex-military forces. I like to keep it simple. So the kind of thing that we do is very simple. And when my kids ask what I do for a living, I simply say I buy and sell money. And that's what I do on your behalf as a fund manager. I buy and sell money and make sure that when we lend the money out, it actually comes back. We're a boutique fund, we're nimble, we keep it down, our head count is very low, and I use a lot of outsourced type of services. We use the services of a public trustee. We also co-invest, and we provide a first loss provision to all our investors, which we actually enacted in the last financial period when we ended up taking an impairment, and we took the loss on behalf of our investors, and they kept on getting their returns. We're wholesale, so that normal Wholesale Corporations Act applies. So we provide monthly income or a reinvestment option, which again, you're going to see across the marketplace quite a lot. The nice thing is we are a holder of our own AFSL. We use a public trustee, AML, which recently got acquired by IQEQ. An interesting acquisition if you're interested in that part of the space. Now, holding my own license, I also now help others launch their own funds, and we are retail and wholesale regulated by ASIC. We have A and B class units. So the A class is fund to fund, so we invest in other private credit providers, and we are launching our first set of projects, our B class units, next month, and we'll be starting with a 3-home subdivision up on the northern beaches of Sydney where we're doing a capital raise for about $14 million. We are illiquid, and this is one of the things that many private credit funds have got into trouble with the regulator over the years. We make a point of ensuring that people that invest in what we do understand we're not an at-call facility. And this is where many people that first venture into private credit don't understand. They get the feeling that they're putting their money in an at-call facility. It's not, okay? What is interesting though is that when we've been doing redemptions, we can normally provide those redemptions within a week to 2 weeks. If we've got the cash sitting in the bank, we give it back. There's no point in holding on to it. We have a 25K minimum, but again, I've had some investors come along and say, well, we're not quite sure, so we'll lower it if people want to dip their toe in the water. But again, with SMSF trustees, which is the core of our clients, they're normally in the 50 to 100,000 as a tranche. We have no entry, no exits, and we're open-ended. So we don't really put any limits on people in that regard with our open-ended fund. We're very flexible, we're very open, and try and fit into the needs. As the fund manager, I choose the investment options, and that's where I get the right to say to my clients, you don't need to worry about the minutiae or the detail, that's what I take care of, and if anything goes wrong, I'll take the first loss. Now, what does that do? It really provides for the low maintenance fund, and I say to many of my clients, set and forget. Going back to the golf course, you'll be getting your monthly income, and for 7.5 years plus, we've been keeping true to our word. We have full online management systems, and again, you should expect this from any of your providers now. You should be able to go onto a portal, look at your unit holdings. We use Registry Direct, great service. I've been with them now since inception. And again, it provides you what you expect. Bottom line as well, if you ring our phone number, okay, a human will answer it in this country. It's not a big thing, but I like to sort of provide that level of personal service. It'll usually be me calling you back. Right? If I'm not available straight away, I'll get back to you. Performance. This is our chart, and I wanted to quote something that I actually read just this morning. How many of you here today get Livewire on your daily feeds? Many people get Livewire? I think the message this morning is fairly plain and simple. When again, if I can find it very, very quickly. 9 charts for investors to keep an eye on. Markets have stumbled out of the gate as geopolitical stocks, AI disruption fears, and stretched valuations test investor nerves. Steve's keynote this morning on AI was very interesting, I thought. AMP's Shane Oliver in today's Livewire highlights 9 charts, not 1, 9, that could decide what happens next, from PMIs and tariffs to inflation in the US dollar. And they're saying at present they are sending mixed signals. My message to my investors is, here's my graph since inception, and we've beaten the market for all but 7 months of that time over 7.5 years. It's simple, it's easy, it's set and forget. I don't know what more I can say, and I'm going to leave you be with 1 minute and 45 seconds of time to go for the next person. Thanks so kindly for your time.
Thanks, Ray. And closing out this presentation block, we have Tandm ACADS-BSG. They are transforming the construction and engineering space with innovative software that automates the complex process of sprinkler design. By significantly reducing manual design time and eliminating costly rework, they are bringing much-needed efficiency to the industry. To tell us more, please welcome Peter Glodick, the President and CEO of Tandm and Managing Director for ACADS-BSG.
Good afternoon. I've got 8 minutes to talk to you about not one, but two companies, and more importantly, one unique opportunity. What I'm presenting today is a vertically integrated software platform designed for compliance-critical building services. And this software that I'm talking about is actually disrupting another company I've built for the past 20 years in consulting engineering. And so to make this tangible from the outset, I'd now, if you can, invite you to look up the ceiling above you, please. There's registers and grills there for the air conditioning that keeps us comfy in the room. There's also fire sprinklers. So you'll notice a few fire sprinklers up there right now I can see there, most of the Joe Blakes. And they're installed in a precise location. But before each of these sprinklers have been installed, a human had to locate every one of those in compliance with standards. A human had to coordinate those standards with the building structure, the lighting, the air conditioning, etc. Multiple humans then had to check them for compliance. And then a human had to place every single one of those sprinklers on an architectural plan or model. That process for all buildings that require fire sprinklers to this day is manual. It's time intensive, it's highly expertise dependent, it's exposed to risk, and as we all have seen with the salaries, it's very costly, and they're accelerating as skilled and human capital reduces and decreases. And therein, in fact, lies the opportunity. Oops, back. The first company is ACADS-BSG I'd like to talk to you about. It's a 46-year-old engineering software business. It holds approximately 90% of the Australian market in one of our flagship products and around 65% in the Australian market in another product. It's the industry standard calculation software used across fire protection and air conditioning services. It is recurring license revenue. It has multi-decade customer relations and relationships. It's embedded in compliance workflows, in fact. So every time our air conditioning system, that I pointed out before, is sized, and every time a fire sprinkler system in a building is designed, and every time compliance documentation is generated, there's probably a strong probability that ACADS-BSG was involved. It's stable, it's defensible, and it's trusted. But what makes it powerful isn't just the revenue, it's codified engineering logic that it owns has been built over decades. Decades. So the second company I'd like to talk to you about and introduce is Tandm. So Tandm automates the design of fire sprinkler systems inside modern 3D BIM architectural environments. So if ACADS-BSG, like I just mentioned, standardises the engineering calculations for design, Tandem then takes that and automates those designs. So it's pretty powerful. But let's bring it back to this room. If a human were to design and fully coordinate the fire sprinklers I mentioned before in this room and the adjacent room and just the foyer out there, factoring in the structure, the ceilings, the lighting, the air conditioning, it might take them maybe 4 to 5 hours. Tandem can do it in about 5 to 10 seconds. So multiply that saving now across the floor plate they're on right now, across the building, 20 odd stories, across the portfolio in fact, and it's not generic AI, it's compliance aligned, domain led automation. And and it's built by engineers for engineers. So it's already been deployed across Australia and New Zealand. So it's in market. So what does this matter now? Well, there's a structural shift happening. There's a global shortage of experienced engineering designers, and that shortage is not getting better. Regulation is tightening, liability is rising, wages are spiralling out of control as a result. Yet every commercial building, one we're in right now, new buildings, refurbishments, retrofits, etc., requires compliant fire protection and air conditioning design. It's simply not optional. Let's reflect on that. Every building, every project, every jurisdiction, globally. So now expand that just beyond the fire sprinklers and the air conditioning I mentioned, to plumbing services, to electrical services, to all building services. That's where ultimately our roadmap at Tandem leads. Now, both these companies provide users with efficiency, consistency, and compliance. So ACADS-BSG provides an installed base of customers, a market dominance, recurring revenue, deep workflow embedment, and a sound track record for management. Tandem also provides, slightly different, intelligent automation, scalable efficiency, global standards expansion, significant growth upside with the same management of ACADS-BSG. So together, they form a vertically integrated engineering software stack. They're sister companies, in fact. So we go from calculation to design to verification and compliance. And when it's codified, it means something. Each business can stand on its own, but together they create something that no one else is offering in this space globally. So what's the impact? Well, it's not just about software. It's about reducing the reliance on the scarcity of the engineers I mentioned before. It's about improving repeatability, reducing design risk, accelerating project delivery, staff retention improvement, and in effect, reducing the cost of business, which all leads to increased profits. And doing so in a sector that failure just can't be tolerated. So this is not two disconnected software plays that I'm talking to you about today. It's one opportunity combining a proven cash-generative industry standard with next-generation automation platform and AI, operating in a regulation-driven global market that's been built for strategic global scaling. So to accelerate the expansion, in fact, why I'm standing here today talking to you all, is that we're looking for aligned growth capital and strategic partners. So if what I've described resonates with you, come and speak to us at table 5 at the end of the room next door, and let's explore how you can be part of these next phases for these companies. Thank you.
Thanks, Peter. And now let's welcome our next speaker representing our sponsor, Swinburne University of Technology. As a world-class university based in Melbourne, Swinburne is renowned for its focus on innovation, industry-linked research, and preparing students for the future of tech and business. To discuss how Swinburne is bridging the gap between academic research and commercial investment, please welcome Seth, Director of Commercial Innovation and Investment Management of Swinburne.
Good afternoon, all. One of the most interesting conversations, actually 5 of them over the last day and a half, have been university. What are you doing here? And the most interesting part of those conversations have been the end, where they lean on and say, yes, we would love to work with you. So today I'll try and walk you through Swinburne's unique commercialization pathway and venture platform that bridges academic research and market-ready ventures. Unlike other universities, Swinburne operates a fully integrated model, something we call as the full-stack innovation ecosystem, combining R&D partnerships, entrepreneurial talent, venture creation, capabilities, direct capital investment, as well as move research beyond labs. So we have our R&D partnerships across different institutions, and as well as venture creation models that are across venture studios. We manage over, we have our own fund, and we also manage over $18 million with Breakthrough Victoria. We run our investments through POC, right up to Series A. We do minimum of 100K and can invest up to $5 million at a time. We take our in-house approach of fund management as well as hold about 20 plus investments as part of our portfolio. We have what we call as a structured venture creation platform. So it's not accidental, it's not acquired, but it's created. And we generate a pipeline through our research translation opportunities, working with the researchers. We have founder development initiatives that help build founders and entrepreneurs, as well as we look at our labs and environments that are part of the university already. Our integrated research and infrastructure platform, we have key domains that we work on: Bionics Institute, we have our nanofabrication labs, we have the Victorian Hydrogen Hub, and the AUSTA supercomputer for all the quantum fans, and all under one umbrella at Swinburne. How do we work with collaborators and investors? We build our pipeline together. We partner in 3 different ways. We run structured programs for the investors, co-investing along their side with technical due diligence as a partnership opportunity, and align strategic LP investments which are complementary to the funds. We have a unique capability which we call as the spin-in model. And unlike different universities that do research for equity, our spin-in model is the biggest differentiator. We provide portfolio companies with access of specialized labs, technical teams, researchers, key opinion leaders, and milestone-driven research collaboration that extends the runway for validation. And we back it with our own sweat equity. So we are as involved in that venture or that creation. Our key takeaways, we generate, like I said, proprietary pipeline, venture creation, which is embedded in research. We de-risk early through capability, finding infrastructure challenge, research for equity, and an alignment on impact. And the last but not the least, we are designed to be a collaborative investor, a partner, and not just a competitor. I think that's enough for now. I would let the startups that we bring along and would love them to get a stage audience today. Thank you.
And that was Swinburne. Thank you, Abs. And now please join me in welcoming our next set of innovators. First up is Eudaemon Technologies. They are disrupting the $150 billion life tech market with an innovative sexual and reproductive health and wellness platform. Please welcome its executive chairman, Nick Northcott.
Take a leaf out of my colleague's book. All right, Eudaemon Technologies. We are a clinical stage medtech building the next generation hydrogel condom. So what is actually the problem? There is the obvious problem, which is that there are 1 million STIs per day. It's very scary, and increasingly they're antimicrobially resistant. So you get gonorrhea for life and you're done. Right? Plus 120 million unplanned pregnancies, $60 billion burden of disease. That's the obvious problem, right? We've all been scared by the Grim Reaper back many moons ago, but if we look at the problem today, STI rates are rising, particularly amongst 15 to 25-year-olds. Why? It's because the problem has moved from we have to we don't want to. So people actually are craving something different today. We live in a very distracted world, right? Everyone's got a device in front of them. I can't get my kids away from their devices. But people want intimacy, and they want that without any form of interruption. And we're seeing that across the condom market, where actually people are prepared to pay a premium for a better experience, right? How much would you pay for a beer these days? 10, 15 bucks? How much would you pay for a condom to have a better experience? Our ambition is to make the best condoms in the world that people prefer to use. The market's huge. It's a $12 billion market today. By 2030, growing to $20 billion. There's 27 billion units created every year. The fastest growing segment is the premium synthetic segment. It's 10% CAGR, and it's grabbing both volume and value. It's also a highly consolidated market with some really big strategics in the space. You'll know the names, Durex, Trojan, or you may not, some of you. Maybe the demographics are slightly different in the room. But there are some big players. There's also a lot of mid-tiers around the place. What is different about our solution? This morning I went for a run. I love to run. And I listened to a podcast about someone else in the US disrupting the condom market. And what they talked about was packaging, that people didn't like the packaging. That's pretty much the extent of what we're seeing. What we've created is the world's first hydrogel solution. So what's a hydrogel? Think of a contact lens, a soft contact lens. It's soft, safe, strong. Our material is inherently wet. It's 50% water. Why is it like that? Think of the human skin. It's skin, water, skin, water, skin, water, right? What's on the market today is basically a solid block polymer, which is a raincoat squirted with lubricant. We've mimicked the human environment to create polymer water, polymer water, polymer water. It's the closest thing to skin, we believe, that nothing like this on the market. It's also hypoallergenic. It has a range of other benefits. But look at the difference. You can see it. Our condom on the right, well, my right, it is entirely clear. It has no taste, no smell. You can potentially, over time, load compounds into it, antivirals, anti-STI drugs, Viagra, whatever. We haven't got to that stage yet. But it is, in appearance, different. And what do the consumers want? There's a whole range of drivers of liking in a condom. And it's not uniform, believe it or not. After 10 years in this space, you learn a lot. What the Chinese market wants is not the same as the US market or the European market. But we win on a series of different drivers of liking, which means we believe we will dominate the global market. Now, let's just talk a little bit about science. My colleague and co-founder Simon Cook's here, and we can talk technical if you would like to later. But there's this concept of modulus, which is strain over stress. Another way to think about that might be stiffness, right? So a lot of the other materials have a higher modulus or stiffness than our condom. What does that mean in practice? It takes less force when you put on our condom than another condom. But there's a compounding effect. Once it's on, it actually takes 35% less force. So it almost feels like it's disappearing. It's obviously not, because it's a barrier, it's doing its fundamental job. But it feels like it's not there. It looks like it's not there. How do we defend this thing if it's so good? One, we've got a really deep tech moat, right? So actually being able to create strength and stretchability has taken a long time, a lot of R&D to do that. Performs like rubber, but it's got 50% water in it and stops a pathogen from getting through. Two, it's thermally stable. People put condoms on their car dash windows in Dubai, 50 degrees. Will it sustain that? Will it be safe? Tick. Global IP protection, we've got 54 granted patents, including the major markets, the US and China. China's the biggest, US is the second biggest. We also have a deep trade secret moat. To be able to make this thing, it's taken 10 years of hardcore R&D. Where did this come from? The Gates Foundation put a call out 10 years ago going, somebody please solve this problem. Someone make a better feeling condom that will increase uptake. That's where we started. We founded the company. We've got a clean IP chain of title. We have some very supportive universities, including Swinburne, thank you, ABS, and the University of Wollongong originally. We built the product. We're very confident in the product. We ran a pilot clinical trial in 2024 that was very successful. We got some really good signal around safety, efficacy, but also consumer preference. This thing is a class 2 medical device, but consumers have got to want to buy it. It's different from a reimbursed product. We now have our Sydney factory, which is operational in Annandale. I'll talk to you a little bit about the commercial pathway in a moment, but we're ready for scale. We have an automated robotic manufacturing process that is again differentiated from the rest of the market. We have a Mark 1 and 2 machines, they're quite small. We're building a 27 million unit capacity plant in Sydney. That is small in the grand scheme of the global market. Why are we doing that? Because our commercial pathway has 3 big milestones. 1, prove the scalability of this so we can infinitely reproduce this to create billions of units at the right COGS, to create the right unit economics to dominate. 2, pass the pivotal clinical trial, 300 plus couples, run it in the US, push the US FDA approval. 3, launch in the market, dominate the US before we go into the rest of the world. Our strategy from a commercialization perspective is to be asset light and capital light. We do not intend to have a huge manufacturing presence. We want to own the IP stack all the way from product, raw material, all the way through to manufacturing technology, and then license this out to the big boys and print free cash. Why now? 50 years of stagnation. The consumers want this, they're pulling it, the technology's ready, there's a clear path to market. But this has happened before. Contact lenses. 30 years ago, hard contact lens was dominating the market. 30 years later, 99% of the market has moved to a soft hydrogel. It's also about a $12 billion market, interestingly. Contact lens, put it in, forget it's there. Hydrogel condom, put it on, forget it's there, but you're safe, you're protected. We're raising a 5 mil seed round. We've got about half the money banked. We've got commitments for about another 30%. We're closing out the round. We'd love to talk to you. Please come and see me and Simon. Thanks very much for your time.
Thanks, Nick. And that was Eudaemon Technologies. Next, please welcome Pulsatile Innovations. This team is addressing the critical global demand for advanced cardiac care with a transformative device designed to mimic the heart's natural rhythm. Please join me in welcoming its founder and CEO, Alicia King.
Good afternoon, everybody. Today I'm going to show you how at Pulsatile Innovations we're revolutionising the approach to CPR and first aid. The problem is recognising cardiac arrest. You might have heard of doctors A, B, C, D. It's the approach to a person to establish how unwell they are and if they require resuscitation or CPR. Depending on your level of training, C can either stand for start CPR or check for a pulse. However, breathing and pulse checks are inherently subjective and unreliable. They cause delays to CPR and defibrillation, which leads to harm and death. And when every 1 minute's delay to CPR where it's required costs a person 10% chance of survival, time and accuracy means everything. Let me show you a current medically trained person's approach to a cardiac arrest. So I walk in and I check for dangers. There's no dangers. I look for a response. There's no response. I check that the airway is clear. Then I look, listen and feel for breathing for no more than 10 seconds. Then I check for a pulse, again for no more than 10 seconds. But because I'm in doubt, I start CPR. Worryingly, only 20% of healthcare professionals can accurately find a pulse in that 10-second time frame. And only 50% can find it within a minute. 26,000 out-of-hospital cardiac arrests occur in Australia every year, and less than 13% survive. The evidence shows us that chances of survival can double and even triple if high-quality CPR is commenced within 2 minutes of collapse. But confidence to start and continue high-quality chest compressions remains low. And how do I know all of this? My name is Alicia King. I've been an ambulance paramedic and registered nurse for over 12 years. I've spent most of that time managing staff. I currently manage a staff of 42 paramedics. I've trained first responders and I've been involved in hundreds of cardiac arrests and resuscitation attempts. And that's why I founded Pulsatile Innovations and invented Pulsatile. It's a single-use adhesive pulse sensing device designed to be applied to the neck of a person who's collapsed and give information quickly and accurately regarding the presence of a pulse, prompting the need for CPR or to withhold CPR. It's a platform technology, and we know that giving CPR where it's not required can also carry risk. I'm very careful with my comms around that because I will reinforce, when in doubt, please perform CPR. I'm simply going to demonstrate that there is an easy alternative that seamlessly fits into the current approach and removes that doubt. So we'll look at a new way of approaching cardiac arrest. I still walk in and check for dangers. I still need to check for a response. There's no response. I look in the airway, but instead of wasting that precious time looking for breathing and a pulse, I apply Pulsatile, and within 5 seconds, I'm encouraged to do CPR and am giving feedback regarding the rate and depth of my chest compressions, making sure I give that victim the best possible chance of survival. Pulsatile is a Class 2B medical device. It uses a novel array of existing sensing technologies to ensure accuracy, eliminating false negatives and false positives often encountered in the field. It features the CPR mechanism that I mentioned earlier, and to use it, it's simple. You peel off a sticky backing, you have a pull tab to release the battery, and you apply it to the neck of a person who is relying on you to save their life. There's no device like Pulsatile on the market. Rescue Doppler is in Norway. They're currently doing clinical trials, but they use ultrasound technology. So that's expensive, it's cumbersome, it's got wires attached. It requires a person with medical training to interpret the data. Pulsatile has been designed for everybody. For trained rescuers, it provides a whole extra resource by acting as an extra set of hands, reducing cognitive load and supporting clinical judgment. I was called to a 40-year-old man who'd collapsed in the street. He had no less than 8 people standing around him. CPR was required, but it wasn't being done because one of those 8 people said that he was breathing. This patient died, and it resonates with me. I think about him a lot, and I think, what if there was a Pulsatile there empowering just one person to be like, no, this objectively is stating this person needs CPR. It's an 8. Let me see where I am. Our go-to market strategy is very clear. So we'll first sell to healthcare organisations, including ambulance services, hospitals, any medical and allied health clinic where a defibrillator sits, and a person is trained to use it. That'll generate that early revenue and clinical data we need to penetrate the retail market. That will include community centres, first responder organisations, and individuals who have an astute first aid kit. We have a vision that a Pulsatile will sit with every publicly available AUD in the country. It's an $8 billion market. Since the sales of Pulsatile will be analogous to defibrillation pads at a bare minimum, we believe that we've been able to use existing data to develop our bottom-up market opportunity, including a CAGR of nearly 10% by 2030. Retailing for a market-tested $95 per unit, we'll use direct sales and distribution modelling appropriate to the customer. By claiming just 5% of the market in launch year 2028, we'll generate $2.6 million of revenue in our first year. This will compound year on year with geographical expansion, return customers, and development beyond our platform technology. We've had significant experience in just over 2 years, but the best is yet to come. Over the next year, we'll finalise our MVP, ready for our first in-human trial, and have our first regulatory submissions. Thanks to our most recently onboarded team member, Nicolette, we have a sound regulatory and clinical pathway. We're conducting animal studies right now at the Baker Institute with our current prototype, and our first in-human trial is being planned at the Alfred in Melbourne. Just this week, we've had Queensland Police and Northern Territory Ambulance Service contact us regarding potential trials and implementation. We've got a wealth of experience and leadership on our advisory group, and they've all contributed to our success so far. Our ask today is that we're raising $850,000 of pre-seed funds. We're not just solving any old problem. We want to save lives during the single most critical moment for decision making. I became a paramedic to help people. Join me with Pulsatile Innovations to truly save lives. Thank you.
Thanks, Alicia. Continuing with deep tech, we have EntroMat, a pioneering startup. EntroMat is transforming global manufacturing through its proprietary high-entropy material powders. Please welcome its CEO, Greg Lindsay.
Good afternoon, everyone. I'm Greg Lindsay, co-founder and CEO of EntroMat. We're unlocking the future of advanced materials with the support of Swinburne University as a spin-out from the university. Traditional materials are limiting human progress, whether it be components failing in the field, reduced durability because of wear, component damage due to rust and corrosion, damage from thermal effects, high temperatures. The materials are limiting the transition to renewables because of things like conductivity, insufficient conductivity. Traditional alloys are at their limits. The solution is to develop high entropy materials using the power of AI and computational capabilities. What is a high entropy material? In simple terms, the animation on the left there shows you a conventional material has a dominating element and the other alloying elements are much less. A high entropy material has 5 or more elements in equiatomic, same number of atoms, proportions. Why is that important? Because on the right you can see you get superior performance in a range of different properties, and depending on which elements you choose gives you the properties that you need. When you're combining 5 or more elements, the combinations are potentially in the trillions. So that's where the computational capability comes in, where we can optimise and get quickly to solutions, and we'll accelerate that with physical AI. As Steve mentioned this morning in his presentation, that's science-based engineering knowledge being fed back into the AI to create a truly learning system. So the addressable market for these types of materials is huge. It's in the tens of billions of US. It's across a number of different verticals. With the fastest path to market for us, and very much our focus is in the industrials. Wear and corrosion resistance is a huge impact in things like mining, steel production, etc. And there is a very large market there for addressing those durability issues. We then move into things like renewables and energy, marine and defence, and then of course there's the long-term aerospace and medtech applications that really take these types of materials across a wide number of opportunities. But again, we are very focused. We know investors want to know that we're going to deliver, and so we are very focused on wear and corrosion resistance in industrial applications as our launch material. We have a growth roadmap that locks in the IP for these products. We discover the materials and validate them before we take them to market. We create a patent portfolio. We already have a patent in place and we've got several more underway. We'll have patent portfolios in specific types of areas such as corrosion resistance, thermal barrier, etc. And once we have that, we've then got several paths to market. We will establish manufacturing operations. We will have commercial scale capability based at Swinburne that we can use for commercial supply from next year. And that will include powder manufacturing. Now, the metal powders can be used for additive, and they can also be used for surface engineering or functional coatings to protect substrates, and is also available in a bulk material where a component can be produced out of the material. But of course, as we develop our IP and lock that in with the patents, we can then license these manufacturing the materials to other geographies, or we could choose to enter those regions in manufacturing. So there are multiple options in terms of our growth roadmap. We are targeting 100 million in revenue by 2032. Our pathway to get there is to continue to build the capability within the business and also in partnering with Swinburne. We'll grow the IP portfolio. It is a global business. We are already doing global business development. We have an active project with Fraunhofer in Germany now to solve a major technical issue to meet an environmental regulation in Europe, and there's some very significant customers behind that. And then importantly, very importantly, the manufacturing is very scalable. The process of manufacturing the materials has been around for a long time. The technology is in the composition of the material. We own that IP, and then we can scale it up. And that also means we can get partners to scale it up as well. So our roadmap is such that by 2032, we will have license income as well as large-scale supply agreements, and potential exit for an investor is that we will get to large scale and potentially a trade scale. A trade sale. So we're running a seed round right now. The use of funds there is that we will establish a pilot scale production capability and we'll demonstrate proof of viability. That'll be through an AEA Innovate grant that Swinburne has got. EntroMat is the industry partner, and importantly that grant also enables us to access R&D. We put $1 in, we get $3 out. So there's a very large multiplier on that AEA grant. So this will also obviously build the talent in the business, both in engineering and BD, and expand into North America and into Europe, as well as leverage the Australian industry, and mining is clearly our focus, and we've already got activities underway in Western Australia. So this round is open now. We have a term sheet available from Breakthrough Victoria. I'm ready to talk to investors right now. I'm here for the rest of the afternoon and tomorrow, so please come and see me or contact me if you would like more information. Thank you very much.
Thanks, Greg. Our next presenter, Gapdrone, is literally bridging the distance. They are developing advanced uncrewed aerial systems to provide sustainable air freight solutions for remote and underserved communities. Please welcome its co-founders, Liesl Harris and Bennett Hare.
Receiving okay? Are you hearing? Okay. Hi, I'm Liesl Harris, and this is my co-founder, Bennett Hare. We're the co-founders of Gapdrone. What we want to do is we want to be the Airbus of the Southern Hemisphere. We want to finally resolve the tyranny of distance here in Australia. It's about damn time that somebody did that. Oh yes, I have slides. And we want to bring the exorbitant cost of air freight more in line with road freight as well as rail transport. So in the world of heavy autonomous logistics, many startups have failed, and this is not because the demand isn't there, but because basically they have built too big and too quick. They've failed to commercialize, and so what Gapdrone have done is we've resolved the barrier to the market entry, and we're looking to be the first commercial entry in the long-range cargo logistics market worldwide. What we're about to present to you is a solution which is initially starting off in the remote and regional areas of Australia, which is obviously where it's most needed right now. And it also proves as a secondary benefit in terms of a low risk, low population density underneath the flight path in order to prove the safety case to CASA and the regulators. Now, as investors, people are often wondering, well, how does it apply if you're only flying in regional and remote areas? Well, in regional and remote Australia, there's $575 million currently not being serviced or not being serviced efficiently at all. So there's a rather large market immediately just for testing. But if we're looking at the global serviceable, obtainable market, it's a whopping $1.3 trillion, all the way up to $1.4 trillion. So the first to market here globally is going to be the one to take the market. We are going to take a strong bet on us. Once we fly here in Australia, if you can do it here, you can do it anywhere. And before Bennett goes into the technical aspects of Gapdrone and the marvel of our Atlas platform, I just wanted to leave you with one question in mind. How is everybody coping with a cost of living crisis? No matter how well you are doing in your career, this affects every single person. And once we revolutionize remote freight, we can revolutionize global metropolitan freight. And so therefore, we can solve that ever-increasing inflationary pressure on our disposable income. So this is not just for regional and remote areas, it's for everyone everywhere. We've raised $4 million to date. We're looking for the final $3 million in our seed round. And we have partnered and are the only people in the world to have partnered with a national logistics carrier in Australia Post. So without further ado, I'll hand it over to our technical specialist, Bennett.
Thank you very much, Liesl. Gapdrone stands at the forefront of a new generation of uncrewed aircraft systems. A system that's built not just for endurance and payload, but for reliability, manufacturability, and real-world operational impact. Our Atlas platform is the culmination of years of engineering across aerodynamics, structures, avionics integration, and system architecture. At its core, Atlas is a medium-weight, long-range fixed-wing UAV designed to deliver meaningful payload across logistics and remote area operations. But what sets it apart is its performance that we've engineered into every subsystem that covers for robustness, maintainability, and scalable production. On the technical side, Atlas combines a highly efficient composite airframe with a V-tail control architecture and a modular payload bay capable of supporting a wide range of profiles. The platform is designed for long-range operations with endurance measured in hours, not in minutes that you traditionally see. The flight envelope of this drone has also been engineered for some of Australia's harshest weather conditions that we can see. At the moment, we're experimenting in Western Queensland, and we are building this drone for top-end Australia. Our avionics system integrates commercial-grade autopilots with redundant communication pathways, ensuring safe and reliable, predictable behaviour across all its mission requirements. But this capability is not enough. We truly need to scale. We need manufacturing excellence, and this is where GapDrone has made some of its most significant improvements. We've developed repeatable, high-precision composite manufacturing processes that reduces build time, increases structural consistency, and lowers costs per unit. Our tooling, layout methods, and volume production is designed for multiples, not one-off prototypes. This means our Atlas can be built quickly, reliably, and at a price point that makes large-scale deployment viable. We've also invested heavily in the modularity to make sure every subsystem from the wing assembly to the avionics trays are designed for rapid installation and field replacement. This reduces downtime, simplifies maintenance, and allows operators to configure the aircraft for different missions with minimal effort. Finally, none of this really matters without our ground control system, which provides our operators with a seamless, secure, intuitive interface for mission planning. Live telemetry and real-time command with long-range communication links and robust fail-safe logic allows Atlas to be flown confidently beyond visual line of sight. And when we say beyond visual line of sight, we're talking 1,000 kilometres. Currently, that sort of technology is only in the military domain. The GCS architecture supports multi-aircraft operations, remote handover, and seamless integration with existing command and control frameworks. In short, GapDrone has built more than an aircraft, we've built a platform. A platform that combines technical sophistication, manufacturing, scalability, and long-range operational control into a single cohesive system. And with that, I'd like to introduce a short video that brings all of this into some perspective. What you're about to see is our Atlas platform in the outback, full scale, with its full wingspan, operating in the harsh remote conditions it was designed for. This footage shows you the true size of the aircraft, the maturity of our manufacturing, and the progress we've made in long-range testing. It's a glimpse of where we are today and a clear indication of where we're heading as we continue to expand Atlas into new markets and new missions. Thank you.
The visuals are worth it as well, so it's all right. I did, yeah. It's not playing. That's unfortunate. You might have to come past our stand and see the video. I can play it over there. But yeah, it's Atlas on the runway at high speed, about to take off. But we leave you with bated breath, wondering when is it taking off. The answer to that is it has taken off initially, but we need to run an extensive flight test campaign. And so we will continue with our second airframe, which is coming off the line in March, and we'll be testing on the 23rd of March. Airborne and then ready to roll into a commercial contract with Australia Post. So this $3 million is critical. We have a lot of offers internationally. What we're trying to do is stave off the international offers to build for a robust Series A, So we welcome Australian investors particularly for this round to close off the seed round. We've had wonderful contributions from Swinburne and would look forward to talking to you. We're in the middle. I think that's the best way to describe it, next door. And Bennett and I would love to have a chat with you if you have some time this afternoon. Sorry about the video. I'll have it ready next door.
Thanks, Alyssa and Bennett. Joining us next is DIT AgTech. They are scaling precision livestock supplementation through their innovative UDOS platform, which delivers nutrients directly through drinking water. Please welcome its founder and CEO, Mark Pert.
Afternoon, everyone. So before I tell you my name, I want to tell you a bit of the sort of person I am. I founded DIT because I've got a single focus in my life to try to change an industry that I love a lot, which is agriculture, especially livestock. Food's really important. I get out of bed every day for that particular purpose, and I'm really proud of what we've built already. DIT's 60 staff, and I want to tell you a bit about what we're doing. I've presented here many times before in a whole different perspectives of our business. So my name is Mark, so we'll get started. A little bit about our business. The easiest way for me to tell you what DIT is, we're very similar to the Coke vending machine or the Gillette razor of Outback Australia. We sell the Coke machines that go through the Coke vending machine, we sell the razor, and we sell the razors to our customers. We are focused on driving production and profitability for farmers. We don't sell some fancy new gimmick. What we're trying to do is solve a problem that has been in our industry for many years. We have become a leader in ag tech solutions in extensive agriculture. What does our technology do? Well, in the last 8 years, we consistently increase average daily gains in cattle and sheep from 10 to 55%. We're increasing reproduction rates by 15%. We unlock data-driven decisions for our customers. We're involved in precision irrigation. We've got 30% reduction in traditional supplement costs. And lastly, we've cracked on how to reduce methane in extensive agriculture. Our problem. There's 27 million head of cattle in Australia and 65 million sheep. And without supplementing, we have no industry. There is no red meat in Woolies and Coles unless we supplement our livestock. Supplementing costs our industry between $20 and $100 per head per year. It's the second highest operational cost in extensive agriculture after labour. And it is a very, very difficult process. It's very manual. We have historically been feeding 50,000 head of cattle on 1 million acres by hand. We now deliver all of those supplements through the water. So our solution is our UDOS system. It's a piece of hardware that measures water flow, and off the back of that water flow we can make decisions from our algorithms on the type of livestock that are drinking, the amount they're drinking, and then we can precisely dose the animal health supplements they require. How do we know that? Because ruminant animals drink proportional to their body weight. It's all connected by telemetry with 3 minutes of latency with geostationary satellites developed in-house, connected with Inmarsat satellites that sit above PNG, all in our UHub dashboard. We've moved into fertigation as well. We've taken what we've learned in livestock dosing. We're now applying that in horticulture and solving problems there around chemical runoff and precision delivery of nutrients. And all of our supplement ranges are approved. Our solution is precise, it's cost effective, it's data driven, it increases profitability, and it's automated. How it works. Very quickly you can see we draw the water from primary water source, whether it's a bore or a dam. Our water meters measure that water flow. We dose into that water. The cattle drink. It's controlled by apps or on our dashboards remotely anywhere in the world. Some of these systems that we're now doing is we're dosing lines, feeding up to 7,500 head of cattle in Northern Australia with one doser and delivering protein and phosphorus and trace minerals 140 kilometres to a trough. We're not driving anymore, we're letting our water infrastructure do the work. Some simple installations there. We're a national company, as I said, from Southern Australia to Northern Australia. Our results, as we spoke, reduction in price, increase in average daily gains, increases in reproduction rates, measurable and accurate means more kilos of beef, wool, dairy from less cattle, sheep and goat. Nothing fancy, guys. Real tech that's adding more money to our farmers' pocket, and that's why we're scaling aggressively across the country. We're in climate tech. 5 years ago, we made a decision as a business with enough venture capital and enough scientists, we would solve how to reduce methane in ruminant animals. That was where all your money went, into solving that problem. No one could see the problem that we could see and that I could see as a founder from nearly 50 years in this industry. Delivery, own the distribution network, sort out the last mile of logistics, and you build a huge addressable moat. We've focused on that and we've nailed that. We're now feeding methane reducing additives into the water alongside these proteins, phosphorus, trace elements, producing carbon credits. And in July last year, the first ag tech company in the world to get a carbon project approved with Vera. It means now that any one of our farmers, we can enable software, we can deliver methane reducing additives into the water, and they can produce carbon credits, and we are doing it today. Climate and carbon is a big space for DIT at the moment. We're working with all of the large organisations as their delivery platform. DSM with Bovaer, Sea Forest with the Asparagopsis, some of the synthetic bromoforms, and predominantly now we're using Agolin, which is an essential oil, only because it's the only one approved under a carbon standard to produce a carbon credit. This is our platform. I'd love for you to come and have a look at our platform real time. We have about 25,000 sheep currently on our platform being fed these additives and 2,000 head of cattle. You'll find it fascinating, real time, carbon credits being produced every day. Our carbon project is producing credits, as I said. We have no competition. It's hard to believe. We have patents on our technology and on some of our delivery additives as well. Market opportunity is huge. I won't go into that. We're sitting in ag tech, climate tech and artificial intelligence. We've already built an AI agent to be able to manage nutrition of our herd that integrates into our platform. And 1 month ago, we cracked a strategic collaboration with Woolworth, Sea Forest and Tees with exclusive distribution rights globally of sea feed in a liquid form through our doses. An established board, leaders in the industry. Our chairman is the CEO of Tees Cargill, the big meat processor. We have our ASX listed chairman sitting on our board as well. Great management team. We're raising 5 million. We're halfway there. We're trying to close this out by the end of February. I'd love to talk to anyone about it and we can explain what we're going to do with the money. And that's 3 seconds to go. Any questions? No, it's okay. Thank you.
Next, we have Halocell Energy, a leader in next-generation solar technology. They specialize in perovskite solar materials that can harvest light in environments where traditional panels fail, such as indoors or in low light. Please welcome its CEO, Paul Mooney.
So today I won't be long. I want to discuss the satellite market and the difficulty of powering the future. So Elon Musk has come out recently. He wants to be sending 1 million satellites up to low Earth orbit. There's currently about 10,000 up there now. So he's talking about 100 gigawatts per year of solar energy that's going to be required for these to power these satellites. To give you an idea, Australia's whole grid is only about 60 gigawatts, so there's a lot of solar panels. The problem is space-grade solar right now is based on gallium arsenide, gallium indium phosphide, which is extremely expensive. It's hard to make, $85,000 a square metre. Our collaborators, Gilmore Space Tech, are paying for them, and it says a 2-year lead time there, but it's actually gone up to 5 because of the extraordinary demand. We believe there's a massive opportunity for perovskites. NASA has tested perovskite materials in space and realised it's the only really real alternative to gallium arsenide. So we've been very busy trying to capitalise on this opportunity. We've been quietly developing space-grade perovskite modules over the last 2 years with Gilmore Space. We have a MOU with them. They would like to fly our perovskite modules on their CubeSat, and we get live data back from that, and that's going to happen in about October. Whether Gilmore's rocket is ready to go or not, we'll still go with SpaceX or something like that. Now, flying anything in space, it requires stringent testing. There's 7 main tests, such as outgassing, thermal cycling, proton radiation, atomic oxygen, and got the other one. But we've passed 5 out of those 7 tests. So in the next couple of months, we expect all those to be passed, and then we can fly our technology into space. So we're going to be orders of magnitude cheaper than what's on the market at the moment, and none of this 5-year lead time nonsense. So what is perovskites? There's tens of thousands, it's a crystal structure. There's tens of thousands of different types. We've got our own secret sauce. We're only a small team in Wagga, 10 of us currently, but we were the first in the world to pass our durability tests, achieve really high performance, and also achieve our registration of hazardous substances first in the world as well. We're also the first to release our indoor PV product that powers portable electronics. So our main three main features of the company, we've got our secret sauce, smart chemistry. The way that we manufacture these solar cells, it's a flexible plastic that we start with, and we use roll-to-roll coating to rapidly produce these. It means it's highly automated, so low labour costs, but also the materials that we've developed, we're able to, there's very low energy input into the manufacture. The third thing that we do really well, we've got 6 collaborations with Australian universities, and we've got 5 formal collaborations with Australian companies. So we're raising $3.2 million at the moment. There's 1.4 in the tin. We would like to get some sort of more diverse shareholders. We'll be using that money for new plant and equipment for our pilot production in Wagga. 1.2 OPEX, and then grant matching after that. Thank you.
Thanks, Paul. Please welcome Cortical Dynamics, a clinical stage neurotech company backed by Philips. They have developed a patented AI-driven brain anesthesia response monitor that provides real-time metrics for both anesthesia and pain management. Please welcome its CEO, Ashley Zimpel.
Good afternoon. Imagine going in for routine surgery and waking up with brain injury, delirium, or trauma. Not because the surgery failed, but because anaesthesia dosing missed the mark. Too much anaesthetic damages the brain. Too little risks awareness. Too many opioids depress breathing. And too little pain control destabilises the patient. This can happen every day, not through negligence, but because clinicians can't accurately interpret the brain in real time. Over 300 million patients undergo surgery every year, requiring general anaesthesia. Current brain monitors rely on statistical guesswork, not physiology, to generate an interpretation of the state of the brain during an operation. The state of the brain tells us if a patient is adequately sedated and pain-free. Patients can receive too much or too little anaesthetics, which may lead to interoperative awareness, prolonged recovery, opioid dependency, post-operative delirium, accelerated onset of dementia, even death, and billions of dollars in avoidable hospital costs. The solution. We've developed BALM-2, the only brain monitor grounded in physiological modelling, enhanced by AI, that interprets how the brain generates electrical activity, or EEG, in response to anaesthetic and pain drugs. BALM-2 gives anaesthetists real-time objective readings of anaesthetic depth and nociception, or pain, enabling precise drug dosing that reduces the effects and cuts the costs. BALM-2 is protected by 30+ global patents and trade secrets. In the operating theatre, the bar monitor is positioned next to the patient and is connected to the patient by single-use bar sensors. They are attached to the forehead and the mastoid. Brain EEG is picked up, interpreted by our proprietary algorithms, filtered and displayed on the monitor screen in the form of two indices: depth of anaesthesia and pain, complemented by a spectrogram measuring the amplitude or power of the brain. Our first version, BALM-1, is FDA 510K approved, CE approved, TGA and Korean MFDS approved as well. There is a large global procedural market that we can address of over 300 million operations worldwide. We have a consumable revenue model driven by the sale of the device, and hundreds of cortical dynamics produce proprietary single-use bar sensors per device, and a solution clinicians will instantly understand. Competing in a market open to new product and innovation, and near-term trials and regulatory submissions are planned for 26 and commercial rollout for 27. We've established a license and cooperation agreement with Philips to plug and play a version of our technology into their IntelliVue monitors, and those monitors are in over 46% of all global operating theatres. Our partnerships extend from the AIT in Austria and Vienna to MPT Connect, Spartan Innovations in the US, Henry Ford Innovations in the US as well as the Springboard Medical Manufacturing Alliance in Perth, and of course the Medical Technology of Australia. Our investors include 10% of our investors are actually clinicians in the medical space, and they're investing because they want to see our technology rolled out into the global operating rooms. Our main top 10, 20 shareholders include BPH Energy, which is an ASX-listed company, IntuitiveX, a US life sciences accelerator, and Gentian Partners out of Korea. We've also received a number of grants as well to help facilitate the development of the product. We've been recognised by the Medical Technology Association, and we're invited to present in Canberra to influential politicians and industry leaders, and we've also extended our presentations across the globe to the US, of course. We're seeking to establish a presence in the USA and in the Netherlands, which will be a big market for us. We've built a multidisciplinary team ranging from people involved with corporate finance through to industry expert advisors Notably, we have Jamie Stanistreet, who's the ex-CEO of Medtronic, for 18 years as one of our industry advisors, and our clinical advisors have, in between them, done over 85,000 operations, and that's just the tip of the iceberg because we're talking to other key opinion leaders globally as well who are providing input into the technology that we're talking about. And our technical team are a very experienced group of people from professorial and doctorate level with expertise in AI and in anesthesia. We're raising capital at the moment in order to finalise the technical development of BAM2 and establish clinical trials in the Netherlands and in the USA. And post that funding will also allow us to secure regulatory approvals in the US, Korea, Australia and Europe and other markets where we have strong interest. And as well, we're looking to develop a go-to-market capability. So if you're interested in talking to us about possible investment, please contact me. The pathway to exit, well, right now our market is dominated by old technology, 30-year-old plus technology, notably the BIS monitor. So therefore we have a clear pathway towards creating a trade sale or a listing opportunity or a partnership with some of the top 10 global players in the world in this space who are already talking to us. There is no other monitor available in the market that measures both depth of anaesthesia and pain. And therefore, you know, we're going to be fluid on the exit strategy, but please talk to me again if you're interested. I will just refer you to the fact that yesterday, Danaher acquired Massimo to strengthen their diagnostic portfolio for $9.9 billion US dollars. So there's a lot of interest in this space. And finally, BAM2 represents the next generation of AI-enhanced anesthesia monitoring, combining pain and hypnosis measurement for safer, faster and more sustainable surgery and minimizing post-operative complications. BAM2 allows the clinician to better interpret the brain, control the dose, reduce harm and deliver superior patient outcomes. We believe anesthesia is at the same inflection point cardiac monitoring was decades ago, and this is that moment. With global clinical trials planned in the USA and the Netherlands this year and a strong IP portfolio, Cortical Dynamics is positioned for major regulatory and commercial inflections by 27 and 28. Thank you very much.
Thanks, Ashley. The next company is advancing a suite of patented dual drug platforms that utilize bioactive postbiotics to target first-line and adjunct treatments for autoimmune, inflammatory, and infectious conditions. To share the company's vision for scaling these microbiome-based solutions globally, please welcome its Executive Director, Dr. Anthony Noble.
Hi everyone. Previous speaker talked about imagining yourself in a hospital. I'd like you to imagine me and my wife in a hospital with our one-year-old son who was potentially going to have his finger amputated. And the reason for that was that he had had microbes from his skin and viruses impregnate that finger and cause a very rare condition. He didn't lose his finger, but what that indicates to you is just how powerful the microbiome of your skin can be. The viruses, the bacteria, the funguses that live on your skin when they're poorly regulated can have really significant impacts on your health. And that's the basis of Biomic, the company I'd like to talk to you about today. How do I progress the slides? Okay, sorry. Most people know about the microbiome in the sense of the gut microbiome, and obviously there is a massive industry around probiotics. It's about a $100 billion industry, but many people don't understand that the skin microbiome is actually a very important modulator of skin health, and we are the first company in the world bringing technologies to market through the skincare market to create a new category, which is microbiome skincare. Most products in skincare are basically chemicals. They're chemicals that people put on their skin, or they're poisons that kill the bacteria on the skin. And disruption in the microbiome as a result of skincare is actually a really serious issue. What we have created with Biomic is a range of products which work with the body's microbiome. So instead of using chemicals to treat skin conditions, we work with the body's own microbiome with our patented technology that is transforming the way people treat major skin conditions. And we've proven that it can work in the market with really attractive commercial margins. So across your lifetime, your skin microbiome goes through a number of changes, and those primarily are driven by the hormonal changes. Where people seem to see the most skin conditions arise is during the teenage years, during puberty, where acne occurs, and during midlife, particularly around menopause and perimenopause, where skin starts to thin and aging starts to accelerate. So we address a large number of microbiome-based skin conditions with our products. Particularly, we're starting with acne, but we also have a significant market opportunity across the entire range of skin conditions across the entire lifetime. Our technology literally works at every single stage of the skin's life cycle. So what is our technology? So our technology is based on a breakthrough made by scientists in our company at Novartis Biotherapeutics on the Sunshine Coast. We are a biotech company that produce live biotherapeutic products, and we're developing those through clinical trials. And in the process of that, in our precision fermentation technology platform, we discovered a large number of bioactive compounds present and excreted by those biotherapeutic live cell technologies, which could have powerful modulatory effects on the skin. We term those now BioQX. So what is it? What is BioQX? It's hundreds of proteins, enzymes, and metabolites expressed by bacteria, by a specific set of bacteria that we own in our proprietary cell bank that we produce in our proprietary bioreactor facility. And we complex those with a delivery system to form an ingredient that we call BioQX, which delivers those proteins, enzymes, fatty acids, and other bioactive compounds into the skin. Taken together, we have one of the most defensible moats of any company you'll ever see in this particular skincare area. We're the only company in Australia that manufactures their own active ingredient in skincare. We own our manufacturing facility, we own our cell lines, we own the media that we use to produce these proteins at high concentrations to put into the complex. We formulate everything ourselves, we manufacture everything ourselves, and we own the whole value chain down to the end consumer in our commercialization model. So we're starting with acne. It's the 8th biggest health condition in the world in terms of its prevalence. We have a range of products that we've commercialised for people that have severe acne under our Ultra Clear range that you can see here. And they have amazing results and fast results, which is something that people really want, particularly teenage kids that might want to go on a date or get on with their life, or they've had the confidence hit of having a breakout. Our best-selling range is our Clear range, which is, we call it our foundational microbiome skincare range. So people can progress from the Ultra Clear range to the Clear range, which is about prevention for those patients, but it can also be about people who have just minor breakouts. So people that suffer from recurrent minor breakouts, it's really terrible, like it just throws their life into chaos. This is a way to prevent those from day to day, and the Clear range is our main entry point product for most consumers. Our best-selling product are our wipes, which sit in the skincare routine where a toner would sit. It's impregnated with our BioQX complex. It restores the skin's microbiome and restores the skin's barrier. You can pair that into your existing routine, or you can buy the entire skincare system from us. But we're just starting with acne. This technology has the ability to transform every single category of cosmetic and skincare by using a pro-microbiome approach as opposed to everything else, which is a microbiome disrupting approach. We've launched a range of products for specific skin conditions that are driven by inflammation and autoimmunity, so psoriasis, eczema, but also for conditions that are environmental, so sunburn, shaving rash, places where you get inflammation of the skin, and those are in our Soothe range, which is a powerful anti-inflammatory formulation. And we've entered just recently into the first steps into the beauty and the perimenopausal skin market with our Glow range, where we've got a resurfacing toner, a serum, and in November we launched a range of hydrogel face masks, which are incredibly popular in the market at the moment. These are massive markets. Acne itself is a $10 billion market, and the treatment section of that market is about 60% of it. The global skincare market is, I don't need to tell you, absolutely enormous. What many people don't realise is that more than half the spend in that market is from perimenopausal and menopausal women whose skin will have the hormone microbiome disruptions that our products specifically address. So we started marketing in a serious manner in March this year. We've been able to grow the business over the last 12 months by about 5x. We're scaling to, we do about $8,500 a day. We take a pure e-commerce based approach to scaling the business. For every order that we get 2.7 orders on average. So that was 2.4 when we made the slide a little while ago, but it's now 2.7. These are extremely loyal and extremely sticky customers. We have a money-back guarantee. We've sold about 10,000 customer orders this year. We've had to give back 3 for not having efficacy under our money-back guarantee. These products work, they work really fast, and they're scaling extremely fast through social media. We're getting excellent traction, and as a fully vertically integrated company, our margins are extremely strong. 75 to 85%, 20% contribution. We've raised some capital, 3.5 million from existing shareholders at the moment, to help to scale that business more, and we're going to be able to aggressively scale more and reinvest more of that margin back into more marketing. Skincare is a high margin, high marketing spend category. The harder we spend, the more customers we acquire. What's unique about us is that we keep those customers for longer, and we drive long lifetime customer value out of them through loyalty because the products actually work. So we're scaling this business now to break even. We believe we break even at around about 10 or 11 million. We're a reasonably lean company. We are fully vertically integrated. We own our own factory. There's no debt associated with that. We only need to get a very small part of the acne market to break even. The pieces of the beauty market that we can capture are pure profit drivers in the future from there. And when you are a skincare company, you get amazing multiples. Skincare companies get acquired at break even or before break even, and the multiples that are paid are between 4 to 7 times revenue. Listed companies in our microbiome space also command extremely strong revenue multiples. So this is an incredible value proposition in terms of short-term value creation for shareholders from where we are now to an imminent liquidity event. And Australia is just where we're starting. We're from the Sunshine Coast. We're a group of scientists on the Sunshine Coast, but we believe we can take this product to the world, and we've got team members that have a track record in scaling businesses internationally as well. We have a contract in place for cross-border e-commerce to take our products to China this year, and we're launching our own company to do the same e-commerce-led approach in the US market, starting with Amazon and then going into broader markets. We will go into retail. We'll go into retail when we have a high level of brand awareness. We've got 10,000 customers last year. When we have about 20 to 30,000, we'll go into Priceline or Mecca or somewhere like that. But we're taking a very staged approach to build awareness so that retail doesn't eat the margins that are driving this business being so profitable. So as I said, we just completed a $3.5 million rights issue. We're looking to do a follow-on placement to purely new investors of 1 million. We'll scale the business from 8 to 12 with the expansion. IPO in 2027. Pre-money is 10, and it'll be a very massive uplift to value that happens at IPO. This is the only chance you'll get to invest in this company.
Thanks, Dr. Noble. Our final company presentation for the day features Astrea Technologies. As an extreme environment healthcare innovator, they are pioneering validation platforms designed to address frontier safety markets on a global scale. Please join me in welcoming co-founders Brooke Mills and Gordon Carroll.
Good afternoon, everyone. Thanks for sticking with us today. We know it's late in the afternoon, so we hope we're going to inject some energy into this room. I'm Brooke. I'm co-founder and CEO of Astrea Technologies, and I'm here with my amazing co-founder and CTO, Gordon Carroll. And we're going to talk to you about Astrea Technologies today. What we do at Astrea could save millions of dollars for cancer institutes, prevent medicines from becoming toxic in space, and maybe even stop robots from having a meltdown on Mars. So hopefully that's piqued your interest, so let's do this.
There we go. Okay, so we're aiming for the stars, literally. We've developed a technology that analyzes the degradation of materials and biologicals beyond low Earth orbit, where the radiation is so intense that it just knocks out DNA. Think a bowling ball striking a bunch of pins. That's what happens. Now, we've all heard the saying, shoot for the moon, and even if you miss, you'll land among the stars. Well, that's us, literally. Not only are we going to the moon in 2028, but we've also identified numerous on-Earth applications for our technology in the extreme environment sectors where failure is simply not an option. And as advertised on the CapitalHQ platform, Australia is an investment opportunity like no other.
So, here's the deal. Critical tech fails in extreme environments, silently. And when it fails, it's expensive. Like, we just lost 40 satellites, and that's $100 million kind of expensive. Back on Earth, we're seeing autonomous robots fail when scouting radiation hotspots, cancer institutes postponing treatment or cancelling services because their technology has degraded beyond use. And believe it or not, no real-time, in-situ capabilities currently exist to measure this degradation. Technology and products are being built based on modelling, not real-life data.
So enter Australia. We've developed a scalable product and quality service that quantifies risk, identifies product failure pathways, generates recommendations for radiation resilience, and validates safe use in extreme environments. Our product and service generate revenue through a multi-channel, high-margin model designed for scalability. Say hello to the Hero Lab, our tech whisperer. It's a 10 by 5 by 5 centimeter system that detects and measures degradation due to radiation in real time. Now, this is for materials, this is for pharmaceuticals, this is for biologicals, this is for anything in the agricultural industry. Now, we can use this in a simulated radiation environment thanks to our partnership with ANSTO down in Sydney and Lucas Heights. And the data from all of these things will be developed into regulatory-ready data sets and insights to support product optimization.
So, from a market perspective, our targetable market is 5 billion Australian dollars annually across space, healthcare and defence, and thanks to an amazing conversation that we had today, it turns out we also have massive agricultural prospects as well. So our customers are going to save millions of dollars by engaging with us to ensure their products perform flawlessly in these environments, reducing maintenance, replacement, and even mission-critical failure costs. The healthcare, defence and space sectors often only have one chance to get it right, and we provide them with significant de-risking services just for them.
So, Brooke and I started this because we are space fanatics. But the longer that we worked on this concept of the Hero Lab, we realized that it has so many on-Earth applications in extreme environments. Now, Brooke has over 20 years experience in startup in critical and emerging technology, and I combined healthcare and space industry, so we are really the perfect team for this mission. Alongside us, we have Graham, who not only is our marketing manager, but he has also worked on a concept for a lunar rover. So together, we know how to build, launch, and sell tech that refuses to fail, and we're just getting started.
So, what are we looking for out of the conference today? We are in our pre-seed raise at the moment. So we're seeking $3 million, and the funds will go straight into the commercialization of Hero Lab deployment, suborbital testing, R&D, and scaling our team. So we're looking for investors that are passionate in our vision and see the future of extreme environment healthcare as a strong new sector in Australia and globally.
So we solve a problem that nobody else can touch with a product ready to deploy, a growing commercial pipeline, and government-backed credibility. Now, we thank you for your time and hope you guys have enjoyed the conference.
Thanks, Brooke and Gordon. To round out the sessions for the day, please welcome Steve Torso back to the stage for a final keynote on the future of private market. Let's welcome him back on stage.
Now, I know I have to bring a lot of energy as the last presentation for today. So this is an area that I think about endlessly, is about what is the actual future of private markets, obviously, because it impacts my business, it impacts the way I work with my clients, it impacts the way it works with the entire ecosystem. And so last year I started actually came from a suggestion from it was actually from Jade, as a suggestion to actually do a couple surveys about what our subscribers, what our clients, and what our sort of fund managers are actually looking for. And then likewise on the investor side. And it's provided us with some of the most important data I think that we've collected in this process, of building what we are. And it did also solidify what I experience in my conversations. And so obviously I'm passionate about AI. We've used it relentlessly across our own business, at first out of necessity and then out of pure, productivity, the improvements that we saw. So for me, this is what I experience every single day. So effectively, a founder reaches out, they talk about how much time they spend on the pitch deck. I get version 30, of a pitch deck, and they spend 3 to 6 months going through it. Typically, any company you've seen raising capital today, they've spent anywhere, and this comes from Startup Muster, they've spent up to 450 hours and spoken to 150 investors in the process of their capital raise in a year, which is equivalent to 11 weeks. Now, if the round closes, they celebrate and they typically get back to work and back to building their business, right? Or they get frustrated and wonder why investors are ghosting them, wonder and start making comments like, oh, that person's a tire kicker, and, all that sort of stuff. And often they can get upset sort of about the process. There is a massive mismatch in this entire space between the way companies want to communicate their opportunity versus the way an investor wants to hear the information. And this has been, we do spend a lot of time educating on it. We give a lot of guidance, from me to the entire team, from what we provide. But it's still one of those relentless challenges that the entire ecosystem face. Now, what's even worse is effectively the entire industry teaches a transactional model. If you go and look at every single startup media article, every single accelerator, incubator, all they ever want to talk about is how to create an amazing pitch deck, which if anyone in this space realizes is an absolute load of BS. The pitch deck plays such a small role. It plays an important one, but it's super small if you think about the entire process, right? And then effectively, it also becomes that, investors who don't go ahead now, it's considered a no forever. And in fact, when I interviewed Jason Calacanis, who everyone knows from the All In podcast, I asked him, because he literally says to every company, it's part of their mandate, keep us updated with your, how you progress. I asked him the question, how many companies actually keep you up to date with the progress of their business? And his answer was low single digits. And I found that really interesting. And then also, for those companies, even if they do complete a raise, they typically come back 18 months later and they're starting from scratch again, right? It's been taught, I don't know why it's been taught this way. It's not practical for anyone. And here's the best part. Who in this room has ever raised money? Okay, keep your hands up. Keep them up for the moment. Up, 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 up. Who loves raising money? No. Okay, we've got one hand. There we go. Second one, put a hand up. Right, interesting. The last time someone said to me they love raising money, when they actually went through a capital raise, they handballed it to someone else. They loved it that much. But it's one of those things where I'm literally dealing with people every day that hate the process of raising money, and I get to work with them on it, right? And so it's an awkward process, all in all. So typically the process is everyone gets aggressive for like a 6-month period with the raise, and then whether they go ahead or don't go ahead, it turns into the follow zone. Where everyone misses is basically from this 6 to 24 months to this 24 months to 120 months. Now, when you're a founder that's raising capital for your business that's running out of money, right, the last thing you're thinking about is 24 months in. But the reality is this is often a time frame that people love to watch an opportunity unfold, right? And so this is the whole part that everyone's missing when it comes to raising capital. And if you think about what's really worked in all your capital raising journeys that you've ever dealt with, whether you're a fund manager, whether you're a company that's raising capital, it's often built through relationships of some way, shape or form, or over time as people get to see what you're doing, how you're transacting, how the business is unfolding, right? So the engagement component ends up having a much higher probability of success from a raise perspective over a period of time. And I've actually done a chart on this talking about the 5 levels of engagement between a company and an investor, right? But the real win is in the nurturing of that actual process. But yet the reality is everyone still thinks about capital raising as a transaction. Most people ring me up after they've launched their capital raise, right? In this case, it's been different for this event because of the relationships with MTP and all that sort of stuff. It's been different because it's a different approach and we had a different philosophy in which we took with it. But very few people think about what is their pre-engagement strategy, what is their post-engagement strategy. Everyone just relentlessly focuses on the raise. And the biggest thing I found, and this is for me personally, I said, I'm no different to any other business owner. I've gone through my wild ups and downs in my journey. It is unbelievable the value and advice and importance of connections of some of your shareholders when you're going through both good times and also bad times. And that part also gets missed in the process. So the truth is about capital raising, it is absolutely emotionally brutal, right? When you get rejected from an investor, you feel like you're this big. When an investor says they're going to be coming on board, all documents signed, money transferred, in that moment, for a few seconds, you feel bulletproof, right? It's just the journey that you go through. And no matter what it is, we still turn up with game face every single day. From the investor side, I appreciate come out in the survey really strong. There's a lack of liquidity at the moment. Everyone's hoping the IPO market's going to be open. Obviously, there's, we heard Partners for Growth OIF talk about how, 4 of their companies that exited actually went through trade sales, right? But there's this ability to exit is very difficult sort of in this space. And then also the struggling to find signal in amongst the noise. And I have to be blunt and say, I'm also have been in what we've been in how we have to market we're also part of that noise, right? But the reality is I know investors are looking for signal. They're looking for relevance, what's to them. And yes, we've built it inside of CapitalHQ, but as wholesale investor, we have to promote, we have to create awareness, we have to create visibility, and we have to basically provide opportunity for an ecosystem. For me, if an investor expresses interest in 1 opportunity or 2 opportunities per year, I've done my job, in my mind. Now, that might sound weird for some people, but effectively, it's very hard to find something that's specifically relevant to what you're looking for. And then for advisors, the biggest challenge is it's very hard to scale your advisory business unless you actually bring on multiple people. So, and also, again, it's a very much, and sometimes for the advisory side, it can be pure feast or famine, in how they operate. And the truth is, most advisors start with capital raising, realize how hard it is, and then basically move into M&A. And the ones that are still doing capital raising that do M&A, they're doing it so that they can get the M&A opportunity at the end. So the 99% problem of this space that I highlight to everyone, when everyone comes up and, whenever I've spoken to VCs or spoken to investors about what we do, they always want to ask me about, how can I get access to the good deals? And it's like, well, what is your version of a good deal? And ultimately where they land is, I want to know how to get access to the deals that either Airtree, Blackbird, or what are the top VCs are investing into before someone else, right? That's their version of a signal. Right? But the truth is the whole space focuses on that top 1%. For me, that's not really my interest, right? It never really has been. Our interest is in the 99% blue ocean area. And I think that's where it represents the most opportunity for the private market space, where it's sort of outside of the top 3, 4 big VCs, outside the top big PE groups, right? Where there's a lot of mid-market operators that basically, are working hard for their visibility, working hard for their awareness, etc. In that process. And the reality is, there's a lot of SMEs that are in that space as well, even ones that are thinking about succession, right? And when people think about a trade, sale, very few people are sitting there going, "Do you know what? I'm going to start preparing for my trade sale 3 years out." Go find me an advisor that's in M&A that doesn't think companies should be preparing 2 to 3 years out before their M&A transaction. Right? But this is I suppose the mismatch again in this entire space. But interestingly enough, the whole space also runs on emails, some version of what they call a data room, whether it's Google Drive, Dropbox, DocSend, you name it. And then also people doing cold reach out on LinkedIn, is the other way. And then the last part is gut feel and hope, as far as what's going to happen, in the transaction. So the interesting thing about it, if you really have a look at it, the entire world has changed. If you look at the listed markets, effectively you're dealing, it's got AI handling, whether it be algorithmic trading handling, nearly 89% of trading volume that's actually going through. And then now there was a report that come out from, I can't remember, it was one of the investment banks where they were talking about how 90% of a prospectus can be completed by AI, and they have a team member come and do the sort of final parts. And then also there's obviously the ability to track real-time sentiment. On the private market side, it's a completely different story. As I said, emails, spreadsheets, it's basically disparate systems sort of trying to work, with each other. And so that ultimately leads to that funding challenge of companies end up spending crazy amount of time in the capital raising space. And whilst they said 450 hours in a year, I actually still think that's wrong. The amount of time that they would have spent on their pitch deck, refining it, speaking to investors about their deck, speaking to their advisors about it. There's a whole bunch of gray area that we as founders and we as people that are raising money just shoulder, in going through the process. So that's why we did the survey. We wanted to ask investors about how they think about this space to provide data at a different level that you just cannot get anywhere else, right? Because when most people do their surveys, they typically just do it from all the VCs. They get all the VCs feedback. And as I said to you, if you go have a look at this space, this entire space right now, especially the technical, like the life science, med tech, renewable energy, the funding is from a lot of high net worths and family offices, and then also a lot of government grant funding as well. So they don't get a look into that. So that's where we want to provide some perspective. And then the feature survey was also helpful for me because for me, I always think about stuff that I can add to what we're doing on CapitalHQ. And now that we're back in aggressive building mode for it, it was important for me that I don't just build what I think is cool. It was about just building what people really wanted. So this is what you want. So what was interesting to find out is that 68% of investors were individuals. Even more interesting is that 25% of investors that responded identified themselves as founders and investors. Another 14% as advisors and investors. Now, you just don't see that anywhere else. If a company out there is having a chat and someone says that they're a founder, the last thing they're thinking is that that person's going to invest money into their company, let alone knowing that that's the stat that sits behind it. Interesting enough, 45% had 1 to 5 companies that they were invested into. Even more interesting was 14% had 30 plus investments in the private space. And as I said, the high net worth identifies 24%, and fund managers, and then also the 4% of family offices. And that makes sense. When you think about the comparison of how many family offices there are versus how many high net worths, that makes sense from a ratio perspective. But also what's really cool about events like today is you can just be chatting to someone and absolutely not know that they're a family office, right? Until, sort of later in the conversation. And that's what's also interesting in that it seems that the people we attract to our area do not want media spotlight, do not want to be covered in the news. They just like doing what they do under the radar. So what investors are actually looking for? Now, you don't see in this anywhere pitch decks. Effectively, when investors are looking at companies, the first thing they're looking at is the management team and their track record. They're looking at the commercial traction. And they're also now, and this is more important than ever, right? You saw this on the VC panel today. Competitive moat is absolutely being rewritten at the moment, especially in software. It's been rewritten about what is actually a competitive moat in software at the moment, right? And then you've got the fact of, there's now more interest in deep tech, life science. Any business have IP moat. You can see why that's playing out. Path to liquidity, was actually quite interesting to see that so high, and that does obviously correlate with the frustrations. Cap table quality. The interesting last one is that if you had gone back 3 to 4 years ago, that would have been much higher on the list of what investors are looking for. Literally, BlackRock tanked that when they come out and said that they're not going to be using the term ESG anymore. But that's how investor sentiment changes. So the frustrations that investors won't tell to a founder's face, is obviously the understanding of the liquidity and the exit options. Too much noise, not enough signal. I said it's always difficult for them to try and get out the essence of what they're actually looking for. The thesis mismatch. People want to pitch things that aren't going to be relevant to someone. The due diligence burden, and then likewise the ghosting. Right, the ghosting is one of the harder parts for this space, and it's understandable. right? And I understand it from the investor's side why investors ghost, and it's because sometimes you don't want to be impolite. There's two factors. Number one, you may not want to be impolite. The second one is it's basically just no, not now. And there may be other personal circumstances as to why, but it could be a yes down the track. So the follow-on opportunity was really interesting when we asked, what are you looking at? If you're going to be following on as an investor in one of your companies, 75% of investors said that they will follow on under the right conditions. What's very interesting is 51% it was situational, right? So half of investors said it depends on the situation of the company at that time, right? How much they would invest, right? If they were looking at 18%, they would do 2 times the initial ticket. 15% said 1 times, 6% said super pro rata. And I thought that was really interesting because I've never seen that laid out so clearly as far as how investors think about from a follow-on perspective. Now, what's even more interesting is that the investors wear a multi-reality role. There's a multi-role reality for all investors. And in fact, you all would have realized that the more you network with each other throughout these last couple of days, you all would have seen you all wear different hats. Some of you wear advisor, then it's investor, then it's then it's a builder. You know, other people, it could be family office, this hat, supporting portfolio company, this hat. Everyone wears multiple hats in this role. 66% said that they provide ad hoc advisory to the companies that they're working with, right? And so that, as a founder to know, is important. 41% said that they would happy to provide network connections to their portfolio company. Even more interesting, 37% would provide fundraising and M&A advisory. One of the greatest challenges for the entire space is that fundraising and M&A, and yet here the investors are looking to participate in that role. 25% said that they would happy to organize a syndicate lead, be a syndicate lead for those companies, right? And then 24% said as a formal advisory practice. So what that means for every single founder that's raising capital is you have this incredible talent base of people that have 20, 30 years worth of network experience and connections that you can tap into as your shareholders, you know, as part of their investment into your company. That is something that's never really, you know, stated too clearly about what that means for a company, because I tell you, when you're under pressure and when you're raising money, all you're thinking about is, I need the money, right? And that's what you're solely focused on at that time. So the capital raising process, you know, for me, I've worked really hard to think about how you can convert capital raising into a science and a process, but the truth is there's also some art to it. And that can't be avoided. That's when they talk about logistics, that's the last mile delivery, right? So there's a process of awareness, creating visibility for what you're doing. Then there's the consideration component. And this is the thing, this whole space teaches everyone that capital raising is awareness to decision, completely forgetting the consideration phase, completely missing that aspect and helping us. But in that consideration phase, then the laws of mere exposure effect come in. It's how you engage with the company, whether it be their updates, their information, you know, seeing some of them presentations, information sessions, boardroom sessions, etc. All the stuff that everyone used to do as a formality for their capital raise seems to be forgotten. All the things that investment banks do when they're going for an IPO capital raise. They start out with a non-deal roadshow before they do anything to do with a deal roadshow, right? But yet we get taught that it's pitch to decision, and it's not accurate at all. So what you told us to build, right, on the founder's side, these are all the features. I'm not going to go through it all for every single one, but whatever is relevant for you, feel free to read it. This is what you told us to build in CapitalHQ. So for me, the initial design of CapitalHQ, I wanted to streamline and simplify the process for investors and founders. I wanted companies to be able to answer investors' questions before they ask them. I wanted investors to be able to see the answers to their questions that they were likely going to think, and likewise get access to the information that was going to be relevant for the opportunity. And then on the founder side, I wanted them to be able to understand who is most engaged with your room and try and encourage that investor relations part. But the hardest part for me is I can't force people to do what needs to be done. I can guide, but I can't force it. But the best part is AI helps actually fix that. So all the things that are highlighted in this, is very relevant to everyone, right? So before, I said, people would spin up a data room, they would utilize it for their transaction, spin it down, and they would pretty much, if they were going to raise again, they'll go from the start again. It's very manual, the entire process, and also, it's fairly, there's pretty much a gut feel approach to how they're sort of thinking about who's going to participate, and also it's a frustration game as well. It's a process of managing your frustration because you want everything now, and the reality is an investor can do anything, they can do things on their own times, on their own terms, right? So for us, our future, the way we see it, is that it's basically having capital engagement as an infrastructure in the actual process. So for me, the continuous thing of, not just having capital raising intelligence, but that always on infrastructure focused on capital engagement 24/7. Proactive engagement from the founder's side as far as how they're giving updates about their business. Real-time insights from the investor's perspective. Real-time insights on what's happening in their deal room and what are some of the key warmth signals as far as who's actually really interested in what you're doing. And then also the automated communication drafts in your sort of tone and voice. And then, of course, the ongoing engagement. I get frustrated, I can't change it, but I'm definitely doing my best to educate it. If people stuck with a process of continuous education for 5 years, they would see that their capital raising process would fundamentally change over time. This in-the-minute now process makes it very difficult to set up those foundations. So what we're building is your AI capital engagement agent. Right, and it's specifically designed for private markets, so for companies, fund managers, advisors, and then also investors. So the features that we're building into it is the investor warmth signals. That was a key thing that everyone wanted, from the advisory side and also from the investor side. The auto draft engine across all the different parts, whether it be from invitations to information sessions, whether it be replies to communications, whether it be doing updates on your progress with your business. An investor insights hub was another thing that was very much desired. And I can understand that because right now, my LinkedIn, if you think about where you get your information from, who here spends a lot of time on X? Okay, a couple of us. Who spends time on LinkedIn? Who loves spending time on LinkedIn? Okay, notice how many hands go down in that process. For me, I've got a great hatred of LinkedIn. My inbox is an absolute mess. Literally, and then when I look at all the posts, it's pretty much 90% noise, 10% signal. So our thoughts are, I want to provide how I've done my presentations today, as far as today and yesterday, the signals I see. I want basically, because we work with some really impressive fund managers, I want those signals going out to our audience inside CapitalHQ so that you can either build your own thesis, update it, ignore it, whatever it may be. But either way, the insights are super important, not just what happened overnight. It's more focused on the signals part. And then the advisor command center. What was really interesting was for investors, I think it was the second thing that investors were looking for, was an advisor command center, the private high net worth investors, because of how they're supporting their portfolio companies. So the process we're building is effectively from zero to investor ready information in the space of 60 seconds. So the input is quite simple: pitch deck, website, LinkedIn profile, and then the process obviously gathers the data, and then the output is the investor overview, an executive summary of the opportunity that's investor friendly, and then also a corresponding pitch deck that goes with it. And so what does that, and I'll tell you what that looks like in a second. That's the next slide. So, in this model, we're obviously using the latest AI as part of that. The deal room generation is important because I know people spend, even though we help onboard our clients, I know they'll go and spend too much time on their actual deal room because, that's what we do as founders. And then for investors, it's the ability to actually chat with a deal room and ask whatever questions it may want to ask, in the process. For raisers, obviously doing decks is important. And then the last one is the investment intent signals. And I forgot to mention, the other important thing is the ability to reject an opportunity, right? and do it in an anonymous way and also give feedback. I would say for you as investors, sometimes when you're rejecting opportunities, the reason you're objecting or rejecting it or saying no for now can be some important, valuable information for us as founders. So we want to facilitate it, obviously not to denigrate anyone or anything like that, but to actually help give people guidance. For all the companies that are participating over these 3 days at the event, they will get more, I suppose, intelligence about their opportunity across the day that they're featuring than what they would normally get in months just because of the concentration of conversations. But obviously we want to do our best to bring that in the digital format, right? And then this is what the envision of when we put this in and we asked DIT kindly, and obviously Mark just presented, and by the way, I got so much respect for Mark. He's just mentioned before, he's had 10 million invested from our network. I've watched him grow that business over a long period of time. So he was the perfect person to use, in sort of doing this. But to be able to put in his company information, just some simple information, and be able to spit out a pitch deck which reads simply, helps an investor understand what are the key signals that they're looking for in an opportunity. Because I know when you look at an opportunity, I'm spending 24 hours, 7 days a week building my business. You're giving me 30 seconds of headspace. I have to do your best to capture your attention, interest, and desire in those 30 seconds of headspace that you're giving me. And so that's why being able to highlight those key signals of an opportunity that an investor's looking for, when a company wants to go and pitch their technology to you and you're wondering who's backed them, what's the traction metrics, who's the team behind it, what have they done before, how do you get that displayed as quickly as possible? So for us, we're fortunate enough that we've already built a significant network across Australasia, Europe, UK, now also starting the Middle East, and also through our partners in CapitalHQ India. We've now also started to build a network there. We're very fortunate enough in that we have the full spectrum of opportunities, right from startups, scale-ups, funds, private credit, private equity, VC funds, you name it. And then also we've got a unique data advantage as well, which we want to put into action. So for us, what this means for everyone in the room is that from the founder side, what I want to build for you. Now, of course, there's the first iteration that we build, and then there's what we progress from the feedback loops over time, is I want to build for you your always-on capital engagement agent. It's your infrastructure that works with you round after round after round, not when you switch it on to do this current raise and then switch it off when you feel like you're done or you struggled or whatever it may be. It's just meant to work in the background for you on your raise. For investors, I want to improve the signal to noise ratio from what we do. Of course, from the wholesale investor side, we're always going to be inviting you to different activities, to conferences, to meetups, and to all that sort of stuff. But when you go in that CapitalHQ app, you should see what is most relevant to you from an opportunity perspective and from an insights perspective. And then for advisors, our whole focus going forward is we want to work aggressively with the advisor ecosystem because you guys do so much hard work on the structuring of the companies, the preparation of the companies, and so forth. And then, of course, then you have to go out to your investor ecosystem. Now, of course, we've built one of the largest investor ecosystems in the country and even in the region, right? So it's a great alignment in how we can work together on the opportunities that you're working with going forward. But also, more importantly, I want our platform to be working for your advisory business and for your clients 24/7 behind the scenes as well. So the end game is basically the digitizing of the relationship layer. Now, I know, of course, some people want to talk to me about I talked about the tokenization of everything. My thoughts on that for us is that I want to integrate with the token platforms. I don't want to build my own. I want to be the relationship layer for those platforms. And so for us, it's all about how do we automate all the friction points and the communication points that just frustrate the entire ecosystem in their processes. And so it's not designed just to be a tool. It's designed, as I said, to be infrastructure and backbone to how people do what they do on the capital front. And as I said, ideally, it's from the seed right through to the exit, in an ideal world. So if you want to learn more about, this is what we're working on right now. There's two things that we're doing right now is number one, we're refactoring CapitalHQ. And at the same time, we're also building the agent, and said there's two parts the way we're thinking about it. Is one, it's designed to be your investor relations specialist. And the second part is your capital raising strategy, your strategy as well. So that's for us what we're building. So if you'd like to learn more about it, I'm just giving everyone the opportunity to register interest. I basically want to get as many people using the sort of MVP version, that we launch over the next few months whilst we're building up this. I am going to be talking about it a lot because for me, 2026 is the year for all of us to be super aggressive in what we do. I see agents being part of absolutely every part of our workflow. And I'll tell you, there's two things I'm going to be relentlessly focused on. Number one is obviously the capital raising agents. And then the second part is how we can help companies get AI across their operations in their business. And we're going to be doing that with partners. That's not through us doing that. We're going to be partnering with Main Beach Advisors for that. So you'll see us hosting shortly a 2-day workshop, which will be all around how do you use AI as it relates to capital raising, and obviously talking about our agent that we're building. And then the second part is how can you overlay AI across all of your operations? Because the reality is all we all really want is have a successful business. And if capital raising can be made anywhat easier, right, or less emotional or less friction, that's great. And if executing in your business plans can be made easier from AI, then that's also a great outcome. So if you'd like to know more, for advisors, basically just scan the QR code and you can register that. We're just going to have some early introductory conversations with advisors. We are going to be running advisor accreditation programs as part of this process as well. Because it's for us, it's just part of, we just want to build we've always got great advisors in our ecosystem, but now actually we really want to closely collaborate with them. And then for the companies, if you'd like to know more, if you're already a client, there's no need. You will get early access to it. But then obviously we can have a chat about that as well. So for me, as I said, I think the future of private markets is all about how do you remove the friction layers in that communication gap between founders, fund managers, and investors. And then how do you have that always on prompting to help people keep up the engagement cycles of what's actually required for successful long-term raising. So on that note, that finishes my keynote for today. Tomorrow, we're all going to be back here at 9 a.m. Tomorrow's an absolute banger of a day. Firstly, we've got Greg Paramore, literally my favorite person to hear about on the property side. He's going to be breaking down how he sees what's happening in the Australian property market. Obviously he's going to be talking about what's happening on the interest rates front and obviously what's just happening in the macro environment, and also, talking about the various states. Greg is an absolute wealth of knowledge when it comes to property. And even more fun is we've got the CEO of OKX Australia, Kate Cooper, coming up. She did an amazing keynote at our AI summit and actually really helped me with something, in basically what I do on the team front now on the AI side. She's going to be obviously talking about the future of finance, because if you think about it, a lot of what the crypto platforms are actually doing is now they're building out the financial layer, the wallet infrastructure for what is going to be that future of finance, and they will all play a very significant role in that. And then, of course, we've got the Family Office Investment Trends panel, and we've also got the Private Equity Investment Trends panel. So tomorrow we have a massive day for you, and then we have the most important part of an event, the closing networking drinks. So ladies and gentlemen, on that note, hope you enjoy day 2. Enjoy the rest of your afternoon.
Thank you.